Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Globalization is not going to be like we have seen it in the past.
Every company is going to absorb these impacts very differently, and you're not going to see it immediately in job loss.
The U.S. market is a big market. It's kind of hard to get out of it completely.
If China starts to make friends with our allies around a shared dislike of Trump, this is a bigger concern.
We'll see some of these backed off. I don't think the administration wants to crash the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, 90 minutes away from the payrolls report, and your scores look like this Friday morning. Good morning to you all. Lower by 2.7% on the S&P 500. On the NASDAQ, down by 2.9%. On the Russell, down by 4 full percentage points. Should we focus on upside risk to inflation or downside risk to growth? There's a clue in the bond market. The two-year yield is lower by 15 basis points to 3.53. We're down 12 on 10s to 3.90. As we anticipate the payrolls report later this morning, the estimate 140K. Sarah House of Wells Fargo with us 10 minutes ago saying this could be the last good one. That drops at 8:30 Eastern time. Then after that, Chairman Powell going into the weekend Who blinks first? We'll hear from the chairman, Lisa, at 11:25 Eastern Time.
Does he lean into the weakness that right now this market is picking up on? And certainly bond markets are expecting a Federal Reserve that will respond more to weakness than, say, some sort of pop in near-term inflation. He said the T word, it's out of the bottle. Let's see if he doubles down on transitory and talks about looking through the effects of tariffs. But ultimately, what can he say at a time when we're not getting the hard data, where policy is still uncertain, and frankly, they have a lot to lose on both sides here?
We've all read the same research. Research note after research note. It's really bad. Bruce Kasman at JP Morgan, bloodbath. That was the headline. Bruce isn't the kind of guy that writes a headline that says bloodbath.
No.
He thinks the odds of recession now is 60%. But if you read the note, it still isn't in their forecast. And I saw that repeatedly yesterday. A lot of people do not think that even if these tariffs go on the 5th, go on again on the 9th, even if China responds on the 10th, people don't think they'll stick. How long before we have to completely internalize the potential that maybe they will? And that's what's interesting about the price action from yesterday. So you can have a 4-5 percentage point move on the index in America. That's not even baking in the tariffs that were announced the day before. It's just a very real risk that it might happen.
To rip up the script, I was talking with a couple of money managers yesterday, and it struck me that a lot of people on Wall Street are conditioned to be calm, conditioned to see volatility as an opportunity, conditioned to look for what you can buy amid the chaos. And that still is the position that a lot of people are in after years of outperformance of U.S. equities. They still will outperform. And there is this feeling this too will be worked out because it always has been before, which is the reason why people are looking at the off-ramps. There is the Fed off-ramp, there is the Trump off-ramp, but either way, there will be some sort of off-ramp. The tail risks are getting fatter. And in a survey of economists by Bloomberg, it showed that recession odds have increased by 92%, but the odds of trade agreements have increased by almost 60%. So both sides coming to the fore with faith.
When you see big shifts like this, huge shifts that could lead to major regime change, it takes weeks, months, quarters, years to fully internalize how powerful that change might be, what things might actually look like. And the issue that I have with a lot of people on the sell side right now who haven't cut their price targets is they can sit here and say the tariffs might not be on in 2, 3, 4 months' time, but maybe the stock is down another 10, 15, 20 basis points, 20 percentage points in that time. And by then, who have you helped? Who does that help? That helps nobody.
At the same time, how do you help anybody right now when you can't give guidance? And this is part of the issue, is that things are moving so fast that when you talk to people, there is a bit of a deer in headlights feel for everybody because there isn't a sense of what formula you can use. I will just say this. How do you even get a sense of what the uncertainty tax is and strip that out versus the implementation of some of these tariffs? And then you can come out with some timelines for at what point you've got to price in tariffs and at what point you're just pricing in the uncertainty itself.
Copper down 4% this morning, crude down another 6% on Brent, WTI down another 6.8. Keeps answering the same question. This focus for this market is on growth and not inflation.
Which to me is the ultimate question. How much do you see a uniform downgrading of growth expectations around the world? And it's not just the United States. We did see that from Wall Street firms across the board. At the same time that there's an upside shift in inflation on oil. Interesting that OPEC Plus is increasing production. And how much is this a tea leaf to President Trump? And how much is this basically saying to all of those who are overproducing, all right, game on, let's go.
That was certainly an objective to get crude down. I'm not sure if this was by design, but the objective's being met. Neil Dutta summed it up well, didn't he, in the last 24 hours? Obliteration day. It continues for a second session. Coming up on the program, Priya Misra of JP Morgan as Trump's tariffs roil markets for a second straight day. Michael Zezas of Morgan Stanley as the president looks for phenomenal offers from trading partners, and the former Boston Fed president Eric Rosengren as traders boost bets for Fed rate cuts. We begin this hour with stocks falling for a second straight day. Priya Misra of JP Morgan saying the risk of a recession is about 50% and the market is not priced for a 50% recession. She goes on to say, where is the policy put? Not at these levels. There's no sense of panic in the White House or the Fed. Priya joins us now for more. Priya, good morning.
Morning.
You sum it up perfectly. We can stop panicking when policymakers start panicking. You see any sign of that right now?
I don't. I think there is a hope trade, though, in the market. I think the hope is that this is the start of negotiation and that this is actually not going to stick. And maybe that's right, but if the uncertainty, I love your uncertainty tax. That's what we're all grappling with. The Fed is grappling with that as well. And so as that hope evaporates and that uncertainty stays, so I don't buy, maybe there are negotiations, but that uncertainty has to build before you actually get that deal. The other big hope is fiscal. There's this hope that we're going to get this fiscal stimulus and everything's going to be fine. Well, the politics are not there yet. Now, do we actually get those tax cuts? We're talking about extension. Where's the additional stimulus? So as this hope trade, and I don't want to sound alarmist, but we've had massive shift and this is an ideological White House. I think when we came into this year, there was the ideological side, there was the pragmatic side, and we haven't really seen that pragmatic side. And I think, I don't know, is there an economic put? If we go into a recession, do cooler heads prevail? Perhaps. We're not there yet. The hard data has been strong. I don't know if today will give you that sense, but you need those negative payrolls, I think, for the Fed put to come in.
That was the next question. The hard data. Payrolls at 8:30 Eastern time. We started the year in 2025 and we sat around this table and I looked down the camera and I said, I hope we don't squander the confidence. Confidence is sky high. I want to see that translate into hiring, into investment. This country was gearing up for a boom, and you could see that in the confidence in the C-suite. That confidence, unfortunately, as of this morning, has been squandered. It's gone. Sentiment is down here. The hard data is still right up there. Unemployment at 4.1% does not speak to where confidence is at in the C-suite, for corporate America, for consumers around this country right now. How much longer can that spread stay that wide? That's got to be the trillion-dollar question right now.
It is, and I'm sure that's something the market's certainly grappling with that, the Fed's grappling with that, which is why I don't think you're going to hear a lot today, unless that number is weak. So as much as I have never cared less about a payroll report than today, because we've just had a big shift from, in terms of trade policy, but if that number is weak, and I would say weak is anything less than 150,000 starts to look weak. I think the market's going to say, well, maybe we weren't that strong as we got this uncertainty shock, as we got the trade shock, as we got the Doge shock. Remember, that's also happening in the background. You're getting fiscal contraction, trade changes, and if the economy is not fundamentally strong, and I would look at the hiring rate, that has not been strong for a while. Layoffs have been low, but if company margins, I mean, if tariffs are a tax on the consumer as well as the corporate sector, at what point do companies say, I've already cut hiring, I'm going to have to start laying off? So I think, to your point, that spread is going to compress, and I don't think it's compressing towards the hard data. It's coming down. I don't think it's going to take that long. If we don't get the negotiations, if we don't get these tariffs off the table, which you're talking about bilateral negotiations, and it's not really clear what the basis of negotiation is. When you're talking about non-tariff barriers, there's everything's on the table. So if that takes a while, I think the economy is going to respond. It's going to respond quickly.
I don't mean to be glib, but why is he speaking today? I mean, ultimately, Fed Chair Powell has told us that they don't have all the tools. They don't have all the answers. They also are in a dark room with a blindfold, bumping into the walls like the rest of us. Why is he trying to message anything?
Well, the Fed wants to be transparent. So I think he wants to explain the reaction function. That's really all he can do. He can tell us that he's not basing anything on a model. He heard what happened with transitory. So I think he's going to push back a little bit on inflation, that the Fed has a dual mandate. They're going to look at inflation. They're going to look at the unemployment rate. I think all he can do is maybe be a little bit of a therapist, but I love your point that interest rates can only do that much. Remember the lags as they were raising rates. You didn't see the impact on the economy. It takes, economists argue, 18 months to 24 months. So the hope, another hope trade is, oh, the Fed's going to cut rates and lower rates will solve everything. It will help some interest-sensitive sectors, but if the unemployment rate's rising, it takes a while for that to work. I don't think you're going to hear that from the Fed chair. I think he'll want to calm the market down and say, we're looking at the totality of data, but uncertainty is so high, we're not going to do anything. So.
What's fascinating to me is there's a discussion right now in markets that maybe traders are pricing in too many Fed cuts by the end of this year, that ultimately they're not going to be able to get ahead of any kind of weakness because of this dual mandate and because it's not going to show up in the hard data. You have kind of an interesting take on that, that maybe they will have to wait longer, but that they will have to cut substantially more. How much more? How much does this give you confidence, frankly, in the U.S. debt market?
Oh, it gives me a lot of confidence that interest rates are not pricing in a recession. If we're talking about 50%, 60% recession odds, where does the Fed take rates in a recession? We can debate when they start to cut, but we've seen the Powell-led Fed is not shy. They hiked in 75 increments when they realized they were a little late. I think there is a risk if the hard data holds up, it takes a few months to show up, they can't be preemptive, meaning that they are not going to start cutting in May, thinking that the hard data is going to worsen. the later they start, the more they have to cut. So I look at the end point. I think rather than when do they start to cut, the market price is an average of total amount of cuts. I look at that end point. The market's still pricing in now, today, a little below 3%. If we're in a recession, the Fed's going to 2, 1, 0. Maybe 0 is hard because that's a very negative real rate given how high inflation will be, but not 3. 3 is their neutral rate. So the rates market is pricing in a chance of a recession, 20%, 25%, not 50, 60.
Big difference this time. It's not their mess. No one's going to blame them for this situation at all.
Well, no one, maybe, except for maybe the person in the White House, which raises another issue because all of a sudden then it becomes a political motivation of how you message this and where you shift the blame. But you're right. Ultimately, it isn't under their control. People might blame them, but this is not something that's focused on the credit markets, and this is not something that they can fix preemptively.
I hear a lot of people on the conservative side defending the actions that we've seen this week, and I have sympathy with the idea that you should deliver some kind of reciprocity given what's been taking place in China over the last several decades. I think we all have sympathy with the political and economic argument of what's happened throughout globalization over the last several decades. Where there is consensus, though, is how this policy has been executed, how this has been deployed this week, the methodology that was used to come up with these kind of numbers. It makes it difficult to take it seriously. And that's not a good position for any authority to be in.
It makes it difficult for anyone to know what the off-ramps are. People were saying that the more specificity, the better, because suddenly you would understand what the nodes of negotiation actually were. And if you don't have those off-ramps, how do you even price in uncertainty? And how do you even understand how long this could possibly go on?
Priya, it's good to see you. Thanks for catching up with us. Priya Misra there of JP Morgan Asset Management. This morning, 2-year bond yields down by close to 19 basis points. We just broke 350. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. A South Korean court removing President Yoon from office after his martial law declaration. The ruling immediately stripping Yoon of his powers and setting in motion a presidential election to take place within the next 60 days. Elsewhere, U.S. Special Envoy Steve Witkoff meeting with his Russian counterpart in Washington to discuss a ceasefire in Ukraine. The U.S. now waiting for Russia's negotiator to report back to President Putin before moving forward with next steps. And finally, President Donald Trump saying the U.S. is close to unveiling a plan that would spare TikTok from a U.S. ban. The proposal calling for outside investors to own 50% of TikTok's U.S. business, with ByteDance's stake falling just below 20%. That right there is your Bloomberg brief. Up next on the program, preparing to negotiate.
Every country's called this. That's the beauty of what we do.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal.
Michael Zezas of Morgan Stanley joins us next from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Here is your Friday morning price action, down 2.9 on the S&P. On the Nasdaq 100, down by 3 percentage points. On the Russell, down by more than 4. Under surveillance this morning, preparing to negotiate.
It was a sick patient that went through an operation on Liberation Day, and it's going to be a booming country. Every country's called this. That's the beauty of what we do. We put ourselves in the driver's seat.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good.
So here's the latest this morning. President Trump suggesting deal-making is on the table. The president believing economic turbulence will settle now, that the tariff operation is complete. Bloomberg's Wendy Benjaminson joins us now for more. So, Wendy, let's go through the timeline here, what the next week will look like down in Washington, D.C.
Well, I think we're going to see a parade of foreign diplomats or foreign leaders, literally doing exactly what Donald Trump wants them to do, which is come and beg him for relief from these tariffs. I think you'll see American CEOs doing the same thing, trying to take advantage of that comment he made on the plane last night to say, if you offer me something phenomenal, that's great. That didn't work, we saw with China, where last night he said that, if he might give China some tariff relief if they, do what he wants with the TikTok deal. But then this morning they slapped 34% tariffs on U.S. goods. So China may be an outlier there, but I think there's going to be a lot of people asking Donald Trump for relief, which is what he wanted, I think, in the first place.
Well, we've gotten some conflicting reporting on that, Wendy. How open is this White House to negotiation? And he said, if we get something phenomenal, how phenomenal is phenomenal, given that there was a lot of reporting that they weren't open to negotiation before April 2nd?
Exactly, Lisa. I mean, that is the uncertainty that Donald Trump really thrives on, the sort of controlled chaos or not so controlled chaos of throwing a bone out there and saying, well, if you give me something phenomenal, and then you have to try to figure out what phenomenal is. But you remember when the TSMC CEO was at the White House and he offered $100 billion, and Trump right there in front of the camera said, how about $200 billion? And the guy was like, yeah, sure. But then Trump just stared at him like, no, how about $200 billion? And then he came back with more. So it's, people will just negotiate to the best, the best that they can, and Trump may or may not be willing to, accede to their wishes, but no one knows. There's only one person who knows, and that's Donald Trump.
Wendy, appreciate the update. As always, Wendy Benjaminson down in Washington, D.C. With us around the table, Michael Zezas of Morgan Stanley. Michael, good morning.
Hey, good morning.
This is tough. For a lot of people, it's so bad it just won't happen. Is that your position on things?
Well, I think there's probably plenty of room for negotiation. We just don't know what the parameters are, right? So one would expect that lower tariffs, potentially asset purchases, potentially more military spending in some of these situations might help. But really, we're in this discovery process right now of what the sufficient conditions are. Unfortunately, and I don't think this will clarify anything for anyone, they're probably different conditions for different countries. So we shouldn't go into this, at least from my perspective, thinking that any of these negotiations will go quickly or any of this tariff relief will come about quickly. And so we do need to price in at least most of the negative consequences of these choices.
What is the significance of the formula that this Trump administration used to come up with the tariff rates on each country?
Yeah, I mean, I only know what they've told us, which is effectively that it's supposed to be a representation of the trade deficit, and that in a theoretical world where if tariffs are equalized, that there would be no goods trade deficit. That said, I don't know if the information we're supposed to take from that is that their end goal is to just get good trade deficits down to zero, or if just that they apply the methodology and they're willing to talk about it. Again, I think we're in that discovery process over the next week. But either way, it doesn't seem like we're going to get relief quickly from any of this.
I was speaking with an investment manager yesterday, and I said, you know, what is your methodology of taking all of the data that we're getting it and ranking it, et cetera? And they said, I run a lot. I run frequently. What on earth are you telling your clients?
Yeah, I mean, listen, I think what we said coming into the year was that we did think that higher tariffs were going to be a fixture of the U.S. policy posture. We thought it was going to be mostly aligned with China, and kind of rest of the world would be a lighter touch. That's still generally true, but the China tariffs happened faster than we thought. We did think they'd get to 60%, but we thought that was kind of an early 2026 event. And rest of world would sort of be product by product and lighter touch. So the new thing we have to bake in here is rest of world tariffs are higher. There's at least that 10% minimum, and then there's higher levels on top of that. Maybe some of that gets negotiated back. But that means there's a weaker growth outlook than we would have anticipated. So now we have to price in weaker growth, higher recession probability, and unfortunately, I think most risk markets just aren't priced for that reality yet. Some of the stuff becomes positive catalysts once you've priced that in, but we're not quite there yet.
Do you entertain the theory that this was about getting the bad stuff out of the way, getting rates down, getting bond yields below 4%, down towards 3%, before they come out with a massive tax plan? Do you entertain any of that?
You know, I tend to look at this more as it was a sequencing of what was available to them politically and sort of legislatively going into this, right? So, because you could sort of make a theory that, hey, why don't we just do the tax cuts first and create space to operate and incur some of the pain around tariffs in the effort of kind of this grand remaking of the economy.
That's what people hoped for.
Right, but I think practically speaking, the ability to actually extend tax cuts and or do more wasn't going to be on offer early because you had to work through the budget reconciliation process, really slim majority. So you work with the things that are in executive control, which is tariffs, because that's open to you. And the legislative stuff was just always going to take longer. So I don't know if there's a lot of rhyme or reason to it other than the administration's doing what they can do with the tools they have available in service of their medium-term goals. And this just happens to be the sequencing of it.
The challenge at the moment for a lot of us is to kind of put markets to one side and think about where we'll be 12 months out.
Yeah.
In 12 months' time, when you've got your hands around the more complete policy platform, not just trade, but taxes as well, what's the mix going to look like?
Well, listen, there's two ways to think about this. It's like, are you better off 12 months from now than you would have been if these choices haven't been made? I think that's an open question, and I think answering that question isn't necessarily relevant in the sense of the real question is, can we price in the kind of negative effects of making these policy attempts? And once you've done that, can the policy choices you make to kind of ease that get it better? So if we were to kind of fully price in higher recession probabilities, weaker growth outlook, and then some of these negotiations on tariffs work out, and then maybe we get a bigger tax cut than we anticipate, because right now we think it's going to be mostly an extension of the TCJA. Those things can be positives on top of pricing in negative outcomes, but I think we have to go through the pricing in negative outcomes first.
Yesterday, there were a lot of historic kinds of comments, a lot of catastrophic rhetoric, sea change, the loss of U.S. exceptionalism. Did you take comfort in the fact that Treasuries rallied, and John mentioned this earlier, that even though people were talking about boycotting U.S. goods or boycotting the U.S. dollar, you did see yields go lower as a haven trade?
I mean, it's obviously an incredibly large and liquid market, and it makes sense that in times of uncertainty where growth expectations are weaker, that you would be buying more treasuries. I think that to us was sort of never in question. I know there's sort of hypothetical longer term concerns, but that's why we've had this preference for fixed income over equities coming into the year and then throughout all of this. I think that's still the way to be positioned right now.
That's the silver lining for me. I know it wasn't your base case, but I'd be extremely worried if we woke up one morning and you had all those people that were running around saying, we're going to see an exodus of money from the United States. People are going to dump dollar-denominated assets. They're dumping equities because that's associated with growth. I don't think there's a sign here that they're dumping dollar-denominated assets because of the policy volatility, because that would show up in treasuries too, and that is what would really concern me. And that's the silver lining, I think, from the cross-asset price action of the past 24 hours or so.
That at least the United States is not acting like an emerging market in this respect, because that's exactly what we would see.
You saw the dollar weakness, but the dollar weakness accompanied with a bond market sell-off would be getting my attention in a much more negative way, and I think it would get the Federal Reserve as well.
We're far way away from that, and the United States still is the dominant market, which goes to this idea of how do you get perspective at a time of a lot of superlatives.
Let's hope we never see that.
Yes.
Let's be very clear about that. Michael, thank you, sir. It's good to see you. Michael Caesar there of Morgan Stanley. Up next on the program, Aditya Bave of Bank of America as we count you down to the payrolls report, 8:30 Eastern Time, 1 hour and 4 minutes away.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The biggest one-day drop since the pandemic, and the drop continues. Equity futures negative and down across the board. Session lows, we're down 3.7% on the S&P. On the Nasdaq, down another 4 percentage points. On a Russell, we're down by 5.3. Let's get you some movers and start with Delta. Next week, we'll get a report from them. Earnings on Wednesday, they're down another 4.5%, down 10% yesterday, down 36% year to date. And Bank of America cutting price targets across a bucket of names, looking for super conservative guidance from these airlines over the next few weeks.
Which is something that we've already heard some sort of taste of. United shares lower significantly more than 10% yesterday, as well as people look forward to this idea of low consumer confidence translating into less travel. And Canadians, they're not traveling to the U.S., so that, takes a hit too.
Can we curse on air? RH. Restoration hardware, down 40% in a blink of an eye yesterday, down another 8 percentage points so far this morning. There was a call that the CEO was on. You've heard the story, I know. Sees the stock and it's, oh, not good.
Yeah, it's a four-letter word that begins with S and ends with T, and that's what he said. It was their moment, and this is ultimately what they're dealing with softer consumer demand, and they are uniquely affected by all of the potential tariffs. And you saw this with every single company that was potentially exposed to that, seeing pretty significant downdrafts.
These are companies that insulated themselves from China risk, moved the supply chains to places like Vietnam. We saw that with other companies as well. And now they're in a position where they can't hide. And they're also in a tougher position now because the wage differential in some of the places they operate is so much greater here in the United States that they'd be better off staying where they are and taking the tariff hit than moving production here and taking the wage hit. That's the problem, the challenge for so many of these retailers at the moment.
Which is the reason why there's just paralysis. And ultimately, at a certain point, how do you get out from ahead of this if you don't know where the off-ramps are, where your potential leverage will come from? It is interesting to see that that investors are really differentiating between those that have exposure to, say, China and overseas imports and those that don't. And you are seeing that, say, Dollar Tree, Dollar General, total discrepancy. I mean, there are some interesting patterns that are emerging in markets.
Tech is having a tough time of it too. We talked a lot about Apple. Let's talk about Tesla. It's down again this morning in the pre-market. We are negative by close to 7 percentage points. It's having a really difficult year already. Only back in November, December time, we'll be talking to the bulls on this name, and they were talking about the halo effect that came from the Trump administration. Stories changed so much in the past few months.
Now the halo effect has something more like horns, just based on the fact that Elon Musk has a pretty negative opinion rating in some of the recent polls, and he is associated with this brand. At what point can he resurrect that with stepping back from the company? At what point is this name just going to be caught up in the Magnificent Seven downdraft that has been 24% since the peak late last year?
Wanted to finish on the bond market. Check this out, 2-year, 10-year, 30-year. So this morning, equities are lower, bond yields were down 2, and then we saw the prospect of China retaliating with their own tariff at 34% on US imports, and we just cratered. We're down by 20 basis points at the front end of the curve, down 15 on 10s. Payroll 60 minutes away. The estimate's 140. I don't know if you even care about that this morning. If it's stronger, you're just going to sit there and say it'll be the last strong one. And then you've got Chairman Powell coming later at 11:25.
If it's strong, potentially, it's going to be even more of a problem because then Fed Chair Jay Powell can't even indicate that he's recognizing softness in the data and will be responsive to it. Right now, I'm looking at credit risk, surged the most going back to June of 2020. All of these metrics are flying out to levels that we haven't seen since the pandemic, and yet we have heard from Chair Powell before that he looks more at the hard data than he does the soft data. So what do you do with this? And how does he really spin this forward in a way where he can be the off-ramp for a problem that he didn't create and that, frankly, he doesn't have the tools to address?
We're hearing from Secretary Rubio, who just moments ago said that markets will adjust to US tariffs, and markets are adjusting to US tariffs. On our radar this morning, President Donald Trump saying he's open to negotiations for cutting back tariffs. Trump telling reporters he'd consider lowering tariff rates for countries that offer something, quote, phenomenal in return.
Do we have any sense of what the parameters of phenomenal are? And this goes back to this question of we can have a discussion about how to create a more fair trade situation, and I think a lot of people would entertain and agree with that premise of a discussion, but there is a question of how the tariff rates came out and where the details were for people to offer something phenomenal. We don't even have a sense of whether that's having to do with TikTok, whether that's having to do with cars, whether that's having to do with wine, cheese, and that's very difficult for people to really understand.
Anne-Marie was on Air Force One with the president yesterday, and when he came out to speak with the press, he wanted to talk about the golden visa, the so-called gold card with his face on. That was the first thing he talked about. He did not look unnerved at all by the way this equity market was reacting to the tariffs that were announced the day before.
He said it was expected. He said it's pretty much in line. And this makes people even more nervous because typically when there is nervousness, there is a response. And right now, it doesn't seem like this is something that the administration is going to push back on.
People think Chairman Powell will respond. Traders are adding to Fed rate cut bets in the aftermath of the announcement we saw in the past 24 hours. And markets are now pricing 100 basis points worth of cuts plus by year end, with expectations that tariffs lift inflation and slow growth, but that inflation hit won't last that long. And that's the bet. That's the bet implied by the forecasts in the SEP from the Federal Reserve only a few weeks ago.
That they will view this as transitory and they will cut on weakness. Priya Misra on from JP Morgan just moments ago, she had a fascinating take on this. They're not going to be preemptive. They're not necessarily going to cut so soon, but when they cut, they're going to cut a lot more than this market is expecting, because ultimately this is a Fed that is not shy about responding to recession. And should they essentially start to see it in the data, that is basically what they're going to be dealing with.
Seeing it in the market, commodities getting hammered. Crude down by 8 percentage points this morning. WTI 61, threatening to break into the 50s, which is unreal. Brent crude down by more than 7%. We're down this morning to about 65. Wanted to squeeze this story in as well. The EU preparing major penalties against Elon Musk's X for violating a law combating illicit content and disinformation. The New York Times reporting regulators are weighing a fine of over $1 billion plus demands for product changes.
Yeah, so this has been in the works for a while. It's both this idea of the EU going after U.S. technology companies, but it's also a question of retaliating against specific companies that are U.S. companies as retaliation. Just to sort of emphasize the China point, because the China retaliation is part of what's driving markets a lot lower. And there's a question here about how much China and Europe are going to go after specific companies in the U.S. as retaliation. China mentioning 11 companies in the U.S. that are now on the unreliable list.
This has the potential to get out of control. I mentioned this briefly in the last 10 minutes or so. I think we have to draw a distinction between a shock to the cycle and a shock to the system. It's clearly a shock to the cycle. You're seeing growth priced lower. You're seeing that in equities, in bonds, in commodities as well. The shock to the system will take much longer to internalize. Much, much longer from here. That's the weeks, months, years story. That's very, very difficult to price. That involves things like shifting away potentially from dollar-denominated assets. That speaks to the weakness we saw in the dollar yesterday. But I want to keep going back to the same point. We aren't seeing treasuries being dumped. And that's the one thing that would really, I have to use the word, that's the one thing that would really scare me, to wake up and see that. And the fact that we're rallying as hard as we are in the treasury market speaks to the idea that at the moment at least, it's a bigger shock to the cycle than it is to the system, because the tariffs aren't even on yet and may not be on at all for very long.
And the truth is, you cannot move a global system this quickly. That right now, this is a global system that is pegged to the dollar, that is pegged to the treasuries, that is pegged to a U.S. market that is the deepest, most liquid market in the world, and that frankly offers the swap lines to the rest of the world. So people can have big catastrophic ideas, but can you implement them at a time where the economy and markets cannot move structurally as quickly as proclamations or bills or tariffs can be put on or put off?
It's really, really hard to price the latter. It takes a long, long time to price that story. We're certainly pricing a shock to the cycle right now. Equity futures are down by 3 percentage points on the S&P as we count you down to payrolls due in just 1 hour's time. The median estimate in our survey calling for an increase of 140,000 jobs. Aditya Bharve of Bank of America calling for 185K, but saying, quote, risk to our forecast are very much to the downside. Aditya joins us now for more. Aditya, good morning to you, sir.
Good morning. Thanks for having me.
Is this the last good one, is the question a lot of people are asking.
Right, that is a great question. So one of the reasons that we have some strength in this jobs report is we expect payback in leisure and hospitality hiring. That was really soft in Jan and Feb, but it was very strong going into the end of the year. So we think that the Jan and Feb effect was probably weather-related, and you can get some payback in March. And then the other thing that we're seeing in the claims data is that you're not really seeing a slowdown, right? So claims are still low. That's true for federal claims. It's also true for the number that gets more widely discussed, right? We're still in the 220s.
Chairman Powell, 11:25. What does he say about all this?
So I think the question that we all want to hear Powell answer is, how will the Fed respond to stagflation risks? You mentioned earlier that the markets are looking for aggressive front-loaded cuts, but I'm kind of more in the other camp, right, where if the Fed has to go, it's going to be a little bit backloaded, and then they might have to go very fast. Because the issue with stagflation is it's almost like your two kids are running in opposite directions and you have to decide which one to chase, right? So initially, inflation's already above target. I do think they have to maintain their credibility on inflation. As long as inflation's going up, especially if the tariffs are implemented as announced and we're heading towards 4%, then they have to focus on that. They have to wait until inflation peaks out, maybe it starts rolling over a little bit, and then they can focus on the demand side.
So why do you think Fed Chair Jay Powell said transitory? Do you think that he's going to try to put that back in the bottle today?
The context of that statement was interesting. If I remember correctly, I think he said there's a chance that it could be transitory or something like that. And there's no reason for him to conclude that it absolutely can't be transitory, right? But I do think the Fed is a little bit scarred by its previous experience from 3 years ago, where it insisted that, that the supply shock was transitory, and it in fact wasn't. So I'm not sure they would jump to that conclusion so quickly.
There's also this feeling that there's either a Fed put or some sort of policy put from Washington, D.C. And it used to be that someone would panic about markets selling off in free fall like they are over the past couple of days. We don't get the sense that anyone is. Is Fed Chair Jay Powell going to be concerned about this from a sentiment perspective, given that so many households are really leveraged to the stock market, both in sentiment and, frankly, for retirement as well?
So that goes back to the stagflation issue. I think it's easier to respond to financial conditions when you see it purely as a demand shock. When the driver of weaker financial conditions is a supply shock. Go back to 2022, right? Markets cratered, the Fed was hiking because they had to respond to the inflation shocks. I think it's something similar for Powell right now, where one, consumer sentiment has been a terrible indicator of consumer spending. So we need to keep that in mind, and we need to keep in mind the fact that consumer balance sheets are still, there's still plenty of room there to accommodate some sort of inflation shock. At some point it could get out of hand, folks could lose jobs, and then I think it'll be much harder. But for now, Powell has to say, look, the hard data are holding up, and if anything, the hard data on inflation are not behaving as well as the Fed would like.
Are you seeing signs, based on the speeches you've read and heard, that they're conditioned by what happened in 21-22, and that would mean they wait longer than maybe some people think they need to?
I think we're getting the same message from the Fed for now. It's all just wait and see. Let's see how the tariffs play out. Let's see how much they impact inflation. Let's see how much they impact economic activity, and let's not jump to conclusions. So as long as this labor report is fine, you know, it's on to the next one. It's on to the next inflation print. And I'm not sure that they'll be swayed just by financial conditions.
And the market's down another 5, 10, 15, who knows how many percentage points. If you are just joining us, welcome to the program. We've got equities lower by 3.4% on the S&P. We've got crude down by 8 percentage points. Bond yields lower by 16, 17 basis points. The payrolls report about 48 minutes away or so. If you are just waking up, earlier on this morning, a headline from China announcing an extra 34% tariff on US goods that kicks in on April 10th. So your calendar now looks like this. On April 5th, the baseline 10% tariff kicks in. April 9th, the additional reciprocal tariffs kick in on the US side, and China is saying, we're going to have this stick ready for you on April 10th, a 34% tariff on all US goods. And you'd imagine this sets the stage for the negotiation to take place between now and then, without any sign, at the moment at least, that those negotiations are taking place, Lisa, between the US or China at a high level.
And we don't have a sense of what the off-ramps are. And the reason why this is catalyzing such declines across the board throughout global markets is once you start the tit for tat, it is hard to get that back under control, especially if you don't have an understanding of exactly how to alleviate some of the pressures. It's interesting that yesterday we were talking about how a lot of the pain was concentrated, focused on the United States as taking the biggest hit. Today, it is a global shock, and we are seeing this globally with markets falling. You're seeing credit spreads widen at the fastest pace going back to 2020 at the peak of the pandemic concerns. And there is a question of exactly how people even begin to reprice something that could be so sustained and that has such levels of uncertainty that we have not seen before.
We're seeing a lot of cuts to estimates over the past week or so from SocGen, Barclays, Edgard Denny twice, Goldman twice, RBC now twice. They've done it again. Lori Calvasina dropping her price target to 55.50 from 6,200, saying that the old bear case is now the base case. UBS, as you mentioned earlier on this morning, Lisa, they cut as well from 6,400 to 5,800. But yet still, as we indicated throughout this morning, a belief that by the end of the year, the stock market will be higher than it was from here. Because at the epicenter of Wall Street at the moment is a belief that these tariffs that were announced earlier this week won't go on, and if they do, they won't stay on very long.
which I thought was interesting in a survey of economists done by Bloomberg yesterday, that 92% of them think that the chance of recession has increased, but 58% think that there is a great likelihood that we are going to get some sort of trade deals that result in lower tariffs by the end of the year. I will say you are starting to see potentially signs of this in the hard data that are coming out. Yesterday, I thought it was interesting, and maybe I'm making too much of this, so please, I welcome all comments, but continuing claims came in at the highest level going back to 2021. And what some people interpret this as is that companies don't have the conviction to hire. And it leaves this question of how do you move forward with an economy where companies don't have that conviction? And that, I think, is a big concern.
Once you're out of a job, it's harder to get a job. And that's what you're seeing in continuing claims. And what we've seen in data elsewhere so far this week, factory activity contracting, services ISM below expectations, the employment component negative as well. That does not make for good reason going into the payrolls report a little bit later this morning. Aditya, it's good to see you. Thanks for dropping by. Aditya Bhavid there of Bank of America. Equities down near session lows. We're lower by 3.6%. Up next on the program, betting big on the Fed.
As things stand now, we're headed to recession. A lot can happen, but if these policies stick for the next quarter or so, then you have to start pricing in the Fed brings down rates to 2.25, 2.5.
We'll get you some insight into the Federal Reserve in just a moment from the former Boston Fed President Eric Rosengren from New York City. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equity futures right now negative by 3.4% on the S&P. Payrolls just around the corner. The Nasdaq down by 3.7. The Russell, the small caps, down by close to 5 full percentage points as China prepares to retaliate, announcing an extra 34% tariffs on US goods. Look at how this is showing up in equities over in Europe. Check out the DAX in Germany. We're down by 4.7%. Check out the move in Italy. The FTSE MIB down by more than 7 percentage points. And if you lift the lid on the Stock 600 and break it down, sector to sector across the index, banks are down 9% in Europe this morning. Speaks to the move in crude too, Lisa. Down hard there as well, almost 9% on Brent. This is about a real shock to the global economy, to the cycle. The prospect of growth rolling over aggressively and repricing the growth story, with crude down by 8 percentage points to 64 and WTI threatening to break into the 50s.
And you're seeing this trend across commodities with copper down 5%. You see this elsewhere as well. I will say what you just highlighted was a global weak story, and that I think is the key one. Yesterday people were talking about the U.S. experiencing the brunt of the shock. Today we are talking about a global downturn in growth that's being priced in across asset classes.
Under surveillance this morning, betting big on the Fed.
As things stand now, we're headed to recession. The Fed already told us a couple weeks ago that, yes, it's not pleasant to have this cost push inflation, but they'll look through that. They're more concerned about the downside. A lot can happen, but if these policies stick for the next quarter or so, then you have to start pricing in the Fed brings down rates to 2.25, 2.5.
So here's the latest this morning. Traders increasing expectations for Fed rate cuts. The view from the former Boston Fed President Eric Rosengren looks like this. He writes the Fed may be slow to react, given uncertainty around the trade policy and the likely significant impact on reported inflation over the next 6 months. Eric, welcome to the program, sir. Lucky for us to lean on your experience. How misplaced or well-placed is that bet on that Fed cutting rates?
I think it's a very challenging environment for the Fed. First of all, while the tariffs have come on and are quite significant, the retaliation is just being announced now. We had China today, but Europe is certainly going to be retaliating as well. The question is, how long are these tariffs going to be in place? The administration has been pretty unclear as to the purpose of the tariffs. If the purpose is to raise taxes and bring manufacturing here, the tariffs need to be permanent. If the purpose is a negotiating tool, then it's going to be temporary. So the Fed, first of all, has to be concerned that the shock that's occurred could be offset pretty quickly by, if tariffs are a serious policy mistake, the most efficient way to address that problem is for the tariffs to be taken off. In the event that the tariffs are kept on and look more permanent, then you have an environment where both the unemployment rate is going to go up and the inflation rate's going to go up. The inflation rate is probably going to start showing in the next couple of months the effect of tariffs. It's a tax. It's going to go through relatively quickly. There's some goods that are probably already being repriced in reflection of the tariff changes. The unemployment rate effect is likely to be a little bit more slow moving. So given the uncertainty around what the policy actually is, and given the fact that the first impulse is likely to be on the inflation side, I think the Fed is going to be very reluctant to move very quickly. If it looks like we are actually going to go into a global recession where the unemployment rate in the United States goes up quite significantly, then that's a situation that the Fed obviously has to react to. But hopefully there are other off-ramps, including changes in fiscal policy regarding tariffs, that will avoid that. I think the last thing the Fed wants to do is perpetuate a view that inflation is going to be tolerated over 3%. I think it's quite likely that we're going to see a 0.5% increase in core PCE over the course of this year. And that puts us over 3%, puts us at 3.3%. Yeah. That's not an inflation rate consistent with the Fed's target. And I think it's going to make the Fed very reluctant to move quickly to address some of the concerns that are occurring in financial markets and are likely to be occurring in the unemployment rate over time.
Just quickly here, I'm wondering if you think then the Fed is destined to be late, and if they cut much more on the back end.
if the unemployment rate starts going up dramatically, it'll cut a lot in the end. That's a really bad outcome if it gets to that point. But I think they're going to move slowly, gradually, and reluctantly. And when they move, if it's because the global economy is going into a deep recession, I think it will have to then start moving quickly to bring interest rates down. Unfortunately, it's unlikely to immediately be able to offset the nature of the problem, which is bad tariffs. And one thing people are not talking about is developing countries are likely to be experiencing a financial crisis. Many of the poorest countries in the world are getting the highest tariffs from the United States. And that could exacerbate the international composition of what's going on.
That's the last thing we want to see this morning, that's for sure. Eric, appreciate you jumping on this morning. Thank you, sir. The Boston Fed president, the former Boston Fed president there, Eric Rosengren, breaking down the Federal Reserve decision. They are in a tough spot. We're going to hear from Chairman Powell later on this morning, 11:25 Eastern Time. Before we get there, we've got a payrolls report, 8:30, 34 minutes away. Up next, Nadia Lovell of UPS, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, and Mohammed Al-Aaron of Queen's College, Cambridge. The third hour of Bloomberg Surveillance is up next.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This isn't really going to start hurting until the middle of the year.
Tariffs will be a net negative across the board. It's undoubtable.
This really can't be a surprise. The reality of the surprise is a little bit more painful for everybody to digest.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households.
If the US is going to be in a waning economic environment, then it's most likely going to drag the rest of the world with it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, 30 minutes away from the payrolls report. Live from New York City this morning, the third hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P 500. The good news, we're off the lows. The bad news, we're still down 2.8% on the S&P. On the Nasdaq, we're down 3. On a Russell, we're down 4. Over in Europe, we are not spared. In Europe, we are down and down hard. The DAX is down 4. In Italy, we're down 6.5 as China pledges to retaliate with an extra 34% tariff on US goods, which would kick in a day after the US puts additional tariffs on them on April 9th. How's it showing up elsewhere? In the bond market, double-digit moves across the curve, down 11 basis points on twos to 356. The move was almost 20 basis points lower in the last hour, so we've trimmed some of that move too. We're down 11 on the US 10-year to 392. And the Tau is in the commodity market. Crude right now is down by 7 percentage points. WTI is down by 8, 61.60. This market is very concerned about growth, maybe not as concerned about inflation. Going into the payrolls report with estimates like 140 in our survey, how meaningless is this payrolls report when so many people on this program already this morning are saying this could be the last good one if the tariffs go on and stay on? And then this man right here has got to talk about it. Chairman Powell, 11:25 going into the weekend, gets the final word. What on earth does the Federal Reserve Chairman say about the position that this global economy is in?
Everyone agrees that he is in a pretty tenuous position. Maybe if the payrolls report is negative enough, he can talk about downside risks to growth and how they can potentially address that. But at a time when we still have not gotten inflation to 2%, and they are facing a dual mandate of both inflation and employment, a sticky employment market that really does hold up, at least in the near term, puts them in a bind. There is a key question right now. What is the off-ramp for this concern that we have in markets that this trade war could get out of control? And right now, people are having a hard time finding it.
Let's go back a few Wednesday. Chairman Powell's sitting in the news conference and he uses the T word. He looks at the forecast and a lot of people think they're implying essentially it's a one-off.
Place. But as a lot of economists have pointed out, it is a stagnant market where you have macroeconomic paralysis. That was Jim Zelter's comment yesterday from Apollo. How much can companies really have the conviction to massively hire people? They might be reluctant to fire people at this moment. That's not a healthy market for this Federal Reserve at a time where there is so much anxiety. At the same time, inflationary concerns picking up. The one-year measure of inflation swaps in the United States reaching the highest level yesterday, going back to 2022.
We're all hoping for negotiations. April 5th, tomorrow, we're set to see the baseline 10% tariff kick in. April 9th, we're looking for the additional tariff on top of that. So we're talking about 20% tariffs on the EU, 24 on Japan, 34 on China. And China basically saying this morning, if you do that, the day after, we'll go 34 too. How much negotiating can be completed in the next week is a big question for this market, with us down 3 percentage points on the S&P 500 at the moment. Coming up this hour, we'll catch up with Nadia Lovell of UBS as stocks look to recover from their worst day since 2020. Stephanie Roth of Wolf Research on why she's lowering her GDP forecast, and Mohammed Al-Erin of Queen's College, Cambridge, reacting to the payrolls report that drops at 8:30 Eastern Time. We begin this hour with stocks lower, following their steepest one-day slide in 5 years. Nadia Lovell of UBS writing, we now look for a period of much slower economic growth and extended market volatility. We reduce our year-end target to 5,800 from 6,400. Nadia joins us now for more. Nadia, good morning. Good to see you.
Morning.
This has been a week, hasn't it?
It has been a very volatile week.
What's changed for you then?
I think what's changed is that these tariffs have come in way higher than even our worst case scenario. I mean, we were sort of looking for the opening salvo to be in the low teens effective tariff rate. There are close to 25%. And we think that they could go even higher. Remember, retaliation is already happening. We're having that tit for tat. And then remember that the president has still said that there is Section 232 investigations that need to happen on semis, farmer, lumber, copper. So there's still potentially more tariffs to come. So reality is this now puts the economy in a situation where we are going to see much lower growth. And so we have to take down those estimates to reflect that. You know, we were looking for sort of trend line 2% growth this year. It's probably lower than that, lower than 1%, and we could even get down to 0% growth.
Do you consider this an adverse regime change or the start of negotiations to take us to a better place?
We hope that it is a start of a negotiation. So far, the administration seems to say that, but I think we're all debating what does the off-ramp look like and what does the administration really want, because we know that these tariffs were calculated in a pretty peculiar way, to say the least, in terms of as a percentage of the trade deficit. And so some of these nations, particularly these Asian nations, that has made the cost of living lower for us here in the United States and other wealthy countries, what can they really offer? And is it about investment in the U.S.? Because we had TSMC that upped their investment, $165 billion. We had SoftBank, earlier this year in terms of a Stargate, investments. And even last week, the additional capital raise in OpenAI. And so it's trying to figure out what can these countries offer the president to backtrack on. Those companies have already, promised concessions, and yet you have, Taiwan hit with 32%. You have Japan hit with 24%. So it remains to be seen what maybe the offense is the American consumer.
So are we getting close to a buying point? I mean, I say this because you have this goal of, you did downgrade your expectation to the target of 5,800, and you said that we think that S&P 500 levels of 5,000 to 5,250 could be an attractive entry point. We're getting pretty close today in futures. So how do you have conviction to buy, given everything you just said?
It's hard to have convictions buy. You might remember, Lisa, we talked about coming into this year having a tariff shock scenario of 5,100 on the S&P. It looks like we're going to be testing that. And so that could be a level where you start to look to maybe nibble. However, right now, our focus is really focusing on, income yielding equity structure products, because we think that that can give you some downside protection, but yet still offer you some upside participation. Because remember, all of this could change with one headline, for the better or the worse. And so you have to have some protection, and it's difficult to call the bottom right now.
Can it change with one headline? And this is what I want to examine, this understanding that can it all just be put back in the bottle? And to me, when you take a look at the sell-off this morning, how much is stemming from the tariffs and how much is stemming from the idea that this is going to potentially get out of control with a tit-for-tat type of trade war that is very difficult to end?
So, we heard the president say phenomenal deals, right? Could include like a TikTok. So we know that that's coming up. So if something that he might be willing to ease back on the tariffs concerning China, if you can get approval there. So that one headline could change it, in terms of if there's a deal and the president starts to step back and starts those real negotiations. As we know, the market is a forward-looking instrument. So if there's any inkling of that, there could be negotiations that meaningfully bring this down in the next couple of months. You will start to see the market recover recover from that. But if we're sort of in a stalemate, this is a huge impact to earnings. This is potentially recessionary if these tariffs remain in place over the next 3 to 6 months. We're talking about double-digit downside to earnings and also a recession that you could see this market get to 4,500.
What's the guide for earnings now? Down to Wednesday. JP Morgan next Friday. What do they come out and say?
Look, our internal conversation is that we think that this is a kitchen sink quarter in terms of forward guidance and potential for guidance to just totally be pulled. I mean, our consumer analyst was at JP Morgan Consumer Conference this week, and some of these companies have literally said they have thrown out their playbook as of Wednesday. And so it'll be interesting to see, but reality is who can speak with any conviction when there's so much uncertainty? So companies are more likely to pull.
How much things have changed? Start of the year, we're in Davos, Switzerland for the World Economic Forum. These bank executives are running around Davos, Switzerland, talking about how great things are, how powerful the story is in America. And to give them credit, there was good reason for that story. You had an administration coming into power that many people thought was going to be pro-growth, pro-risk, deregulation, tax cuts, sentiment was sky high. And now we're sitting here and saying that they're going to come out after first quarter earnings and pull guidance. That's how much things have changed in just 3 months?
I think that's how much things have changed in 2 days, Jonathan, right? Reality is coming into this. Most people thought that, the 10% potential effective tariff. And so we're in this situation where things could change day by day. And that's what makes it a challenge. And that's partly why you might remember we were quite bullish on financials, right? In one of the best performing sectors since last summer. We took that down to neutral because there is risk to the downside if we end up in a recession. That's hit to banks, and that will offset some of the potential positive that we could get, who knows, in the second half of the year around deregulation and potential for capital returns.
I'm smiling because everyone's saying this is going to be a kitchen sink quarter. So I'm expecting people to announce frauds, affairs with secretaries, et cetera, because ultimately no one will care. It'll sort of be the time. If you have a fraud or if you have, some kind of malfeasance, now is the time to report it because everyone will be sufficiently distracted. In a more serious note, does the jobs report matter in any way, shape, or form, given this backdrop?
If it's weak, absolutely, because that means the recession is probably, on its way, already started. If it's strong, who cares? Because the reality is Wednesday's announcement was a seismic shock to the market. It is yet to see the aftershock in the economy, the consumer confidence, corporate confidence, et cetera. And where we end up on that Richter scale will depend on the president and the administration, how much damage and how much gambling they're willing to do with the U.S. economy.
It's never a good time to reveal the affair with the secretary, is it?
Well, I actually think that right now, if someone has...
Not going there, Nadia, don't worry, I'm not going
You really want him to go there? But I'm just thinking...
There's something a little bit lighter this morning. Everything's so heavy and dramatic.
If they're going to really kitchen sink it, let's see what else they can come up with.
Maybe not that much. Neil Dutta of Renmac writes in, here's his latest note. Why does anyone think this is over soon? Goes on to say, if Wall Street stops panicking when policymakers begin to panic, then we should not hold our breath. President Trump cannot back off. If he did, he would look weak, and there is no coming back from it politically. And at the very end of the note, he says this, I am increasingly of the view that this ends when Congress reclaims its tariff authority, but maybe I am too pessimistic.
He might be too pessimistic, or he might be correct. Right now, the fact that there is that range of possibility gives you a sense of the range of options. To his point, Marco Rubio, U.S. Secretary of State, saying, as you mentioned earlier, that markets will adjust. No one seems particularly phased. And it is hard to see how President Trump backs down and says, okay, if you're going to put 34% tariffs on us, we'll come to a negotiating table. That isn't the tenor of these discussions.
Nadia, it's good to see you. Great to catch up. Nadia Lovell there of UBS going into payrolls later this morning. That report is 17 minutes away. Equities are lower by 3 percentage points. Up next, we'll get you some morning calls. Plus, we'll catch up with Robert Tipp of PGIM Fixed Income as we count you down to the payrolls report. And as Sarah House of Wells Fargo indicated earlier on this morning, that payrolls report may well be the last good one. From New York, this is Bloomberg.
brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
So we have had price target cuts on the S&P 500 so far this morning from UBS, again from RBC. Lori Cavacina comes down to 55.50 from 6,200. Bruce Kasman saying there will be blood if these inflation tariffs go on. Obliteration day is what Renmac calls it. Nil data brutal in the last 24 hours or so, and equities keep falling. On the S&P, we're down by 2.7%. On the Nasdaq, we're down by 2.9. On the Russell, we're down by close to 4. Let's get you some morning calls. Canaccord cutting its price target on Yeti to 35. The analyst citing tariff impacts and competitive threats in drinkware. Your second call from Truist lowering its price target on Wells Fargo to 84, looking for EPS cuts due to tariff impacts. And finally, Citi cutting Nordstrom to sell, citing unfavorable risk-reward due to the pending take-private deal by a Mexican department store chain. That's random. They've got bigger problems, I'm sure. Nordstrom right now is down by 2.6%. The whole sector's got bigger problems right now, that's for sure.
Yeah, that's the reason why a lot of these retailers lost about a quarter of their value, or a little bit less yesterday in one day, on the potential for supply chain. So maybe, you know, these deals will be refreshing to discuss.
As we count you down to the payrolls report, it's just moments away. Robert Tipper, PGIM, writing the following. In the wake of the tariff announcement, investors will anxiously await hard economic data. Central bankers, too, will be struggling to evaluate the expected impact of tariffs on growth and on inflation. Robert joins us now for more. Robert, welcome to the program, sir. That payrolls report's 13 minutes away. For you and the team this morning, what's your approach to that data point? How relevant is it?
Right. Well, I agree that downside, showing up in the numbers right now, in things that have occurred prior to April 2nd, will be very worrying. So far, that's been limited. There's been some hit to confidence. The Challenger layoffs yesterday surged, but those were government jobs. So it's so far so good. People are going to look through strong data like they did with ADP and other data this week. But they're going to be very sensitive to the downside, as are the policymakers, I think.
Well, let's talk about the policymakers, because Chairman Powell, as you know, speaks later on this morning. Are you expecting a repeat of what you heard in the Federal Reserve news conference only a few weeks ago, or is it time to offer something different?
I think that this could be a watershed event. I think that he signaled at that conference maybe that there was a crack between him and other policy makers on the committee there, that since then we've heard patience preached from others. I think he, signaled that he would be willing to take risk on inflation if need be in order to curtail downside risks to the economy. So I think this could be a moment analogous to kind of a mix of a 1987 or an Alan Greenspan 1998 Island of Prosperity speech, where he, talks about things look really good, but sometimes, you need to act. Confidence is important. He alluded to that at the last meeting, and this could be, an important time, given that we have had things come in worse than expected this week.
Robert, what's the risk that if Fed Chair Jay Powell does indicate that he is ready to proactively cut rates, that long-end yields go up, that actually creates a liability for longer-term inflation expectations?
I think that's a reasonable question and a reasonable expectation. I mean, this yield curve is really flat. And in order to justify, a 3.90 10-year, you have to think they're going to cut 150 basis points if this is going to be sustained. But I don't think that's their concern right here. I think their concern is confidence. And I think it's possible for him to preach the sound underpinnings of the economy, that imports are not a major aspect of the economy, that this is something that people will be able to get through, but he needs to be sure. And he needs to instill confidence in the economy, in the markets, in order to begin to throw a net, to let people know that they are there, that they have a dual mandate, and that they're prepared to look through the inflation, which he went so far as to say could be a transitory threat.
Robert, what's his incentive to do that, given the fact that this isn't a problem of their making and potentially they're solving? That the additional credit creation doesn't offset some of the uncertainty that you're seeing get injected into the financial system?
Yeah. I mean, I wasn't there, but this reminds me of 1929. Because in the middle of that huge decline of the stock market, about halfway down, that's when Smoot-Hawley was brought to the fore. And central bankers, are still looking back and regretting that there was not a more aggressive approach to heading off the Great Depression. So, Alan Greenspan in 1998 with that Island of Prosperity speech, the United States economy was doing great. Asia was in crisis, Russia was defaulting, and long-term capital management was freezing up, threatening the entire dealer community, and we're seeing some liquidity concerns in this market. There's a lot of arbitrage relationships in fixed income that hold together spreads, that keep mortgages issuable, and so on. And so I think he doesn't want to look back, 6, 12 months from now, whether things go great or whether they go terrible. Look back and say, we didn't do anything. I think he needs to show that they were willing to act. The whole economics community is up in arms about the tariffs being a destructive way to address this, rightly or wrongly, and the markets are very concerned. He needs to show that he's willing to step in, take some risk, to instill confidence that they will be there if they need to support this economy.
Robert, as you know, for you and the team, as a daily job, you've got to manage risk. No one can see into the future. I wonder how you've been managing that risk around fixed income and high-yield corporate credit at the moment after the spread widening we saw in yesterday's session. It's unusual. We don't typically see moves of 50 basis points plus in spread widening on high yield. That's what we saw in yesterday's session. What are you and the team doing?
Yeah, well, just to go right to the point of panic, and do you hit a panic button? I think this is a panic for cash, for people that are in cash, because this really opens up the prospects of cash yields dropping aggressively. I think it creates a panic for equity investors because they're clearly contingent on expectations for earning growth that may be, threatened by the rapid policy changes that are out there. But in fixed income, you're going to have some balance here between yield and spreads. So I think the Treasury equation, the yield equation has become less attractive. But the corporate market has a lot of sound underpinnings in terms of fundamentals. This is not 2008. This is not, WorldCom, Enron, thinly capitalized, high leverage situations, and a lot of high competition, spread out competitors and industries. There's been a lot of consolidation after COVID. There's been a lot of battening down the hatches from COVID through the war, through the hikes in interest rates. There are a lot of credits that are really well positioned to take this. So I think if you're seeing yields go up in a manner that offsets or more than offsets the decline in treasuries, this is a great spot for fixed income. So, do I think people need to be alert that this could go further? We could have a recession. That possibility is real. Yeah, but having growth drop from 2.5 to 0.5 or from 2.5 to 1.0 is not a nightmare for fixed income. I think after this initial panic phase, passes, think back to 2021. We're in the midst of an environment where nobody knew what was going to happen. There were huge flows into fixed income.
Yeah.
And that was very supportive of the credit markets. And there were a lot of credits that made it through COVID. So I think this is, something that may be very manageable for a lot of credits. There's going to be a lot of opportunity in this market. And for bonds, I think we're at a strategic buy point for the market as a whole in general.
Robert, just real quickly here, when was the last time you were this overweight corporate credit?
I can't remember the last time we were this low in our exposure to corporate credit. Spreads have been tight. We've been guardedly optimistic on the outlook for corporate credit. I think you are going to have positive excess returns, and I think that's especially the case from where we are now. So I don't think, this is something where we come into it and say, wow, we have way too much economic risk, and, what are we going to do? I think this is an opportunity in the credit markets to find things that are going to be underpriced, that are going to do very well over the next 1, 2, 5 years.
Robert Sipp of PGIM. Hey, Rob, good to catch up with you. As always, sir, thank you. On the outlook for corporate credit and fixed income right now, as we head towards the payrolls report, 5 minutes away. The estimate in our survey, 140K. The price action looks like this. Equity futures down by 2.9% on the S&P 500. Stocks getting hammered. Crude is lower and down hard, as this market focuses much more on the downside risk to growth than the upside risk to inflation, for the moment at least. And in the bond market, as we approach this jobs report, the 10-year yield is down by 14 basis points. The 2-year is down 17. We'll catch up with Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, and Mohammed Al-Arian. Jobs up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The payrolls report is 20 seconds away, and your scores look like this. Equity futures down across the board. On the S&P, we're down by 2.7. On the Nasdaq, we're down by 2.9. On the Russell, we're down by 3.7. And check out your bond market going into this report. Yields lower across the board, down 15 on twos. On a 10-year, down 14. A drop below 4%. A break earlier, below 350 rather, on twos. With your jobs report, it's a wow number. Here's Mike McKee. Good morning, Mike.
Oh, boy, John, do we have a wow number. 228,000 after revised lower 117,000 the month before. Ordinarily, you'd say that offsets a lot, but given the situation now, this is going to have some repercussions for the Fed. Unemployment rises to 4.2% from 4.1%. And we see average hourly earnings up as forecast 0.3%, but on a year-over-year basis, we're getting 3.8%. Forecast was for 4%, and that was what we saw in February. So there's got to be some sort of base effect in there. Average weekly hours do rise to 34.2 as forecast. That's 0.1% higher than they were in February. Change in private payrolls is 209,000, up from 140 the month before. The revisions total, I mentioned the revision earlier, total of a negative 48,000. So you can, cross-reference that to what we got today, but it's still a very strong report. And finally, the average underemployment rate, 7.9%, the U6. That drops a little bit. But this certainly creates a bit of a conundrum. If you're thinking about the Fed, it tells you that might be a little bit harder to cut rates than people anticipated.
Mike McKee, thank you. I'll come back to you in just a second. If I showed you a chart of the S&P or just a chart of a 2-year yield right now, you'd have no idea that jobs report just came out. Equities are still lower on the session by 2.7% on the S&P. And if you turn to the bond market, the 2-year yield is still down by 14 basis points. Still lower by 13 basis points on 10s. Lisa, it's a monster upside surprise on the headline print. But there is a take on Wall Street right now that this jobs report, albeit a good one at the headline level, might be the last good one.
Which is why they expect the Fed to actually speak to the weakness. We just spoke with Robert Tipp of PGIM Fixed Income about how this is a Fed who wants to be seen doing something ahead of the weakness. This is not weakness that we're seeing. I just wonder, are we at a place where good news is bad news? Whether this ties the hands of the Federal Reserve that much more in the near term, just based on the fact that it is a massive upside surprise with wage growth still there and with an underemployment rate, that with a labor force participation rate that actually went up, not down. It makes it difficult for them to respond to weakness that might come.
So, Mike, to get you back in, that takes us to 11:25 when we hear from Chairman Powell. At 11:25, this is the data he's got. And the hard data isn't bad. The soft data is terrible. Prospects for the future, not great. But the hard data is decent. It's still okay. What does he say at 11:25?
I think he sort of echoes what Vice Chairman Jefferson said yesterday, that we have to see the totality of the data and how all of this is playing into the economy. I suppose it's true, as some of the analysts have said to you this morning, that if Trump suddenly looks at the markets and says, okay, I'll take the tariffs off, then all the danger goes away. But for right now, they don't have a meeting until May 7th, so there isn't much for the Fed to do except sit and watch. Couple of notes here in terms of the jobs, John. 3,600 federal jobs lost outside of Postal Service, so really nothing. That's half of what we saw in February. The big number this time is in retail sales, up 23, almost 24,000, including 20,000 at grocery stores. That reflects the end of a grocery store strike in Colorado that had 20,000 workers off the payroll. So it's not an actual increase in workers. So maybe we take that out of that headline number and it looks a little bit more realistic, but it would still put you above 200,000.
Mike McKee, thank you, sir. We'll come back to Mike a little bit later this hour. So we've got the jobs report coming in like this. Big upside surprise, 228. The estimate was 140, so that's the headline number. If you look at equities, recovering only slightly, still lower by 2.4% on the S&P. And in the bond market, yields down, not as hard as they were. We're down about 10 basis points at the front end of the curve now to 358. The next stop for this market is 1125, around 1130. 6:30 Eastern Time, when you hear from Chairman Powell, who has to confront the very real risk of upside risk to inflation and downside risk to growth. Stephanie Roth of Wolfe Research is with us around the table for more. Stephanie, good morning.
Good morning.
The last good one?
For sure, the last good one, and then it's going to take a big plummet lower.
At the same time, you have to wonder how much people can take this and see this as giving any sense of where we are coming from. Does this report indicate that we are coming from a position of great strength that will take a long time to really weaken?
I don't think it matters where we're coming from, to be honest. These tariffs are so big, they are going to be very damaging to the consumer. And by the way, businesses have no idea how to invest in this environment. So you're going to see a sudden shock. I would look at this as a shock to the economy as opposed to something that's more domestically driven, in which case then those things tend to take a long time to work their way through the data. So the fact that today's data was strong doesn't really matter a whole lot in the context of everything else going on.
At the same time, does it give you a signal of how much room the Fed has to act proactively the way that Robert Tipp was talking about versus not really doing anything just simply because the hard data, the totality of data, is showing that strength?
Yeah, I think either way they're kind of in a position where they can't act unless the data were crumbling already, which hasn't been the case, so there was not a great reason to expect that would be the case for this print. They're going to have to wait until the data actually start to crack before they react. So they're in a really tough position. It's going to be really interesting to see how Powell spins this today. Because, yeah, he wanted to use the word transitory last time. I don't anticipate he's going to use that again. Base case is he'll probably, try to talk about how they're ready to act. Of course, financial conditions have tightened a lot since we last heard from him, or at least from an equity perspective. They're going to have to wait until they see a notable rise in the unemployment rate until they can actually start to ease, because inflation is going to tick up notably higher on the back of all these tariffs.
Market's desperate for a circuit breaker right now, Lisa, as you know. It's either coming from Chairman Powell later this morning, or the president could pretend that she called again. And maybe that makes a difference, I don't know, going into next week.
This is a market that's gotten accustomed to having a circuit breaker, and often it has come in the form of Fed Chair Jay Powell. One thing that we keep discussing this morning, and I think it is the right point, is that this is not the Fed's problem to fix, and it's not the problem that they can fix. So how can they get ahead of this when they're facing what essentially looks like a stagflationary shock?
Joining us now is Jeff Rosenberg of BlackRock to weigh in on this jobs number. Jeff, first of all, we've asked this question all morning. It's worth asking again. How relevant is this number to you and the team this morning?
It's not particularly relevant, Jonathan. It's one of those, very unique situations where the data looking backwards is probably the least impactful to the forward-looking outlook. And you said it a few minutes ago when you talked about the market reaction. It's a big upside surprise. We came into this backward-looking. Economy is in pretty good shape. Labor markets in particular are in good shape. None of that really matters to financial markets right now. Financial markets are incredible discounting machines, and they're discounting the future story, and that's really about this tariff story, not really about the labor market.
So, Jeff, as you know, sentiment is already rock bottom. We've seen that repeatedly in surveys, and hard data based on this is still holding up. So how much longer can it hold up?
Yeah, well, there's a split in the hard data versus the soft data. The soft data survey data is much more about looking forward, and the hard data, is going to be about people taking actions. And I think you're going to start to see that show up in the hard data. And most importantly, for our economy, as much as the focus is on manufacturing, this is a service and consumption-based economy, and the most important issue for consumption is real wages. And so when you take something away from today's report that is important, it's that wage picture, and the wage picture has been pretty good. It's been holding up. Now it's a little bit of a concern in terms of the support that has had for inflation and the likelihood that we get back down to 2%. We're kind of more likely to stall out here at 3%, but you've thrown an entirely different wrench into the mix when it comes to the near-term inflation story, which is of course the tariffs, and the impact that has in terms of growth. Away from the confidence shock, is that this is a real wage killer in terms of short-term impact on inflation, and so that's going to be the way in which we see the hard data react. And I think most importantly, the follow-through in terms of the survey data is going to be one on the business side and investment. This is very, uncertainty is very bad for investment. I think you're going to see that. You're going to see that in the IP data. And then I think on the consumption side, to add the second to the 1-2 punch here is the real wage impact from what hopefully is a transitory impact on inflation, as as Powell may, repeat. Maybe he doesn't repeat it later today. But in the interim, it doesn't feel transitory. It's just what people are feeling in terms of the impact on real wages, and that is a drag in terms of hard data into consumption. That's all kind of forward-looking, so it's not yet there in the hard data that is a little bit more reflective of where we were.
Jeff, sit tight. I want to bring in Mohammed Alaoun of Queen's College, Cambridge. Mohammed joins us now. Mohammed, you've had a few minutes to go over these numbers. Your initial reaction, and then we can get to the much, much bigger picture going forward from here.
So while I agree generally that this is not as relevant as it normally is as an employment report, I do focus on the 0.3% monthly earnings growth. When people rush to predict lots of Fed cuts, they forget the difference between what is necessary and what is necessary and sufficient. Weakness, pronounced weakness in the economy is necessary for the sorts of cuts that are being priced in, but they're not sufficient. The Fed needs some sort of air cover on inflation. And most forecasts of inflation, as Jeff said, are now going to the 3 to 3.5% at the PCE core level. So this is quite a move. The 0.3 monthly earning growth that we saw in today's report is not consistent with air cover on inflation. So this is a report that suggests to the Fed, wait and see. And my hope is that Chair Powell, later this morning, will do two things. He will walk back the notion that the tariffs' impact on inflation will be transitory, and let's eliminate that word again from his vocabulary. And the second thing I hope he walks back is the ease with which he dismissed the soft data. Because, as Stephanie said, expect the hard data to weaken in the months ahead.
Mohammed, are we dismissing the strength of this labor market report at our own peril? The idea that corporate America has thrived despite what the U.S. government has occasionally done, and that there is quite a bit of robustness and people who are employed and able to absorb a greater amount of price increases that might get passed along to them.
I think, Lisa, what this reminds you is that the structure of the economy is fine. And this is important because while there is general agreement on a very bumpy few months, there's significant disagreement on where this would lead to. There are those who think that the pain is worth the gain that's coming forward. It's just a matter of time, and the structure of the economy is strong enough to take us through this very bumpy journey. And there are others that worry that the structure of the economy is not as strong as we think it is. This number here gives you some confidence that the economy is fine if we can just avoid repeated self-inflicted wounds.
If you are just joining us, welcome to the program. Moments ago, a big upside surprise on the payrolls report, 228, the estimate 140. And we look at the charts. In the immediate aftermath of that jobs number, this market hardly blinked. Yields are still down 15 basis points at the front end of the curve, 352. And in the equity market at the moment, equity futures are lower by 2.8%. Mohammed was looking forward to Chairman Powell at 11:25, and Stephanie Roth, he talked about that word transitory, the T word. Does that get canned today?
I would imagine he won't use it again. I guess, of course, we'll see. But I think we'll have to be a little bit more cautious about this. And I think it's also important to think about the fact that transitory doesn't mean the same for every person, which is the problem. And the extent of the tariffs are so big that it might take a really long time for this inflation shock to work its way through the economy. So yes, it is.
The T word, as you know, speaks to the same mistake we all remember, which was waiting too long. That's the problem with the T word at the moment. Waiting too long to do something about inflation. This time around, I wonder, conditioned by their previous experience, do they wait too long to do something about growth and downside risk to growth? Because that's the major risk for this market.
Yeah, I think that's potentially the case, and they're going to have to wait and see. And by the way, they're going to be watching inflation expectations. They've anchored, especially the last time in 2018, they said inflation expectations were the main anchor to determine whether they can look through it or whether they have to act more hawkishly as a result. And if inflation expectations start to pick up, they're gonna be in a tough situation for a little while. They're gonna have to wait until things get really bad before they can act. And by the way, inflation expectations, long-term ones, are largely driven by your most recent experience with inflation. Well, in 2018, we had no inflation in the past prior years. This time it's very different. And inflation expectations are likely to pick up a lot more given experience with inflation and the fact that these tariffs are just so large.
Which raises the question, Jeff, and I would love your thoughts on this, how the bond market responds to either a dovish message from Fed Chair Jay Powell or a hawkish message. If he does put transitory back in the bottle, does that give you more confidence, frankly, to go into long-term bonds? Because eventually they might have to cut rates a whole lot more.
Yeah, it's really interesting if you look at the last 2 days and what has transpired in terms of the bond market. So yesterday, you saw a big rally in rates, but it was mostly led by the intermediate and short end. If you look at the 30-year portion of the curve, it lagged. For a brief moment in time, it barely budged at all. Contrast that to today. And today what you're seeing is a very different picture from the bond market. And probably the most striking is that you're seeing not only longer-term inflation expectations fall, but even some of the shorter-term inflation measures. And so Stephanie was just talking about it. It'll be challenging for the Fed because it depends on how you're measuring inflation expectations. Everybody's seen the Michigan survey. The survey measures will likely be going higher in an environment where people are seeing higher prices due to tariffs. Potentially that gets a little bit offset by what we're seeing in oil, but the impact in terms of survey responses may be to higher inflation. Meanwhile, in the bond market, they're really looking at the financial conditions tightening that's going on, seeing the implications for consumption. 70% of the economy is driven by that side, and that's quite negative, and starting to price in today much more of a deflationary environment. So you're seeing the back end of the curve fall, you're seeing break-evens fall, and you're even seeing short-end inflation measures, which have really been this story about stagflation. When you measure the stagflation, it's short measures. Inflation in the near term is expected to go up. Now some of that stuff is starting to get rolled over. So it's possible here the bond market may try to lead the Fed to this message of transitory by basically cutting the interest rates both in real and nominal terms for them.
I can tell you this market move's not leading the president to changing his mind. Just posted on Truth Social right now saying that my policies will never change. If you're looking for someone to blink this morning, it's not the president at the moment.
He says, to the many investors coming into the United States and investing massive amounts of money, my policies will never change. This is a great time to get rich, richer than ever before, which raises this question of how much the bond market and the stock market matter to him at a time where there is real concern on Wall Street that isn't being reflected in his commentary.
Jeff mentioned crude. Crude is down by 7.5% on WTI. Brent is down by close to 7 full percentage points. Mohammed, quite clearly, this is a shock to the cycle. Quite clearly, we're repricing growth lower. From your perspective, how much of a shock to the system is it, and how long does it take to internalize major regime changes like the one we might see?
So, John, we are repricing growth outlook in a significant manner. Interestingly, the beta for the rest of the world is catching up. It started out being a U.S. phenomenon. Now it's spreading. People are realizing that if the U.S. growth rate falls by X, it may fall then by more than X outside the U.S., and I think that is correct. The beta is greater than 1 outside the U.S. So it's a major revisiting of the growth outlook. How long? It depends on what other countries decide right now. The president's message will encourage other countries to retaliate. You see, there's a choice out there between retaliate, de-escalate, or just wait. And we all want de-escalation, but the escalation requires both sides to play along and for there to be an amount of trust that this is not a multi-round where you're going to have to renegotiate every time. If you de-escalate now, it will hold. That isn't there right now. So I suspect you will see more countries move towards what China did, which is a response that involves both tariffs and non-tariffs. And where that comes in for the bond market is we're now going to start talking not just about interest rate risk, but credit risk in the bond market. Credit risk has been, until very recently, really well protected, but now we're starting to see it come under pressure. And credit investors no longer have the shield of all-in yield because both components now are in play. So the next thing to look in the bond market, John, is going to be not just at government bonds, but look at credit, and in particular high yield, because that is significantly vulnerable right now.
Yeah, we saw yesterday the biggest spread widening going back to the heart of the pandemic in some of those riskier instruments. We caught up with you earlier this week, Mohammed, and you said that it's about a 50-50 chance, in your estimation, that we either have some sort of Reagan and Thatcher-esque reordering of the global trade system, or you go back to the 70s, you go back to Carter on steroids. Do you still think it's 50-50?
I do. What has changed, if you remember, I said my own perception is 50-50. The market is at 80-20. The market is absolutely convinced this is a Reagan-Thatcher moment. I think that 80 has come down in the last couple of days, and for good reasons. So yes, I'm still at a 50-50 because there is the upside of significant innovations in tech that are there, that are multi-year beneficial to productivity. So yes, I'm still 50-50. The market is repricing now closer to 50-50, which is, I think, that's the correct thing for the markets to do.
We can add to that. I think there's a lot of faith at the moment, based on the conversations we've had so far this morning, Lisa, that many people still don't believe these tariffs even go on, and if they do, it won't last long. We've got these two key dates now. April 5th is tomorrow, so that's the baseline 10% tariff. April 9th is when you hear the 20 on the EU, 24 on Japan, 34 on China, and the big numbers on everybody else. Everybody thinks that we can negotiate something in between. I think they're scared at the moment that we won't, but if you go through all the research on Wall Street right now, the base case is this won't happen. And I wonder where that faith comes from.
At a certain point, there was this belief heading into this year that the Fed put was there and that the Trump put was there. To imagine that an administration would allow an economy to tank or a market to tank seems infeasible, and I think that's what a lot of people are looking at. If you put on top of that this question of where is the off-ramp for the tit-for-tat retaliation, how do we start to estimate the damage from that? It becomes a fool's errand to try to model out. And I think a lot of people are just saying, look, we're just going to assume that's not going to happen.
Jeff, where does that faith come from in the market right now, that it's so bad it just won't happen?
I think, as you're pointing out, that faith, or as Mohammed was pointing out, I think that faith is being challenged day by day, and I think that's why you're seeing the market reactions. Yeah, so I think the only path forward is to observe what this administration and the policies that it chooses to implement are. It's very impossible to forecast, but the 80-20 to 50-50 I think is right, and you see it in these market reactions.
Stephanie, how do you model this?
So we've definitely tried to model this a number of different ways. Base case, we've done the fool's errand approach and tried to model from a global perspective. What happens if we apply all of the tariffs? What happens if everybody else retaliates in kind, and then you get some offsetting factors? The numbers are kind of comically bad. You're looking at something like a 2 to 3 percentage point headwind on GDP if this all really plays out. Again, we don't think it will play out to that extent. We think it will be pretty severe, which is why we took our growth estimates down for this year to 0.5% and recession odds up to 40%. Because these policies are bad, and it's hard for the administration to walk away from it unless something forces them to do so. And we're not there yet.
Stephanie Roth of Wolf Research, a special thanks, alongside Jeff Rosenberg of BlackRock. Mohammed, I just wanted to give you the final word before we go. What you'll be looking for going into the weekend, and as we reset, going into next week, what's the number one thing at the top of your list?
Number one is listen to the administration. I think there is a belief that you may have to break some things to remake the global order, but remaking the global order is the objective. And you have the very specific example of X, where you had to break things to remake it at the back of people's mind. But also listen to business. And I've been on the phone nonstop with business leaders, and they are not waiting, John. They see a hit on the cost side. They're worried about demand destruction on the revenue side. And they're starting to make difficult decisions about the balance between profit margin compression, higher prices, and cutting costs. And these discussions, believe me, are really active. Business is not going to wait, because they're going to try to rebuild resilience, because whatever people disagree on, I think most of us agree on this being a very uncertain environment.
Mohammed, appreciate your time, sir, as always. Mohammed Al-Erin there of Queen's College, Cambridge. That last point on what companies are going to do through the next few weeks, few months, that speaks to why so many people on Wall Street believe that jobs report from 24 minutes ago, the last good one. Because when you start to put pressure on margins, when companies have to start thinking about pulling the lever on costs, that's when the labor market comes into it.
And that's the reason why people are looking at indicators like what we saw yesterday from ISM Services, the employment component, as you mentioned, going into contraction, going into some of the lowest levels that we've seen on that index going back to late 2023, but also the most since 2020. It is a difficult scenario to try to model out at a time of a shock due to policy, given that the economy was strong heading into it.
And this was always going to be a long week, wasn't it? Do you want to do a special program Sunday?
Oh,
Going into the,
what are you doing? Seriously, this is what you're doing?
Just seeing if you're keen, seeing if you might be interested.
Depends.
If tariffs go on.
The truth is, no one's going to be working. No one's going to be resting. I mean, everyone is going to be working and focused on what happens over the weekend because this is a seismic shift. So sure, if I'm game, if you're game.
You know, at the start of the week, I said, if you wrote a book in 10 years about this week, would it get its own chapter? I think after the week we've had, if this policy is enacted, this will be the book. Build the library. This could be a major change for the global economy.
The entire book could be what actually went into creating that model that President Trump put out there.
That gets its own chapter.
That gets its own 5 chapters. I mean, exactly how it was modeled and the reaction in the market. Right now, it really remains to be seen where the off-ramp actually is.
Equities down 2.5%. At 9:15 Eastern Time, just a programming note, we'll catch up with the White House and get their reaction to the jobs report. We'll speak with the U.S. Labor Secretary, Lori Chavez de Rima, so look out for that. Then on Monday, here's your lineup. Chris Verona-Strategas, the former senior Trump trade advisor, Kellyanne Shaw, Liz Ann Saunders of Charles Schwab, and Michael Gaper of Morgan Stanley from New York City. Try and enjoy your weekend from New York City. This was Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world, and so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
I never
Do it for fun.
Ready? Go.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
The sell-off continues. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment, and Bloomberg Open Interest starts right now.
Coming up, Obliteration Day Part 2. Trump's tariff wrecking ball continues to hit every corner of the market. And a hot jobs report offers some relief to investors. Fed Chair Jay Powell takes the mic today. Plus, China retaliates with a 34% tariff on the U.S. even after President Trump said he's willing to cut a deal for TikTok. Katie?
Let's put it all together and take a look at how it's happening in markets right now. The S&P 500, which we're not looking at, but we should, because, boy, it is just an absolute wipeout. But we'll take a look at these stocks first. China-related stocks leading the drop, but I want to take a look at the futures, because the S&P 500 down by over 2% right now. Remember, the index fell 4.8% yesterday. That was its worst drop since 2020, which certainly tells you something. And that selling momentum continuing today, even in the wake of that jobs print. I also want to take a look at 10-year Treasury yields. We were starting yesterday closer to 4.10%, 4.1%. Now we are well below that 4% level, and that rally just continues to build, currently down about 9 basis points. And I want to take a look at the VIX as well. We reached 45 in the pre-market. A lot of volatility being expressed. Some of it is draining a little bit right now. We're back below 40, but still trading with a 37 handle, Matt Miller. And we were trading in the 30s, around 30 this time yesterday.
Yeah, I want to go back to the board you had up previously, because it strikes me, if you take a look at those stocks that you were looking at, the single stocks, they represent individual sectors that are all getting hit very hard. You had Nike up, right, which represents retail. You had energy firms up, like Occidental Petroleum. There we go. And you had banks represented by JP Morgan. All of those moving down 4 to 5% in the pre-market. As I said, banks are closely watching the labor market and its impact on interest rates. The U.S. added 228,000 jobs compared to 140,000 in the estimate. So blowing it away. That is a very hot print. Let's bring in Bloomberg's international economics and policy editor Michael McKee. Mike, is this the Biden economy?
Well, it could be a hangover from the Biden economy, yes, but I guess Donald Trump was president during February, so he can take the credit for it, although I'm not sure if he wants it right now, given the way his policies are going. But anyways, as you mentioned, 228,000, much stronger than anticipated. Now, 20,000 of that was the return of grocery store workers who were striking in Colorado, so not quite as impressive. And the February number revised down to 117,000. So major disappointment now for February compared to what we thought it was, 151,000. The unemployment rate goes to 4.2%, but all of that change, it's only 13 basis point change when you look out to 3 digits in the unemployment rate rounding issue. All of that was teenagers, so it may have been something around spring break. Men unchanged in terms of unemployment. Women go down 1/10. Average hourly earnings is interesting. Same as last month, 0.3% on a month-over-month basis, which was what was expected, but we do get a slight decline in terms of the year-over-year to 3.8%. And federal jobs, which is the number everybody wanted to know, they're only half of what they were last time in terms of jobs lost. 3,200. Add in postal workers, you get 4,000. They were 7,000 in the month of February. So the Doge effect has not taken effect yet. All this leaves the markets thinking we're still going to get 4 rate cuts by the end of the year. Earlier today, we were closer to 5, and now that's come down some. Let's see what happens as the day goes on.
So, Mike, heading into this report and in the aftermath, it seems like a lot of folks are calling this basically a sideshow. This isn't the focus right now, even though this is the most recent read that we have on the labor market, but it's all about tariffs. And we actually are going to hear from Fed Chair Jerome Powell in the 11 a.m. hour today. How candid do you think he will be?
I think he will be as candid as he always is. In other words, you're not going to walk away from his remarks this afternoon knowing anything more about what the Fed's going to do, because they're going to say they don't know what to do. Now, what you can take away from this report today is that the labor market is still solid in the way the Fed has put it. Unemployment, the slight rise to 4.2%, meaningless. So you're looking at a 4.1, 4.2% unemployment rate. You're looking at still reasonably steady wage gains, but they can say they came down year over year, so there's not a lot of inflation pressure there. Fed has two mandates, employment and inflation. And with these employment numbers, the Fed's going to be able to say we can focus on inflation for the moment, and let's see what happens because of the tariffs in terms of prices.
All right, Mike, looking forward to hearing from the horse himself. That is Bloomberg's Mike McKee. The Fed also, of course, watching tariff impact on inflation. You have countries like China and Canada retaliating against Trump's trade war. The big headline, though, is what we heard from China this morning. But let's take a listen to what the president had to say yesterday about negotiations.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
All right, Bloomberg trade czar Brendan Murray joins us now from London with the latest. So, of course, the message from the administration had been, don't retaliate, let's negotiate, but China clearly had its own plans.
Yeah, exactly. China wasted no time slapping the U.S. back with tariffs. And in addition, this could be an underhanded message to President Trump to say, yeah, we can hit you back too, but we should if you're up for talks, this is the time to do it, rather than further down the line when this thing escalates into a trade war that damages both economies. I'd point out that the tariffs are one thing, the 34% that China hit back with, but the export controls are also really crucial here. Those 7 rare earth minerals, without access to those, many American companies were going to have to shut down, and these go into things like precision medical equipment and car batteries, electric batteries. So that is one of the interesting elements here that could probably do more economic damage than the tariffs on U.S. exports to China themselves.
All right, Brendan, thanks very much. Brendan Murray there covers global trade for us out of London. This trade war continues to wreak havoc on markets, and Wall Street is sending real signals about the sell-off. Let's listen in.
I think some great opportunities, great buying opportunities are being created here in the market. I mean, the U.S. still stands out in the realm of technology and communication services. The Magnificent Seven are quite unique to the United States.
On the other hand, PIMCO's Bill Gross says investors shouldn't buy the dip, saying this is a market event similar to the end of the gold standard. Let's get a deeper understanding of this dichotomy with Bloomberg The Close host Romaine Bostick, who joins us on set.
Hey, Matt, you kind of have to look at this from two angles, from the fundamental angle and, of course, also from the technical angle. On the fundamental angle, Ed Yardeni makes a good point here. Forward PEs right now on the S&P 500, the lowest that we've seen in more than a year, at least going back to the start of 2024. But, of course, there's a reason why they've dropped to where they are. Are you going to buy into a fundamental economic story, a fundamental corporate story? Okay, maybe so. But then there's the technical side of the equation. Two numbers I want you to keep your eye on, Matt, 53.58 and 53.20. Those are basically the main support lines on the S&P 500. Futures, they've been below that all day long. Remember, at around 7:30, we hit 52.10 on S&P futures. Now, not only putting the S&P 500 on pace for one of its worst weeks going back to 2022, but quite frankly, putting it on pace for the first time to fall below every key support level for the first time since the onset of the pandemic in March and April of 2020.
And sort of a narrative that kept getting bandied about yesterday. We heard this from Mike Wilson, that you take a look at what's happening right now, this sell-off, Romaine, and it doesn't seem like there's panic yet, but maybe that narrative is changing a little bit this morning. Matt and I were looking at the VIX hitting 45 at one point. There's some nervousness working its way through the credit markets as well. What are you hearing from investors when it comes to whether or not there's actually fear in this market?
Everyone keeps calling this an orderly sell-off. Now, Most of those people said that prior to what we saw happen overnight with the spike in the VIX. One interesting thing that I think is, to your point, Katie, is money rotating around within the market? Remember, a lot of the sell-offs we saw earlier in this year, it was more people going out of the more heavy-weighted stuff into sort of the lighter-weighted stuff, and that brought down the broader indices. You look at what's happening in the pre-market. Are people rotating into utilities? Are people rotating into consumer staples? Are people rotating to some of those other defensive sectors like they did yesterday and the day before? Sadly, the answer is no. When you look at the consumer staple space, really Mondelez right now is the only stock in that space that is higher. Most of the other things that are getting bid, you're going to see that in the treasury space. You're going to see that in gold, and to a certain extent, foreign FX.
We saw a drop so serious yesterday that Bloomberg put a red box around the percentage decline. I mean, if you type WEI, you can see that really across the board. And if you look back, we have a chart 3387 in the library. If you look back at drops of 4.5% or more on the S&P, you only see them in COVID and during the great financial crisis.
Yeah, I mean, this is unprecedented. And we had a good debate. And it's not just academic, man. If you removed the COVID pandemic. So let's assume that was just a blip. Just assume that we're really talking about unprecedented moves in the market right now, that you would really have to go back to like the 1970s to see something like this. And what is the course correction? Is it monetary policy? Is it the White House and Trump just flipping the switch and saying, okay, you know, oops, my bad? I don't know. Most of the people we spoke to yesterday on the close, they seem to think we've kind of went past that Rubicon already. So even if there is a flip back, there's going to be such a lag to repair what has been done to this market that we could be seeing red on the screen like this for quite some time.
And Romaine, we have to be out of here by 9:12 or so, but you mentioned the defensives did well yesterday. I just want to bring out
running the show?
What worked. You know, we are, you are, Romaine. It was Lamb Weston, it was Philip Morris, French fries and cigarettes. There are still some spots that you can pick and choose in this market.
One of the best performing subsectors yesterday was managed healthcare stocks. And look, I mean, that's where people's minds are at right now. They're talking recession risk, and if you do believe we're headed towards a recession, you look for the things that people have to spend money on. In theory, healthcare and I guess French fries, at least if you're Matt Miller.
You still see, I mean, there are some winners in today's market.
Yeah.
Smucker's was one, Dr. Pepper was, anything that's basically addictive and horrible for you is going to be up today. Romaine Bostic, thanks very much. Really looking forward to the close today. This is one Friday where I will stay to the end of the market.
Thank you, bless you.
And
you are a national treasure.
No, because we've had flips, right? And yesterday I thought maybe we would see one again, but it just got worse into the close.
It got worse into the close, and like I said, a lot of key technical levels and fundamentals, like levels like Dardenne was talking about, maybe that does bring people back into the market. Stay tuned.
Yeah, we'll have to see. We've certainly seen plenty of volatility. When it comes to the Friday session, that is Romaine Bostic. Tune into him at 3 p.m. But Matt, it's interesting to take a look at this jobs report and think of the kind of non-reaction that we saw in futures to it.
Absolutely.
I mean, it's just, we haven't seen the full impact. Maybe you saw some Doge effects coming through, but the focus is really on tariffs and what the next several months, the next several quarters look like, not what happened in March.
I mean, the jobs report in itself, I thought if there's a big miss, right, it's going to be a big, huge problem for this market. And then our producer out of London, Dan Curtis, said, if we get a hot print, it's going to be a bloodbath, right? This is as hot a print as I could possibly imagine. 228 over expectations for 140. And we did have futures bounce back up a little bit, right? We were down more than 3% on S&P and NASDAQ futures before this report. So it remains to be seen how the market is going to read this jobs report. But I think, to your point specifically, it just doesn't matter. Right? They're looking straight through non-farm payrolls into the tariffs.
Yeah, so Dan Curtis, we have the receipts, but let's discuss this jobs report with someone who has decades of experience in the market. That is BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, it's great to have you with us. We speak to you every jobs report, and again, the narrative that's out there is that this one in particular is a little bit of a sideshow. So talk us through what fundamentally has changed for you since now and when we spoke to you about a month or two ago.
Thanks, guys. Thanks, Katie. I don't know, decades of experience. I don't know, that sounded daunting from an age perspective.
I wanted to make you sound like you have gravitas, Rick.
I understand. I appreciate that. Did we have a jobs report today? You know, it is. This is one of the. You know, this is one of those reports. Interesting, but I'm writing a piece where I said next month's report is going to be very interesting. Listen, I mean, you can't write it off. I mean, when you look at it, you've got a jobs market, particularly the service sector, that just continues to hum along. I focused on healthcare and education, leisure and hospitality, pretty solid. And so what does it mean? I think, you're also going through this extraordinary sentiment shift. And looking what the data is going to be over the coming months are going to be fascinating. But, today's report, I always look at it, there's some interesting trends within it, but we're going to quickly forget about it.
One of the things I saw in the jobs report, I don't know how much it means, but manufacturing jobs added 1,000. The expectation was for 0. Rick, you are, I think it's safe to say, pretty well connected in the corporate world.
Yeah.
How many CEOs are telling you, well, I'm just going to move production back to the U.S. now? Who's doing that?
It's a great question. So listen, I think every CEO is evaluating their business, and I think today, virtually everyone I talk to and others talk with are suggesting, let's understand the landscape. Let's figure out where we're going to be. And the truth is, you're not really going to know what the landscape looks like probably for another month or two. We've got to get what is the reaction function. Obviously, we heard from China. My guess is that's not the last discussion around China. So, today, I don't think I've ever seen in my career more of CEOs, CFOs, by the way, investors, and even some consumers say, I need to evaluate where we are. I think you will see, personally think you will see some manufacturers, some producers that'll say, gosh, the cost differential is significant. I will bring some of my operation back here. But I think the near term, people are sitting on their hands in epic proportion, and I think people want to see the news. See what the ultimate news is to make a tangible decision.
All right, Rick, we're going to keep you today through the opening bell. So Rick Reeder from BlackRock is going to stay with us. Coming up, Labor Secretary Lori Chavez DeRemer on the state of the jobs market. Is this the Trump economy now? This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Live from New York City for our audience worldwide on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro, and joining us now, I'm very pleased to say, is the U.S. Labor Secretary, Lori Chavez de Rima. Madam Secretary, welcome to the program, and first of all, congratulations on your confirmation. Secondly, the jobs report, a blowout jobs report, an upside surprise. There can be no debate about how solid this jobs report is this morning. Where there is debate on Wall Street, as I'm sure you know, is whether this will be the last solid jobs report for the remainder of 2025. There is a lot of worry about policy volatility. What gives you the faith, the hope that we will see more of the same?
Again for having me, and listen, this is a great day for America. This is a great day for the American worker, and this is a great day for President Trump. I can tell you this, I don't expect that this will be the last positive jobs report. We're going to be on the ground. We're going to be working together. We're going to be focused on the American worker. We blew it out of the water today, and again, as I said, this is a great day for America.
With stocks down 2.5% for Wall Street, they'll struggle to say the same thing. We heard from JP Morgan in the last 24 hours who said there will be blood. Neil Dutter, Renaissance Macro, another well-known strategist on Wall Street, said it's obliteration day, not liberation day. Where are we going to get the confidence to hire in America with sentiment so beaten up over the past month?
Well, again, I don't believe that that's a sentiment across America when you're talking to the workforce. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save, and I think you'll see those markets respond. Again, the president went around during the campaign, and he's keeping his promises to the American worker. He is the president of the American worker. We align on that. I'm going to be on the ground starting this weekend in Pennsylvania talking to the American worker. I want to know what they're doing, what they care about, and I will report and advise the president on the positivity there, and we're going to start to grow this economy as we build the workforce here in America, and we're going to see these numbers continue to rise.
We don't hear that same positivity. In a recent consumer sentiment survey, in fact, 2/3 expected unemployment to worsen through the remainder of the year, the highest reading going back to 2009. These are people who are anxious about their jobs, anxious about the labor market. You want to see a massive transformation. You want to see a huge shift, a reshoring of manufacturing. They're things a lot of people want to see. At the same time, we hear repeatedly that people are just sitting on their hands and waiting. Who's going to do the hiring?
Well, I can tell you this, the labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. That is going to be the key for the president. It's going to be the key for me as the Department of Labor to protect these American workers first and grow this economy. That's what we're seeing across the board. So yes, we will be hiring. We have to get out there and make sure that our workforce is skilled and trained. That's what I'll be focused on. You know, John, as a former mayor, as somebody on the ground, that matters most in all of these communities, where they are urban, suburban, or rural. And we want to make sure that we are supporting President Trump and his agenda, and that we're growing that workforce each and every day.
I think, Madam Secretary, a lot of people would have sympathy with the idea that a lot of manufacturing in America has been hollowed out over the past few decades because of globalization. They will certainly have sympathy with that. Where they will struggle is with the strategy for this week. When you see tariffs like 46% on Vietnam, when you see retailers get absolutely hammered, you can take a step back and just acknowledge that the weight differential between what you can earn in Vietnam and what you can earn in the United States is just too large, that those companies will have to accept the tariff, won't be able to move manufacturing back to the United States, and they'll have to do something about costs, which will damage the retailer on the ground on Main Street in America. It's the rollout of this strategy that people are really struggling with. Madam Secretary, how can you guarantee that these retailers won't just be laying people off and putting up prices? In what world are they going to move manufacturing from Vietnam and start making sneakers in the United States?
Well, I can tell you this. What we saw at the Rose Garden just 2 days ago was the president talking to the American worker. We saw who was in the audience. We saw the American worker there. supporting President Trump. That's who he campaigned to. That's who he believes in. That's who I believe in. These companies are going to repatriate. They are going to onshore back to the United States. We want fair trade agreements for our American businesses here as well. That's what the president does best. I can tell you this, he is a master negotiator, and he can teach a master class in that. And I can tell you the people who were in that audience were excited. They were cheering him on, and they are supportive of that. I will continue that effort. I will be on the ground across this country to make sure that the president knows what's happening on the ground, and we can continue to have positive growth for those business owners who are on the ground, because I do understand that they put their blood, sweat, and tears into the businesses that they have, and the American worker as well. We're going to protect all of them.
They put their blood, sweat, and tears into the ground as well. The American farmer's got to confront this headline this morning that China's announcing an extra 34% tariff on U.S. goods. What's your message to them?
Well, our farmers and ranchers and producers deserve our attention as well. I'll be working with the Ag Secretary along with President Trump to make sure that they have the necessary things that they need to make sure that we are competitive on the world stage. America is number one. It will continue to be number one, and I'll do everything I can to support those farmers and ranchers and producers with the American workers and the workforce that they need to get the job done.
So we've got some key dates. April 5th, baseline tariffs go in. April 9th, the bigger tariffs go on. The day after, China threatens to retaliate. You're the face of the administration today. Are there any negotiations taking place this weekend at a high level between China and the United States?
Well, I would imagine the president is on. Listen, President Trump works nonstop. That is why he built a formidable team like myself and the rest of the secretaries to do our job and support him. We will continue to do so. I would imagine that the president is continuing to have these conversations because he wants to protect the American worker and the American business. We're going to make America wealthy again. You heard him say it, and I'm going to help him do it.
I hope you're right. There are doubts on Wall Street this morning, and you and I will talk again in the future, I'm sure, for an update. Madam Secretary, thank you for your time. The Labour Secretary, Laurie Chavez de Rima. Madam Secretary, thank you.
All right, thanks to John Farrow as well. Let's get a quick check on futures right now after that jobs report, which really blew away the estimates. We are still looking at 3% down on NASDAQ futures. Russell 2000 futures off another 4% after a 20+% drop from the November highs. Less than 4 minutes until the opening bell. BlackRock's Rick Reeder is still with us. This is Open Interest.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but is producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are off 2.5% after yesterday seeing the biggest drop in the cash trade in 5 years. NASDAQ futures down 2.8%. Russell 2000 futures, after the index has gone into an official bear market, down 22% from its high, off another 4%. So there will be blood, as JP Morgan's Bruce Kasman said in his note today. You can see RBC Capital Markets ringing the bell at the New York Stock Exchange today, celebrating a 31st anniversary of some hockey charity or something. Microsoft down at the NASDAQ celebrating their 50th anniversary in a pretty scary reminder that I am older than Microsoft, Katie. So that doesn't matter today. All that matters is the sell-off we're seeing and in stocks and the buying that we're seeing in bonds.
Absolutely. Let's talk about the stocks first, because I want to take a look at the likes of Apple and Tesla, Alibaba, all linked to China. Remember, China added a 34% tariffs on all American imports starting on April 10th. That was announced earlier today. We just got a response from President Donald Trump on Truth Social posting that China played it wrong. They panicked. So not exactly a free-flowing negotiation just yet. You can see that those sell-offs that we saw materialize yesterday gaining steam today. Apple down 3%, Tesla not too far off, Alibaba down nearly 9%, Matt Miller.
All right, we are watching other sectors, including retailers. We see continued slide from Nike today after the company was decimated again yesterday, now down 4%. Energy also, as we see the underlying oil price absolutely crater, we see the energy producers drop as well. We're looking at NYMEX crude, by the way, under $62 a barrel right now, so Occidental is off. And then banks continue to fall. JP Morgan Chase is one here, but you can look really across the KBX and see that they're all down. JP Morgan off 6%, all deep in the red following that Chinese retaliation news. We're back with BlackRock's Rick Reeder. And Rick, let's dive into this trade war, which is kicking off. I guess the Trump administration put massive tariffs on China. China is striking back with massive tariffs on the U.S. How does this play out for our economy?
Listen, I mean, in the near term, and similar to what we talked about, there's a lot of discussion about recession. And, the way we define recession is interesting. You get a couple of quarters of negative growth. What I actually think is happening is you could have a downturn because of people sitting on their hands. That could be pretty intense over the short term. I don't think it's, quite frankly, I don't think the timing is at 2 quarters or 3 quarters or 1 quarter of softness. It's the intensity of how much do people sit on their hands for a while. So, listen, I think it's going to be, we're going to have a softer period. I think you have to build that into your asset allocation, how you run risk, because we're not going to know, at least for a few weeks, what the ultimate outcome is. When will corporate CEOs start to do more in CapEx, R&D, M&A? Well, my sense is it's going to take a few weeks for that to play out. But I think you have to build in any portfolio. There's going to be a soft patch.
All right, so you're saying a softer period, a soft patch. I want to go to a note that came out this morning from George Saravelos over at Deutsche Bank. He wrote that the market is doing one thing, pricing in a global recession. Rick, it sounds like you don't quite see that yet.
So no, I see some significant slowdown in the near term. Like I say, whatever we call it or whatever we term it, I think you got to manage your risk. I talked about it last week, a week before. I think you got to pull back on risks that you take within portfolios, and I think you're going to see some tangible slowdown in terms of what orders go through, how do companies think about their inventory development, how do they think about what cost of goods sold is going to be, what does it mean for margin? Do you have to start to make some inventory adjustments, CapEx, people adjustments? So, listen, I think your portfolio has to reflect that this is going to be a weak period, and the question of defining the durability of that. I'll say one thing that's very different when people think about spending. CapEx you put in place for 5 years, 10 years, sentiment can change amazingly quickly. And so we're in this period where sentiment now is going to be really tough. That can change, and so I think you got to think about, how do you position? What are the conditions that you'd operate in where sentiment? My sense is sentiment will change quite a bit. Whether that's a month from now, 2 months from now, or 6 months from now, is going to be the key for markets.
Well, Rick, is that what you're doing? Because if I take a look at BINC, of course, that's your ETF. I see a 9.5% allocation to investment-grade corporates. Then I see a nearly 38% allocation to high yield, which certainly we've seen some cracks start to form in the corporate credit market. Should we see some of those come down in coming days?
So I think if you study it, which you do, I think you'll see those having come down. But I will say one thing about the one thing about positioning around. The things you do a week before, 2 weeks before tend to be your best, how you manage a portfolio. Increasing some of your interest rate exposure, bringing down some of the lower quality parts of your portfolio is definitely what we've been doing. And by the way, if you think about single B high yield in the U.S., double B in Europe and the U.S., that credit condition should be okay. Managing that and putting some hedges around it, including some interest rate. If you look at performance of how a portfolio like this did versus the high yield market, it's why it holds up so well.
I look at all the enthusiasm that we had coming into this year, Rick, was about deregulation and tax cuts, right? And it doesn't seem like the M&A guys are seeing the kind of allowance that they were expecting. And then in terms of taxes, JP Morgan's Bruce Kasman says this tariff hit, a 22% all-around tariff on imported goods, represents the biggest tax hike the U.S. has seen since 1968. Even I wasn't born yet in 1968. That doesn't seem like it's great for animal spirits, especially when Republicans are also talking about actual tax increases.
Yeah, I was born before 68. So the one thing I will say. Listen, I think I said this last week. I think the dynamic of we've gone from animal spirits to animals in hibernation, and that's where I think we are. I think it is literally just hold off and wait and see what all these things that play through. I think companies are going to have to make significant adjustments. If you're a multinational, how you think about your supply chain, how you think about your distribution function, how you think about assembly. I think all those things are going to change, and that's why we're in this period that I think is to make decisions to add a lot of bait or think about risk today. I just think you got to be conservative. I think, I think you got to hunker down for a bit of time here.
I was in a Bloomberg chat with some private equity companies yesterday, and their portfolio companies are not going to be able to relocate production into the U.S. and are going to have to essentially double prices. That just isn't going to work for so many manufacturers out there. Do you expect these tariffs to somehow go away?
So, Matt, the thing we were going through today that is fascinating. So there is a transition. So, it's all about elasticities and the reaction function. And so we were trying to think about what is nominal GDP? If you slow down real growth, do prices stay exceedingly high because you've got these tariffs? And so your nominal GDP stays high because you've got higher prices and higher inflation. My sense is that doesn't capture the elasticity around it, meaning what will happen is companies will have to reduce prices. You're seeing that in some of the retailers, more promotion, more couponing. So I think what will happen is companies, the first reaction function, I'm going to pass through price. Maybe I don't pass through all of it. I'll absorb some in a margin. I'll try and pass through some. My sense will be you won't be able to pass through that much which will denigrate your ability to actually get that price, and you'll start to see prices come down. So I think what'll happen is you'll see volumes come off, and then you'll start to see prices will have to come down, or you just won't sell the volume, you just won't move the inventory you need to move. And listen, there will be some, there's no question, there will be some manufacturing that will relocate. It just takes time.
Right.
There'll be some distribution chains that will change, no question about it, depending on how people respond. And so, companies are going to try and keep that margin up. I'll throw out one thing that's hugely important. They're going to move faster towards productivity, automation. How do you make your business more efficient in a bunch of different ways? And that's the next trade that I think you got to put on.
And I do want to point out we're keeping a close eye on Apple, down about 2.5%, actually falling below that $3 trillion threshold on market cap. So these superlatives coming in quickly. I do want to end by talking about treasuries, because clearly there has been an enormous bid into the bond market, Rick Reeder, you know that well, but you have seen some notes out there, some worries starting to form that if this really continues, this trade war, and this deepens and escalates, whatever word you want to use, that you could see international buyers of treasuries step back even more than they already have. We know that China's holdings have been going down. We know that Japan's holdings have been going down. But do you think that that's a chip that's potentially on the table here?
So, tough one. So listen, I think that there's a series of timing things to all these things. We've talked about, we love the front end of the yield curve. You're pricing in a lot of cuts today. We've been taking some of our duration further out the yield curve for a variety of reasons, what it means for notionals, et cetera. But I still think, we talked about, we've added some interest rate exposure, been pretty significant. The front end now has got some, how do you think about the front end? How much can the Fed go if inflation is this high? But anyway, holding interest rate risk makes sense. The longer term paradigm is incredibly important. Part of why policy has to bring the debt down, part of why spending has to come down is exactly like you say. We've relied on international purchases of our treasuries for so long, and those countries, forget whatever retaliation is, those countries have to fund their own domestic. If your own domestic economy is going to slow, you've got to fund your own, you've got to issue debt in your own domicile. And that is a big deal. So yes, I think you have to be really sensitive to that. It's part of why we need to reduce spending in this country. We need to manage the debt stack in this country because it's too onerous.
All right, Rick, great having you on the program. Really appreciate you spending so much time with us. BlackRock's Rick Reeder, also the manager of BINC.
Yes,
an
yes.
ETF that Katie watches very closely.
Well, it's grown pretty mightily since its launching. But I do want to point out, I liked your question about animal spirits, because they've been nowhere to be found. Rick said that this is animals in a hibernation sort of mode. Do you know what animals hibernate?
Bears.
Bears.
Yes. Very good point. All right, so hopefully they can stay away, but we're not far off of bear market territory, right? We're down, what, 15% now on the S&P from
Somewhere
the high.
close to that, yeah.
Getting very close to bear market territory in the NASDAQ, and of course we've seen it on the Russell 2000. Coming up, we're going to talk about pharma, avoiding Trump tariffs, at least for now. We'll look at the sector and top calls next. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome back to Open Interest. You take a look at stocks 15 minutes after the bells ring. Losses deepening right now. The S&P 500 now down nearly 3.4%. We were already heading for the worst week since March 2020, and those losses just keep coming. We'll keep a close eye on that because you take a look across the indexes, the NASDAQ 100 down a similar amount, and the Russell 2000 really bearing the brunt of the sell-off. This index already in a bear market, and it's just getting worse. Now down about 4.5%, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, one of Wall Street's most bearish Tesla analysts is getting even more bearish. JP Morgan's Ryan Brinkman is cutting estimates for the EV maker's earnings, citing unprecedented brand damage thanks to the Elon Musk backlash. Next up, we have Citi downgrading Kraft Heinz to a sell ahead of its earnings. The analyst citing growth struggles and margin risk. And finally, car parts retailer Genuine Parts getting upgraded to a buy over at Evercore ISI thanks to its insulation from tariffs. The analyst says that earnings may move higher actually because of tariffs. The stock right now is unchanged. I also want to take a closer look at pharma stocks. That's after the industry survived any sector-specific tariffs in Wednesday's announcement. But President Trump yesterday told reporters that tariffs may be coming soon.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category. Then we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
Let's get some analysis now from Emily Field. She is head of European pharmaceutical research over at Barclays. Emily, it's great to speak with you again. And just set the scene for us. Any supply chain in any sector is going to be difficult to untangle from how globalized they actually are. But that feels especially dramatic when you think about the pharma industry.
Yeah, and I think what is just such a sweeping change for us looking at pharma on the investment side is just that, you know, as President Trump said, unprecedented territory. Pharma has been essentially immune from tariffs due to a WTO agreement from 1994. So it's just something that we have never even thought we'd ever have to consider. And now, obviously, it sounds like this is coming down the road. We're trying to do the analysis and have sought guidance from all of our companies. But, you know, we're still at very sort of high level thinking about the impacts as it's so difficult to quantify.
How hard is it? I mean, I know that we have some workers coming back to the Health and Human Services. Maybe the FDA doesn't lose nearly as much staff as we feared, but there's still going to be a slimmed down workforce. How hard does that make it for drug companies to get things through and to get new advancements out to the public that needs them?
Yeah, that is a super salient point. And to be honest, me personally, that's what I'm more concerned about impacting the space rather than tariffs. Pharma products are still going to get made. These companies have very, very high gross margins, so they can absorb some cost increases. However, this is totally unprecedented at FDA. High-level people at the organization that investors know about have left in the last week. Will this delay drug approvals? To be honest, we just do not know.
And I want to talk a little bit about specific companies. Novo Nordisk obviously is in your coverage universe. Novo having a really difficult start to the year, down 28%. And you think about Novo with its blockbuster obesity drugs, its biggest market is the US. I mean, when you think about the global impact of any specific sector tariffs here, I have to imagine that Novo could be in for more pain, Emily.
Yeah, and it certainly has been a painful period for Novo shares. And I think, it is getting sort of isolated as a potential tariff loser, if you will, given we know the supply chain because it's really centered on one drug. They make the raw semaglutide mostly in Denmark, although the filling and finishing is done elsewhere. And then, of course, Greenland, which is part of Denmark, seems to be in the headlines. However, what we're really looking for with Novo is, will obesity prescriptions start to rebound after the phenomenon of compounding, what Hims and Hers is doing in the U.S., is set to expire at the end of May? So that could be what we're all looking for as a potential turning point.
In your coverage universe, Emily, how much production is moving back to the U.S.? How many companies that you cover are saying, all right, in order to avoid tariffs, I'm going to bring all my drug production back to the United States of America?
Well, in terms of what we've seen from companies thus far, Johnson & Johnson, Eli Lilly, and Merck have, issued press releases saying, oh, we're doing this incremental capital investment in the United States. None of the ex-US companies have done that yet, although maybe that happens in the future. But the thing with pharma production is they're very, very long lead times to build facilities, and they're also highly regulated. So, you have to have some certainty on how long this tariff picture is going to play out. And then also, you're going to need FDA inspectors to inspect any new facilities that you're building. So in terms of where CapEx goes, that's still just another huge question mark.
And Emily, it's interesting how grim things feel in this industry right now relative to mid-January. I was out at the JP Morgan Healthcare Conference in San Francisco, and one of the big themes was we're going to see all of this M&A, we're going to see this merger activity, some consolidation in the space, all of those tailwinds that were kind of anticipated at the beginning of the Trump administration. It just feels like they've totally gone by the wayside.
Yeah, absolutely. And we were certainly expecting with the change at FTC, we know FTC had taken a pretty draconian view towards pharma consolidation under the Biden administration. All our large cap companies have very healthy balance sheets. We were expecting really significant M&A to pick up in 2025. But I think the uncertainty created not only with tariffs, but also with what's going on with healthcare policy under RFK Jr. at HHS, I think has led all these companies to just really sit tight and see what happens. We actually, given the policy overhang, downgraded pharma to neutral back in January, right after JP Morgan, as we thought this policy uncertainty would be a drag probably until about the summer.
All right. Emily, thanks so much for joining us. Emily Field there from Barclays talking to us about what to expect in the pharma industry. Let's get a quick check on stocks as the S&P, the NASDAQ, and the Russell 2000 continue to fall. We're looking at a 3% drop for the S&P right now, so not nearly as bad as what we saw yesterday, but it does look like if we stay at these levels, we'll close out the week down 6%. For the S&P 500. The Russell 2000 in an official bear market now, off about 25% from the high that it posted in November. This is Open Interest.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on in stocks. We are down really across the board. The S&P 500 is off more than 3%. So it is now off 15% from its peak at the end of February. The NASDAQ down 3% as well. The Russell 2000 has lost fully a quarter of its value, 25% from its recent high. In terms of the individual movers, NVIDIA down 4.33%. You know that's a big heavyweight drag on the indexes. Apple is now worth less than $3 trillion. We have losers in DuPont, in Alibaba, Tesla leading the automakers down, but Stellantis is not far behind it with 6% drops at these two automakers. It is not a bloodbath. We're not looking at panic, Katie, but at one point this morning it did feel like we were going to be.
Yeah, absolutely. I mean, you think about the VIX hitting 45 on an intraday basis. That's only the highest level since about this past summer. But if you take a look at closing bases, then you have to pull out to a 5-year chart. So maybe it's not panic yet, but some of the measures that we were told to watch, it's the VIX, it's credit spreads, they're starting to get a little bit hairy. So not panic yet, and it'll be interesting to hear from Jerome Powell himself in the 11 a.m. hour, though there's a lot of questions out there about whether Fed policy can really offset the economic hit that might be coming.
Yeah, we'll talk about that economic hit with Claudia Sahm. She joins us in the next hour. This is Open Interest.
Offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically. and think about the transportation system as one integrated system. An intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority bus terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Stocks are down about 2.5% across the board after China announced today it's slapping 34% retaliatory tariffs on all U.S. products. Economist Gus Fauché.
There was an earlier increase in tariffs on goods from China earlier in the administration, so it's not terribly surprising that China would make it more expensive for U.S. exporters to sell into China.
On Truth Social, President Trump says Beijing panicked, and he insists his policies will, quote, never change. Despite mass government firings, American employers added a better-than-expected 228,000 jobs last month. CBS News business analyst Jill Schlesinger.
Overall, this report feels kind of strange coming out in light of the tariff announcements, because this report indicates that the labor market is alive and well and continues to grow.
The new Health and Human Services Secretary, Robert F. Kennedy Jr., is suggesting around 10,000 job cuts DOJ made at his department were wrong.
Personnel that should not have been cut were cut, or reinstating them, and that was always the plan. And one of the things that President Trump has said is that if we make mistakes, we're going to admit it, and we're going to remedy it.
7 deaths are blamed on severe storms that have left tornado damage from Arkansas to Illinois. Heavy rain and flooding are the new fear. CBS meteorologist Kate Bilo.
Northeast Texas right up into parts of southern Illinois, areas that have been hit over and over again this week. All that rain, and here comes yet another round as we get into Saturday. More rainfall leading to historic generational flash flood threat.
Attorney General Pam Bondi joined officials in Broward County, Florida this morning to announce the arrests of alleged MS-13 gang members in a 2014 cold murder case. Sheriff Gregory Toney.
Here in Broward County, justice doesn't have an expiration date. It doesn't matter when you committed the crime. It doesn't matter what part of this world you are from. If you come here in this community and decide that you're going to take a life, we're going to unleash every single resources to bring you to justice.
Bondi says all 3 suspects are in the country illegally. A British comedian's been charged with rape and sexual assault.
She's not a random woman. She understands me. She laughs at my jokes. She's like you.
London's Metropolitan Police say its case against Russell Brand involves 4 different women in alleged incidents between 1999 and 2005. Brand denies the allegations. He is former husband of Katy Perry. The Dow's now down over 1,000 points, S&P off 153. The NASDAQ off almost 3%, 480. This is CBS News. The Senate's confirmed Mehmet Oz to head the Centers for Medicare and Medicaid Services.
The party line vote was 53-45 for the former heart surgeon and television star. As administrator of the CMS, Oz will manage health insurance programs for almost half the country as he oversees Medicare, Medicaid, and Affordable Care Act coverage. He made this pledge during his confirmation hearing last month.
I commit to doing whatever I can, working tirelessly to ensure that CMS provides Americans with access to superb care.
Oz has not said if he supports the Medicaid cuts Congress is debating. Michael Wallace, CBS News.
Beyonce and Jay-Z are celebrating 17 years since they exchanged wedding bands. To date, the fourth day of the fourth month, no coincidence. They like the number 4. She was born on September 4th, Jay-Z on December 4th. They have matching tattoos of the Roman number 4 on their ring fingers. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Busy day today. Stocks selling off yet again. The S&P off 3%. John Tucker will have an update in just a moment. Craig Trudell, Bloomberg Global Autos editor. He's going to join us on the effect of tariffs on the global auto industry. Mira Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management, will give us her thoughts on how to navigate this uncertainty and this volatility in the market. Then around 10:40, we're going to have a simulcast with Bloomberg Television. Howard Marks, Oaktree Capital Management co-chairman. He's going to be speaking with Bloomberg Television anchor Lisa Bronwynson. We'll bring that to you. So lots happening. We're going to have a lot of market guests and a lot of folks talking to us about the different angles that different industries are going to be hit by these tariffs. So we'll dig deep into a lot of key industries here. Market Drivers today is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow in your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Let's get a market update right now with Mr. John Tucker.
All right, guys, the Bloomberg Business Flash brought to you by IBKR. Will the U.S. Consumer Sentiment Index exceed 70 in April 2025? At IBKR forecast trader, the S was recently at 29%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is May 13th. As the market melts down, let's bring you golf news. Crossing the Bloomberg, this according to ESPN, the PGA Tour is rejecting the Saudi PIF revised offer to invest $1.5 billion. Risk tilted to the downside, more investment firms raising the recession probability. Taking a look at the NASDAQ 100, you graph it from peak to trough, today's being the trough, down 19%, over 19%. So that's flirting with bear market. Of course, China imposing a 34% tariff on U.S. goods in retaliation. Job growth exceeding forecasts for the month of March. Non-farm payrolls increasing 228,000 last month, but investors are shrugging that off for now. The Bloomberg Mag 7 index down close to 27% from its peak. Right now, among the movers in the S&P 500, the laggards in terms of index points, you have NVIDIA down 5.2%, Apple down 3.2%, Tesla down close to 7% right now. But the tariffs are a game changer for tech. That's according to Dan Ives at Wedbush Securities.
It changed the whole tech paradigm from a supply chain and from a growth perspective. And I think that right now is the scary thing. For the long term, of course, right, I continue to be bullish in terms of these. But look, this is a black swan event, what he single-handedly has done on a self-inflicted way.
The big event could be Fed Chair Powell set to speak later this morning, 11:25 Eastern. That's a speech in Virginia. Oil continues sinking right now. You have NYMEX crude down 8.2%, 61.47 a barrel. And Paul, as you noted earlier, Bloomberg BNEF points out the cost of production is right around $55 a barrel. Right, Alex?
Yep.
Oh, is this Paul knew that?
Well, Paul said it earlier, but I'll attribute to you. How about that?
There was the Dallas Fed latest survey said that break-evens are definitely around that area. I'm just taking a look right now. Hang on, it's important. About across all regions, anywhere between 61 to 70. So
there you
we
go.
are right
All right,
there.
we're there.
Yep.
S&P 500 down 3.3%. The Dow Jones Industrial Average down 1,125 points. The NASDAQ 100 down 610 points. That's a decline of 3.3%. The Russell 2000 down another 4.6%, firmly in a bear market. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
Happy Friday, guys. This was a week for the books. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. Honestly, you could just sit here for an hour and just do the soups.
Yep.
Like all the superlatives on a weekly and daily and two-day basis are so unreal. I'm getting calls, I'm getting emails, I'm getting texts from friends being like, oh my gosh, how bad is it? Like, it just gives you that perspective of what's sort of out there in the zeitgeist. Let's get a look at some stocks on the move today. We're joined now by Bloomberg's Lisa Mateo. Lisa, you're looking at Apple.
Yeah, we are, because it ended the day down about 9% yesterday, erased about $311 billion in market value, the worst single day decline since March 16th, 2020. So that was during the pandemic. This morning, shares have been down about 3%. We all know from the story yesterday, the supply chain relies heavily on China, right? New tariffs will reach 34% for China. But the thing is, it's not just China. Apple also relies on other nations that are affected by tariffs, including India, Vietnam, Malaysia, Thailand, Ireland. And then it's not just Apple, too. I mean, Dell Technologies, they sank 19% yesterday. Those shares have been down as much as 6% this morning. So it just goes to show you that it's still on the downfall.
Yeah, the SOX index, for example, talking about, say, semis in particular, on a weekly basis, it's fell the most since 2020, lowest levels in November 2023. I think that comparison is going to reign for a little bit. Also, let's look at Nike. Talk about a stock that got really hurt yesterday. Where are we today?
Yeah, most definitely. But what's wild about this is that during President Trump's first term, apparel footwear makers, right, they shifted their manufacturing out of China to avoid tariffs, and now they're being hit anyway because Trump is targeting the same nations that they decided to move to. So nations like Vietnam facing a tariff of 46%. So Nike, as we know, ended the day off down more than 14% yesterday. This morning, down as much as about 5%. And it wasn't just Nike. We had Adidas, Lululemon, too. What I found interesting, though, is that how much is produced here in the U.S. So analysts from Jefferies, they estimate that only 2.5% of the U.S. apparel market and 1% of the footwear market are made domestically. Vietnam actually exported $44 billion in textiles last year, with the U.S. as actually its largest market.
Wow, there's just no getting around those numbers.
No, there's not.
Okay.
No, like those are real solid numbers. And then let's wrap it up here with some of the automakers. They had already been getting hit, of course, to some extent. Then the tariffs went into effect yesterday. What about Stellantis?
Okay, so they closed down more than 9% yesterday. This morning, off as much as 5%, but they're also dealing with a few other things, kind of this trickle-down effect. So the news came out that about 6,000 workers in Canada's auto sector received temporary layoff notices. That's according to their largest union. The majority of them, they work at Stellantis plant in Ontario. That makes Chrysler Dodge vehicles. They're going to pause production for 2 weeks starting on Monday. Then on top of that, Stellantis received a downgrade by Fitch due to tariffs. And now what they're doing is they're trying to spark sales. So we heard a similar story from Ford, but the Wall Street Journal reporting that Stellantis, now they want to extend that employee discount program to other car buyers and on most of their new models. So we're talking about being effective today, and it's about the Jeep Wrangler SUV, the Ram light duty pickup trucks as well. So they might be getting those. They're trying to just get more people in, to buy the thing. So that's why they're giving out those employee discount programs to just everyday shoppers.
Right. It's so weird. It's like some weird deflation scenario before prices tick back up, or I guess the idea is companies are going to eat it.
Correct.
They're going to eat those prices. All right. Thanks so much, Lisa. Really appreciate it. For more conversations just like this one, listen to our new Stocks Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Let's stay with autos for just a moment. Craig Trudell is Bloomberg Global Autos editor and joins us now. Craig, at the same time, we also got the news that Tesla's estimates were cut further by an analyst on, quote, unprecedented brand damage. What's the conversation, the zeitgeist around that right now?
I think over here in Europe, it's particularly bleak when you look at some of the numbers. Just yesterday, we saw the full figures for Tesla in Germany in the first quarter. For them to have some months in the beginning of this year where they were down more than 70%, and that's in a country where they build vehicles, where you would think that they would perhaps have built up some goodwill on the basis of employing quite a lot of people outside of Berlin at their factory, and yet for Musk to sort of intervene in the federal election in February in a way that was highly unpopular, and for some of the protests that we've seen across the U.S. to also carry over here, where we've seen dealerships get paint tossed on them, cars set on fire. It's really intense, the backlash that we've seen against Musk.
So, Craig, I'm trying to get a sense how much of their sales weakness is due to some of that backlash against Elon Musk versus maybe some of the Model Y introduction and the change over there of lines. Do we have any sense as to what's, kind of the percentage between those two?
It's really difficult. I think we are going to be spending the next, probably months, maybe quarters, unpacking what exactly the dynamics are here, because, to your point, they did have a sort of, self-inflicted disruption that I should point out is not unusual in the auto industry. Even very experienced, car makers, when they go from one generation of vehicle to the next, they often need to do some retooling and take the factory, down a bit, work on the production lines. Tesla, in this case, had to do that at all of its factories around the world because they make the Model Y everywhere. And, so that was a substantial disruption for them in the first quarter that we shouldn't sort of lose sight of. I do think that, it can't be a coincidence that in a place like Germany, where you've seen Musk poll so poorly, and where he so asserted himself so emphatically, you look at those figures, and even as you've seen some weakness for Tesla in other parts of Europe, we haven't seen it be as drastic as we've seen it in Germany. So I think, to your question, I think there's absolutely a bit of both, and it's going to take us probably some months, maybe some quarters to sort out, just how much sort of lasting damage has been done here, and whether, they can lure buyers back with this fresh product.
I have to say, you look at, if you do Tesla equity in the DES, you get all the good information on Tesla right away. You look at a PE ratio, is still 112 times. You look at the PE ratio of NVIDIA, and it's 32 times, just meaning that it is still incredibly expensive when you look at it from that metric. Hey, Craig, really good perspective. Thank you so very much. Craig Trudell, Bloomberg Global Autos editor, joining us on the overall impact of tariffs, but really brand reputational damage when it comes to Tesla. Wow. Yeah. This is a week.
Yeah, market's just kind of setting some new intraday lows here to the S&P off about 3.7%, then the NASDAQ off 3.9% here. And we're also seeing yields come in dramatically. The 10-year Treasury yield now down to 3.91%
I
here.
also want to point out, did you guys see that the VIX almost hit 46?
Yes.
And
we called that out this morning.
You called that out?
Oh, yes.
And I bring that up, too, because when you have the funds, like the volatility-controlled funds or CTAs, they're trend following, right? They're forced to rebalance when the VIX moves. They have to sell equities and put it in cash. They don't have a choice. So I just feel like the churn is going to be sort of a self-fulfilling prophecy, and I wonder how that's going to sort of play out, particularly as you head into the close. All right, coming up, Mira Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management. It's her job to figure out what to do in this market, so we're going to ask her and Herman Chan at Bloomberg Intelligence on the sell-off in regional banks. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's get right to it. The Dow Jones Industrial Average down another 1,216 points. That's a 3% decline. The S&P 500 down 185 points. That's down 3.4%. The NASDAQ 100 down 616 points. That's a decline of 3.3%. The Russell 2000 of the smaller caps, the smaller size companies right now 5% lower, extending its slide into a bear market. Of course, the tariff worries overshadowing a relatively solid jobs report. And yet another salvo in the trade war, China retaliating against U.S. tariffs with commensurate tariffs on all American goods. They're also doing export controls on their rare earth materials. Markets fully pricing in 4 quarter-point rate reductions this year. And also the chance of a 5th from the Fed, with a quarter-point move by June also expected. You could say that's for all the wrong reasons. The Bloomberg Mag 7 Index down close to 27% from its peak. Worst performing stock in the S&P 500 right now, DuPont de Nemours down close to 15%. China's state administration says it's probing DuPont China over alleged breach of antitrust law. I haven't given any love to farm commodities. Soybean futures, they sank to their lowest since early January. Top global importer of soybeans, of course, is China. Parenthetically, Republican Chuck Grassley of farm state Iowa is helping introduce a bill to rein in the president's tariff powers. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right. Thank you so much, JT. Alex Steele here alongside Paul Sweeney. We made it to Friday, although there's still a few hours of trading left, and anything can happen as we are around the lows of the session for the S&P below 5,200. I have seen so many calls in the last 24 hours re-rating either GDP, inflation, recession scenarios, S&P target, earnings target. Let's talk to Mira Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management. Mira, have you changed anything in the last 48 hours in your calls?
What we didn't expect coming out of the April 2nd announcement was just how severe the reciprocal tariffs would be. Reciprocal implying that we'd probably charge what they charge us, which in many cases is roughly single digits. So to see an average effective tariff rate going forward of nearly 25%, the highest in over 100 years, does have us rethinking how are we looking at the economy going forward. And right now our economic models are pointing to roughly no growth over the course of 2025, but we have to think about where policy goes from here. Do these policies stick? Do things actually get worse when we think about sectoral tariffs on areas like copper, lumber, pharma products? Could we see retaliation from other countries, as we indeed already are from China, and therefore that further ups tariff rates? So there are still upside and downside risks. We clearly haven't seen the end of this tariff story, so we're still grappling with how do we think about growth and potentially higher inflation going forward.
Well, the markets are certainly repricing for an uncertain environment. Have they repriced enough? Is it a time to go out there and get a shopping list together, or still too early to call?
It's a bit early to call. Even a couple of weeks ago when we saw the 10% correction in the markets, I had 4 things I was looking at to see more market stabilization. One was a re-rating in valuations. We've seen some of that, but probably not all of that, especially when we think about the re-rating we need to see in earnings. Some downward revisions we would certainly expect to hear about over the next couple of weeks as earnings season kicks off. And so we probably will see more choppiness around some of those announcements as businesses today are thinking about how to cut back on CapEx and hiring to prepare for a potentially higher tariff environment if things do go through as planned. I would also say we're looking at the economic data. Now, the challenge is similar to the jobs report this morning. Any strong economic data we get over the next month, which reflects a pre-tariff environment, is probably going to be dismissed by the market. So it will be a period of time before we actually start to see things in the data. And the fourth thing was really around a consolidation of tariff announcements. We certainly had a big bang consolidation the other night, but again, we have yet to see the full extent of retaliation and if, in fact, that results in higher tariffs out of the U.S. And again, on sector, different markets and materials. And in the absence of that, we're still in a wait-and-see mode.
Yeah, and we just got that retaliation from China overnight, for example. I mean, the S&P is down 8.4% in 2 days. What provides the floor at this point?
We are going to hear from Chair Powell shortly. Hopefully we could get some more dovish commentary. But the challenge with relying on a Fed put is the fact that the Fed has to weigh slower growth, which would cause for them to cut rates, against potentially higher inflation from tariffs, potentially inflation expectations moving higher prior to any movement in the actual inflation numbers. So while we do expect cuts this year from the Fed, there is a limit to really how much they can do in the face of inflation that was already stubborn and could get somewhat more stubborn going forward.
How do you think about allocation stocks, bonds these days? What's changed, if anything, for you over the last couple of days?
Yeah, like what's safe at this point?
Exactly.
The solace we feel in markets here is actually, as of yesterday's market close, you did still have 5 out of the 11 sectors in the S&P 500 positive year to date. So defensives have been an area where people have sought shelter. Areas like healthcare, staples, utilities. Certainly areas like utilities are probably going to be fairly insulated from tariffs, but staples not so fast because of global supply chains, because of thinner margins. And what we actually have seen in slower economies is people do pull back on some of the goods that you would think they wouldn't. People actually do pull back on food and essential household items. So we do have to be a little bit more careful around staples. But value versus growth, we've seen value outperform growth year to date by double-digit percentage points. International versus U.S., we have not only seen international outperform the U.S. by about 13%, but moreover, in dollar terms, that has really helped as you've seen the dollar weaken. So some of these very unloved areas of the market have actually really protected this year. Duration has worked, although I will caution that per my comments about the Fed and inflation, there are still some two-side risks here to yields, but thus far, certainly having core bonds has protected.
How about gold?
Gold is interestingly faltering a little bit. It's already run a really long way. I think some degree of gold in portfolios has been a good hedge. And when I think about the supply and demand dynamics, typically we're not gold bugs because they're not providing a whole lot of income or an earnings stream, but you do see a lot of central bank buying. And in an environment where people are feeling a little bit less cautious about the U.S. as a whole as a safe haven, whether it's the dollar or treasuries in the longer term, then that does provide an alternative to structurally what has been, a pretty reliable bet when we think about the U.S. So gold actually does provide a little bit of policy diversification potentially.
All right, Mira, thank you so much. We appreciate that. Mira Pendit, Executive Director, Global Market Strategist for JP Morgan Asset Management, getting some thoughts on these markets. Again, the sell-off continues pretty hard out there. S&P 500's off just about 4%. NASDAQ off 4.25%. One of the things we want to do on this Bloomberg Intelligence program is talk to the analysts at Bloomberg Intelligence and talk to us about their sectors. Let's do that right now with Herman Chaney, follows the regional banks for Bloomberg Intelligence.
I was going to say, it's never good when you see him in studio because it always, something is going to be blowing up in regionals when we see Herman. Otherwise, when we ignore Herman, it's like, everything's fine.
Everything is good. So how do you view from the bank's perspective a world where it seems like we're in a trade war here?
Right. Well, banks are ultimately a reflection of their economies that they operate in. And when the economic expectations are in flux, then typically there's some pain for the banks, and that's where we are today. While all the bad news has been reflected in the stocks, the fundamental performance is still sort of shaking out. I would say that we're coming up on first quarter results in the next couple weeks, and so we'll get a better picture of guidance changes, performance going forward. But right now, we're still waiting to see where the shoe's going to drop in terms of loan growth, credit quality, et cetera.
And that's my question, because I understand the big banks getting hit in part because the capital markets are just going to freeze up. Like, forget IPOs, M&As, we're going to put that on the side. Okay, that kind of makes sense. But the regional banks may not have the same kind of exposure, right? In the real economy, the hard data is still fine.
Right.
So were you surprised at the extent to which your sector got hit?
Every time there's worries about the economy, these bank stocks sort of get hit first, and then investors ask questions later. So that's where we are today. Valuations have come down, and there's just a lot of worries about future credit quality, the guidance coming down, loan growth, fees coming down, top lines coming down. So there's going to be a lot of revisions going forward if these tariffs do really materialize.
So I guess one of the things we're hearing, and we've heard it, all years we were building up to this tariff date, and now it's just kind of reflected in the financial markets. It's just, I just don't feel like doing anything. If I'm a CEO, I don't want to buy a company.
Right, totally.
If I'm a consumer, I don't want to make that big expenditure for the washing machine or the car or whatever. And that means I probably don't need growth capital.
Right.
So if I'm a bank, I'm probably not writing too many loans these days.
Exactly. And that's actually been happening over the past few years, given the uncertainty with interest rates first and then regulation under the Biden administration. There was just a lot of demand that was just on the sidelines, and you've seen that reflected in loan growth for the industry. It really hasn't moved a lot over the past couple of years, and the expectations heading into this year was that Donald Trump and the administration was really going to unleash more activity from a deregulation, but now the trade spat and just the chaos that's happening over the past couple of days, everything's really continues to be on the sidelines.
Something in any kind of like regional M&A that we've all been expecting for the last couple of years, that's not going to happen.
Banks, right?
Right, exactly. There has been some news that the Discover Capital One deal could be pushed through with the DOJ giving the green light to that. So now we're waiting on the Fed and other bank regulators to weigh in. So that could be a good litmus test going forward, but still, there's a lot of uncertainty involved.
When you see an economy slow down like it appears the U.S. economy is doing, where's the first place you see it from a regional bank? Is it credit quality? Is it slowing loan growth? Where do you see it first?
Yeah, well, it's going to be slowing loan growth, and it's going to be sort of the delinquencies, right? So these 30-day past due metrics, 90-day past due metrics, so those will start trickling in. And then there's other early warning signs for credit quality that the banks talk about. There's some, in bank parlance, it's called criticized loans. So loans that may not be past due yet, but the bank knows that there's some problems with the borrower or the project, so they'll flag it as a potential problem. So those are sort of the metrics that we look out for every reporting season.
Which banks in your coverage are pretty well set up to manage this kind of environment right now?
Yeah, I think the market is telling you something. We just put up something on MRR looking at the 5-day performance of the KBW index, and it shows the trust banks like Bank of New York Mellon, Northern Trust holding up fairly well. M&T and PNC are the ones in my regional bank coverage that are holding up fairly well. And then there are others, smaller regionals that are faring worse.
Hey, can I just bring some breaking news to you?
Yeah, please.
Yeah.
The NASDAQ 100 just entered a bear market, down 20% from its peak. I know it's just numbers, but
no, I mean, a bear market, we haven't talked about a bear market in quite some time.
But they're numbers, but they're also headlines.
Yeah.
That's that's part of it too.
It's people's IRAs and their 401ks.
I'm not looking at that. Who's looking at that? Any of you guys look at that?
No, I'm not looking at that.
I'm not
it's
looking.
now called the 101K.
I'm not looking for 20 more years. Just gonna sit there, and that's the story. Okay, and then before we let you go, real quick, Herman, what is like sort of the type of bank that's going to struggle the most?
Yeah, it's going to be the banks that have still been dinged during the prior regional bank crisis. Probably they'll be in the headlines still. So yeah, banks that have sort of weathered it, but there's always that recent history that all investors point back to. So banks like Western Alliance and others that were sort of teetering during that time probably get pushed a bit more by investors, but we think that their balance sheet and the deposits are really strong going forward.
All right, Herman, thanks a lot. Really appreciate it. Herman Chan joining us in studio. Always good to get your perspective. Bloomberg Intelligence Senior Analyst for U.S. regional banks. All right, here we go, right? As John Tucker just said, NASDAQ 100 sent to enter a bear market, falling 20% from its recent peak. You're now looking at the declines about 4% for the S&P and the NASDAQ 100 just on this day alone. John Tucker here with the Bloomberg Business Flash. Give us some more updates here.
Yeah, right now, 20.1% below its peak. The peak, of course, that was reached on the only February 19th of this year at 22,175. Right now, the NASDAQ 100 in today's session down 4.4%. This is an 805 point drop. Dow Jones Industrial Average down another 1,482 points. This is a 3.7% drop. The S&P 500 down 230 points. That is down 4.25%. And if you're keeping score at home, the S&P 500, the broader index, down over 15% from its peak, so well into correction at least. The Russell 2000 is certainly the worst performing of the major indexes. Remember, this is the small, medium enterprise stocks that are publicly traded. That is down 5.9% in today's trading, and that is well into a bear market for that index. Today's jobs report for last month, pretty solid, but moving forward, tariffs will impact the jobs market, according to Veronica Clark. She's at Citigroup.
Businesses are not going to be hiring right now. Of course, you're gonna hold back on adding any extra costs if labor costs would add to tariff costs. So I think the first response is to pull back on hiring. But eventually, if your tariff-related input costs are going up, you might start to see layoffs.
All right, the laggards in the SPX, NVIDIA down 7%, Apple down another 4%, Tesla down another 9.5%. Investors looking for a Fed put. They're going to hear from Fed Chair Jerome Powell, 11:25 Wall Street time. I think they might be disappointed if they're looking for that. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, John Tucker. I mean, right, that's really the question, like what provides the floor here, and does it really come from the Fed, or does it need to come from the White House? So S&P is down by about 4 percentage points. Just saying, for the New York Stock Exchange, as we should all know, there are 3 circuit breakers. One's at 7%, one's at 13%, one's at 15%. When you get to 7 and when you get to 13, you're going to be shutting down for a minimum of 15 minutes. We are clearly nowhere near that yet, but I think it's worth putting out there with the velocity that we're seeing, particularly that it's a Friday. And a lot can happen in the next couple of hours and the next couple of days. I guess my question is for Jay Powell, since he can't say anything, like what is going to be the clue? Like if they say, sure, we'll support the economy, sure, we'll do an emergency cut if we need to, like is that going to be enough?
Did you see volumes, by the way?
It's crazy.
100%?
Insane.
S&P 500?
They're like well above average for the 10-day average for this.
Potential good sign from that piece of data is when you get big selling with big volume, and today is huge volume, maybe it's a little capitulation.
Right, exactly. Only 41 stocks in the S&P are positive. The rest are all declining. So if you get more intraday stock volatility and they're all moving together, then we get a macro event, then maybe we get the washout. So, but hoping for that's weird. It feels weird to say that, but like maybe that's a floor. Maybe that's a floor that we can start looking at.
All right, well, we'll see. I mean, again, we'll see some more data coming out next week, economic data.
We do? What do we have next week?
Well, just there's always stuff coming. I mean, yeah, there's always stuff.
There's always things. I can't get past today. I don't know what next week is at all. Jobs, remember jobs were today too. Speaking of, we have a great conversation lined up for you. Lisa Bromwitz, Bloomberg television anchor for Bloomberg Surveillance, is sitting down with Howard Marks, Oaktree Capital Management co-chairman. He's been in this market for a very long time. He had a lot of experience. Get his take on the sell-off.
Thank you so much to our Bloomberg radio and TV audience. We are incredibly lucky right now to get a chance with a man on the 30th anniversary of the firm he co-founded, Oaktree Capital Management, which has since grown into the world's biggest distressed debt investor. Mark's joined us on a day of turmoil after putting out a memo about a month ago where he wrote, "The bottom line is that credit presently offers a better deal than equities. Even at today's spreads, credit isn't a giveaway today, but it offers a healthy absolute returns and is fairly priced." Howard joins us right now. Howard, you wrote that a month ago. The world has changed. We have seen the market sell off. We have seen tariffs implemented that are the highest levels that we've seen going back 100 years. Does your thesis still hold?
The yields on credit are still very healthy, and in fact, credit yields a little more now than it did 6 weeks ago when I wrote that memo. Then high-yield bonds, for example, were yielding around 7.2. Today, they're close to 8, which means they went down in price, producing a higher prospective return. Of course, the stock market is well down since then. I don't know, 15, 16, 17%. I haven't done the math yet, and it keeps moving. But, you know, obviously the the state of the world, which equity prices depend on, is completely in flux and has been radically changed. Most investors think for the worse. That's why prices are down. The question, of course, is whether they're down too much, just right, or not enough. And almost nobody can say.
How do you start to even measure something like a potential paradigm shift, like the tariffs that were announced earlier this week?
Well, first of all, of course, measure is the wrong word because that suggests some quantification, which is impossible. There's nothing to measure. But how do you gauge? How do you think about the changes? And, you know, this is the biggest change in the environment that I've seen probably in my career. You know, we've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States. I believe that the last 80 years since World War II have been the best economic period in the history of mankind, and one of the major reasons was the growth of trade. And I think that we have truly had a rising tide that lifted all boats, and trade was a big part of that. And everybody in the audience should understand the role of trade. Every country, for example, does some things better and worse. And worldwide welfare is maximized when every country does the things it does best and cheapest, and then sells them to the countries that need them, which do other things and sell them to other people. That's how trade works. And, well, I don't know if it's politically correct, but the good news is that the Italians make the pasta and the Swiss make the watches. But if we stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably be, well, maybe arguably people in both countries will be a little worse off. That's what we're talking about here. And we should not underestimate the benefits that we've gotten from globalization. And among other things, there was a 25-year period, which I cited in one of my memos 10 years ago, in which the cost of durables in the U.S. went down by 40% in inflation-adjusted terms. That kept a lid on inflation here. It made goods available cheaply to all Americans. If we don't have world trade, we don't have that benefit. And, you know, the tariffs are designed to encourage production at home, but who could imagine that that most things produced in the United States will be as cheap as they are coming from abroad? In other words, things will cost more.
If that's the case, does that mean that you see the inflationary regime as being something that is more persistent, or a reversal of what we saw, the disinflation of the globalization?
Well, I think so. There were financial benefits from globalization, including keeping a lid on inflation. And, you know, if we hadn't bought our TV sets and appliances from abroad in that 25-year period at declining prices, what would inflation have been? And the answer is considerably more. Maybe not 2, but maybe 3, 4, 5. And so, tariffs are an increased cost. Somebody has to pay them. And, most people think the consumer will pay them. There's some possibility that the importer or the exporter will pay them, or the government of the exporting country. But it's an increased cost, the proceeds from which will go to the government. And, will society be better off as a result?
When you're measuring how to decide the risk and reward of given asset classes in this type of environment that could go in a multitude of different ways, how do you understand where there's value, what a return is that would justify a risk at a time when, potentially you could get 7%, 8%, 9% with credit, with stocks that have delivered more than 10% for the past number of decades. But going forward?
I want to respond first to your last sentence. Stocks have delivered an average of 10% a year for the last 100 years, but not when the PE ratio was 19. And the PE ratio today is probably 19. The average return has been 16. So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is, if you look at history, if you bought the S&P when the PE ratio was 19, historically you probably made, let's say, 1 to 6% a year, or 2 to 7% a year, something like that, but certainly not 10. And so, you know, what you pay matters, and the price of the S&P is elevated relative to historic levels, so you shouldn't expect historic returns.
Whereas in credit, one of your arguments is you can expect to get that return because the default risk isn't as great as some of the excess spreads and what you're getting in all-in yields.
Well, you know, with credit is a newfangled word for fixed income, or which was a newfangled word for bonds. In 1978, I was moved at Citibank from the equities department to the bond department. Nobody talked about fixed income or credit. But with debt, or bonds, or fixed income, or credit, what you see is what you get. You can read on the piece of paper what the promised return is, and then the only thing you have to wonder about is, will I get it? That is to say, will the issuer default, or will they keep their promises? And by the way, they promised you interest, they promised you to pay your money back at the end, and if they don't keep the promise, they lose the company. So they have a lot of incentives to pay. I've been in non-investment grade credit for 47 years, and in our experience, roughly 99% of our issuers have paid as promised.
You've thrived during your 5-decade career, almost 5-decade career, during times of dislocation. Is this a time of dislocation to play or not to?
Well, it's a time of dislocation. Everybody has to judge for themselves whether the reduction in asset prices so far is right, inadequate, or excessive. If it's excessive, you should jump in with both feet. If it's inadequate, you should wait until things adjust further. And it's impossible to make that judgment qualitatively. You used the word measure before. I pushed back a little bit. There's no place you can look. There's no analysis you can do to determine whether today's asset prices are right for the environment ahead. Now, there never is. It's always conjecture. It's always guesswork. That's, in theory, why the greatest investors are great, because they make those judgments better than most people. It's excessively hard today because today we have no idea what the future is going to be. Normally, we think we know what's going to happen in the future. We normally assume the future will look mostly like the past. We extrapolate, and usually it works because the world doesn't change that much. But the world economy and the world order beyond economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days, and nobody knows what it's going to look like. Nobody knows. I dare say, if you tell me that what our rules will be 6 months from now, I'll bet you're wrong. This is in flux. And if you think it's in flux, then by definition, you don't know what the future holds. And then even if you know what our country's going to do, and it's going to be that way 6 months from now, we don't know what other countries are going to do, what the ramifications will be. And so, you know, I always inveigh against forecasting. I don't believe in macro forecasting, my own or other people's. And we know much less today than usual. Now, people who like to run their lives according to forecasts, they say, well, this is going to happen in the future, so I'm going to do this, and this is going to happen in the future, so I'm going to do that. What you really need, if you like to work with forecasts, is you need two things. not just a forecast. You need the forecast, but you need an estimate of the probability that your forecast is correct. And today, whatever your forecast may be, you have to say, the probability that I'm right is lower than ever, because the probability that we know what the future is going to look like is lower than ever. And that's how I feel.
Is this a time to be fearful or greedy?
You know, what you have to say, Bloomberg's offices, you have to think in terms of your neighbor. The department store.
Bloomingdale's.
Bloomingdale's. Bloomingdale's just put everything on sale. Prices have come down for the S&P, 8% in the last 2 days, and much more in the last 6 weeks. It's on sale. That should encourage people to think about buying. Will they go down further? Nobody knows. Are the prices fair? Nobody knows. But everybody runs from the market when prices go down because they think it connotes risk. It's just stuff going on sale. And, of course, it takes, well, I was going to say a pro, but it takes a prescient pro, of which there aren't many, to know whether, as I keep saying, the discounts are adequate or appropriate. But certainly you have to look, and it doesn't make any sense to say, just a minute, I did XYZ when the price was 100. Today the price is 90, so I'm going to boycott it. That doesn't make any sense on its face. You have to take a hard look.
Do you still think that the U.S. is the best place to invest?
I think it's probably still the best place, but it's less best than it used to be, because I think that, you know, if you think about the things that made it the best place, one of them was the rule of law. That may be less the fact today. One of them was the predictability of outcomes. That may be less today. One of them was the worst thing about investing in the United States for many years has been our fiscal situation, our deficits and debts. And the U.S. has behaved like somebody who has a golden credit card where there's no credit limit and the bill never comes. So, of course, you can spend more than you make. And if somebody has a golden credit card, well, what would you do? Well, you might buy a nice car, but what the hell? You might as well buy all the cars because the bill's not going to come. And that's the way we've behaved. And that's the way Washington has spent money. But can the events of the recent days change that? Can they cause there to be a credit limit? Can they cause a bill to be presented at some point in time? And if the answer to either or both of those questions is yes, that's a real risk. If people don't like the dollar, don't like investing in the United States, don't want to hold an unlimited number of treasuries, if we just make people mad and say the U.S. is still a great credit, but I don't want to hold their debts because look how they're treating me, the fiscal situation will be very complicated.
Howard Marks, we have to leave it there. That was Oaktree Capital co-chairman Howard Marks. Thank you so much. Back to you.
All right, that was Bloomberg Television's anchor Lisa Abramowitz speaking with Howard Marks, Oaktree Capital Management co-chairman here, talking about the markets, the dislocation in the markets. And again, the S&P is down 4.3%. The NASDAQ off 4.8%. We'll stay on top of these markets. What we've been trying to do is kind of go industry by industry and see what potential impact could be on a world where there are much higher tariffs in most of the world. One of the areas we want to look at now is the media business. It is a global business, and for that we go to Geetha Ranganathan. She covers the media industry for Bloomberg Intelligence. Geetha, I mean, I guess, where do you see some of the risks to some of these big media companies, to their business, in a world that appears to be going through some type of trade dislocation, to say the least?
Yeah, sure, Paul. So I think in general, what we're seeing is, of course, a lot of these media companies are heavily exposed to advertising, television advertising, and television advertising has already kind of been a little bit down in the dumps. And overall, we're seeing, kind of consumer confidence shaken up pretty badly. And with that, we're seeing ad projections. So growth projections actually come down by quite a bit. So before all of this stuff started, Magna Global was projecting about 5% increase in U.S. advertising spend for 2025. Now it's down, actually before the tariff news, it was down to 4%, and I suspect it could go even lower. So that is going to be a big blow to the bottom lines of a lot of companies like a Warner Brothers or a Paramount.
So let me just ask a stupid question for you two smart media people. So I'm Nike. I usually do advertising, say on CBS. I'm making all this up, right? All of a sudden I'm like, oh my gosh, I'm not gonna be able to sell my product, so I'm gonna pull that ad all together. And is that like the logical 1 + 1 + 1 = 3 trickle down, Geetha?
That is exactly what it is. We have seen, it's great that you brought up Nike. We've seen commentary from a lot of these consumer-facing companies that are saying that they are going to pull back on advertising quite a bit this year, and that's really just a way of them protecting their bottom lines. So we're seeing that commentary actually across the board. We're seeing even, digital advertising, and remember, digital advertising has kind of been the standout, has been the star of the show, if you will, for so many years now, jumping up every year about 15 to 18%. And we've seen some pretty soft commentary even for digital advertising. So I think across the board, there's definitely a lot of nervousness.
How about, I think about the Walt Disney Company and even Comcast, the theme park business, which has been such a great business it's been a great business just across the board, and Disney's really stepped up its capital spending for that business because they're so bullish on it. But if consumer sentiment is shaky here, is the expectation that they'll see it in their top line?
I think so, Paul. I think this is going to be a real risk for Disney. Remember, this is so important for Disney. Parks make up 60% of the company's profits, so absolutely critical to their bottom line. Now, what management did is they already guided to 6 to 8% profit growth in the theme park business for this year, but I think they might have spoken too soon. So we've already kind of seen a little bit of softening in terms of theme park trends, and I think it's going to get even more and more difficult as kind of the year progresses. Disney also faces some competition from Comcast, actually. Yep. Because Comcast is opening Epic Universe on May 22nd. So for Disney, it could almost be like a double blow here.
Which is so weird, because weren't we saying just like a couple quarters ago, oh, it's great because it's like a one-stop shop. You get to go there, you're going to Universal or Comcast, but you're going to go to Disney at the same time. Now that's not the case.
Not the case, because again, there's going to be a lot of pressure on consumer wallets, and we've seen some really clever pricing come out of Comcast. So the way that they're packaging their promotions for Epic Universe is it's a 3 or a 4 day package, leaving a family like very little time to go to Disney. So they know what they're doing.
Is there going to be an analyst day for this new theme park?
Not that I've heard. I haven't heard.
See, that's what Comcast and most other companies don't get that Disney gets. Disney, whenever they do something fun like a new cruise ship or open up Shanghai, they have all their investors and analysts come, and it makes everybody feel good, and presumably that's good for your stock, and they know how to play that game.
Is that kind of like a bribe?
Yeah, but it's fun. They used to be really...
Yeah, and what's your point?
Sorry. All right, Geetha, thank you so much. We appreciate that. Geetha Ranganathan for Bloomberg Intelligence. The best one of those I did was in Canadian National, opened up their tunnel through one of the Rocky Mountains that cut the transcontinental trip by like 50%. We had a multi-day rail trip through the Canadian Rockies. Awesome. Awesome. That was probably one of the all-time greats.
Huh, really?
Yeah, so it was awesome. And what do you do on a train with a bunch of... Yeah. And what do you do on a train when you got not a lot else to do? You just have some cocktails.
I was like, well, I don't know. You play cards, you gamble, something along those lines?
All right, that was back in the day. That's when they knew how to take care of their Wall Street buddies. All right, we're at the top of the hour. Let's get to John Tucker, get a Bloomberg Business Flash, and then we'll keep this thing moving. John.
All right, back to the NASDAQ 100 entering a bear market. If it closes at this level, down over 20% from its peak. Intraday basis, NASDAQ Composite Index down 4.5%. The NASDAQ 100, 4.3% lower, down 794 points. The Dow down 1,372 points S&P 500, 222 points lower. That is down over 4%. The volumes are just off the chart. Fed Chair Jay Powell set to speak today, 11:25 Eastern or thereabouts. Wall Street boosting bets the Federal Reserve will cut interest rates to fend off a recession. A Bloomberg survey of economists pointing toward an increased risk of downturn since the White House imposed the tariffs. In the meantime, Priya Misra at J.P. Morgan Investment says even with this big sell-off, investors are still too hopeful.
I think we've just had a massive shift in outlooks. The market is still, I think, in this hope trade that this will all get negotiated away. The market's also saying, well, we might get fiscal stimulus and that can offset this shock. The one thing that's certain is uncertainty. Uncertainty plus tariffs, you're looking at growing odds of a recession.
Right now, the 2-year yield, 11 basis points lower, 3.56. The 10-year, that's well below 4, down 9 basis points as we get a bid to the Treasuries, 3.93. Remember Nike yesterday? Right now, one of the few that's in the green, up 1.5% for stock of Nike. Nintendo pushing back pre-orders for the Switch 2. They say it's because of concerns about tariffs. According to a statement sent by Eddie Garcia on behalf of Nintendo to The Verge, Nintendo said pre-orders will no longer begin on April 9th in order to assess the potential impact of tariffs and evolving market conditions, end quote there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Sorry, gamers. Alex
Yeah. No. I mean, that was my daughter finally got a used Switch. We're never going to get a new one, but still.
A used one?
Yeah. That's how I roll, man. Used toilet paper and everything. I should point out here that not true. It's not true. It's recycled. Looking at the S&P, just down 3.4%. We're off the lows. Here's a possible why. Right around the top of the hour, President Trump says he has a very productive call with Vietnam, saying that the country wants to cut tariffs down to 0. So Trump saying that Vietnam wants to cut their tariffs down to 0 on holdings, for example, jumping to a session high amid those comments. Okay, we have a great hour lined up for you. Let's just go through this here. We're gonna, Jay Powell is coming up in about 30 minutes time. We'll also hit Anurag Rana, Bloomberg Intelligence, talking about tech companies and how they're managing the sell-off. Mary Ross Gilbert, Bloomberg Intelligence, will also break down what's happening with retailers. We were just talking about Nike after getting pummeled yesterday, and Mike McKee will be here. Right, remember there was a whole jobs number that came out? He'll be here and to preview what to expect from Jay Powell at around 11:30. Now let's look at some of the stocks on the move today. We are joined now by Bloomberg's Lisa Mateo. Lisa.
All right, so we're starting with Tesla because it was off more than 5% at the close yesterday. So far this morning, down as much as 8%. Yes, tariffs played a role, but that's not all. The thing that changed today is that we learned that J.P. Morgan Chase analyst Ryan Brinkman, he's one of Wall Street's most bearish Tesla analysts, well, he further reduced estimates for the company's earnings. The reason why, well, he said it was due to that backlash against Elon Musk, how he's becoming like this kind of polarizing figure. But he also pointed to, as we know, Tesla's first quarter vehicle deliveries. They were far below estimates, slumped to the lowest since 2022. Said that report really shows that they may have underestimated the degree of like consumer reaction. Other headwinds, though, it changed over production lines, right, at each of its assembly plants to build that redesigned Model Y. J.P. Morgan now expects Tesla's first quarter earnings to slip to 36 cents a share, and that is just short of the previous projection of 40 cents a share. But shares have been really on the downward spiral since hitting a record high of December 17th. The stock has slumped 44% through the close on Thursday.
Have we had any update on what Elon Musk plans to do, whether he's going to be staying with the Doge? Because that was reported a couple of days ago and I haven't seen any confirmation.
He seemed to deny it, that he's going to stay till the job's done, but I guess we don't know what that actually means.
Okay.
What that winds up looking like. All right, let's go to NVIDIA.
Yes. Okay. So remember yesterday, closed the day off more than 7%. It's lowest since last summer when those fears about the delays of the rollout of the Blackwell chip. So you remember that. But this morning it's been down, well, more than 7%. You know, U.S. chip makers are generating significant amount of sales in China. So any additional duties on products sold inside the country, well, that could negatively impact their business. So this is why those shares have been lower. Why it's still lower today? Well, we heard the news, right? China retaliated and imposed that 34% tariff on all American imports that starts April April 10th. So that's really escalating the trade war. Other chip stocks that are affected, for example, you have Intel off more than 8%, Micron down as much as 12%, you have Broadcom off as much as 7%, and Qualcomm down as much as 5%.
Unreal. We are seeing, by the way, I just want to point out here, circuit breaker triggered for restoration hardware. RH now all of a sudden starting again, quickly trimming some declines to 7.3%. Like these stocks are moving really fast on really whippy headlines. Wrapping it up here with Wayfair, getting a downgrade, right, due to tariffs?
Yeah, so of course, dealing with tariffs, right? A lot of retailers, we heard that yesterday. It closed down, I didn't even realize this, but 25% yesterday.
Yeah.
Before the bell, down as much as about after the open, it was down as much as 16%. The difference today is that it received, yes, the downgrade from Citi to neutral from buy. They said Wayfair still positioned great long-term, but tariffs have made the risk to revenue now greater. It also added that the company's management has, quote, done well in controlling what is in control, but it says that those macro headwinds, well, they're just too much to ignore at this point. But what was really interesting about it is that Citi also said it sees eBay as a good alternative because consumers are going to start looking for value since maybe they're going to have to raise their prices. They're going to say, hey, I'm going to go over to eBay instead of Wayfair. But we'll see what happens.
All right, very good. Lisa Matei, we appreciate that. Again, the headline that I think you hit, Alex, earlier, President Trump saying that Vietnam wants to cut their tariffs down to zero. So we'll have more reporting on that.
And also that means you got Lulu pairing declines. You got On Holdings jumping to a session high. Nike jumping to a session high as a lot of their product comes from Vietnam. So this is that link there, and you get equities off the lows of the session. All right, let's go now to tech and where we are in that market after the big sell-off. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. All right, Anurag, what stops the bleeding here for tech?
We need a few more of those announcements that other countries are willing to negotiate as well, because unless that happens, it'll be very tough to figure out where the bottom is in terms of fundamentals for any of these companies.
Yeah, Anurag, we had Dan Ives in studio earlier this morning on surveillance, and it's by far the most cautious I've ever heard him. Now, granted, he's a very bullish analyst by nature, but he's saying basically this is a black swan event for technology, and unless it changes, this is a long-term headwind for tech, and I guess that kind of goes. Is there? And he even went to the level, Anurag, of saying he'd be surprised if many of his companies even provide guidance in the upcoming earnings here. So, as you talk to clients, what's the mood out there? Is there anybody saying I feel the bottom here? These are great companies. I can buy them cheap here. Or what are the conversations like?
I think the biggest thing is how long is this malaise going to last on the uncertainty side of it? Because, frankly, if you extrapolate and see what NASDAQ has done over the last 3 years, it has been phenomenal since ChatGPT came out. So, one could argue there is a lot to give on the price action point of view. But fundamentally, these are very strong companies, really amazing balance sheets, and also the growth profile down the road. And, we talked about the conference, and everybody is looking to invest more in more AI-related services. So the fundamentals on paper are very good. But what happens is when you have a shock in the system like this, everybody freezes, hiring freezes, spending freezes. So you don't know what to do for the next 6 months. You don't know whether the revenue decline, how much is it going to be? The margin, pressure because of the tariffs. So there is so much uncertainty right now. And I think there's a fair point that the guidance is going to be very tough at this point.
Oh, yeah, tough for everyone. I should point out some more headlines coming out of President Trump saying it's a perfect time for Fed Chair Jay Powell to cut rates. This is as Jay Powell is expected to speak in just about 20 minutes time. That's going to be a fascinating conversation to unfold. That's pretty tough. Okay, Anurag, when we take a look at earnings estimates for these companies in your tech space, in what subsector do they need to re-rate more?
I think software numbers needs to come down quite a bit, and something we did a note a few days ago. We looked at the top 50 software companies and saw that the median growth rate for those was 13.2% on December 31st. So that is for for calendar year 25. Just a few days ago, that number was 12.4%. So less than 1% decline in the expectations of a growth rate. That number needs to come down quite a bit. It needs to come down, well under 10% at this point before one could say that, okay, we are at that point where fundamentals are now aligned with where the overall economic situation is.
So let's go down and talk about Apple here. It's off another 3.6% today, off 21% year to date. Anurag, is there any call here on Apple? They're just so, and we've known this for years, and we've talked about it for years, how so dependent they are on China, both from a supply chain as well as an end market. What's your current view on China in this environment, on Apple?
Yeah, I'm really getting worried about how how consumers will react in China with this thing, because it's one thing to say that, okay, my phone buying has been pushed out by 3 months or 6 months or so. Okay, the demand comes back next year. It's not that big of a deal. But once you really get a bad feeling about a company or a country, that sourness really impacts the fundamentals of it. We have seen what's going on with Tesla in Europe, for example. You don't want Apple to have that same feeling in China, where consumers are saying, you know what, I don't want to touch an American brand. I would rather just buy the local one. And that's a very big problem in our view, because Greater China region accounts for 20% of Apple's revenue.
Yeah, this is what we're talking about now. We're not even talking super cycles anymore. I feel like 6 months ago it was like, no, it's coming. The next iPhone super cycle. To that point, we've already seen, say, Ford talking about discounting their cars to get people in the door. Is this going to be a similar case for Apple? Because they're not a discountery kind of thing.
No, I don't think so. I mean, I think the Apple CEO has played it very well when it comes to China. He has gone to China a few times. He's been seen with the commerce ministers. He's talking about investing more money here and there. And I think he's playing the cards right, because you really don't want the world's, most lucrative market for your goods to basically have a very bad feeling about your products. Because at the end of the day, in the US, they really cannot grow much. It's a saturated market for them. Their growth rate will come from emerging markets, whether it's China or in a few years from India. But, they really have to play it nicely in China in order to show growth rate over the next 3 to 5 years.
In terms of overall tech spending, Anurag, how elastic is tech spending broadly defined? Is it something that these companies feel like they have to do no matter what? Or like advertising, we were just talking to Geetha Ranganathan, that is very discretionary spending on a part of a company. How about tech?
I think you're divided in 2 categories. One is your growth CapEx, where you're going to invest for newer products. And that will remain the case. AI spending, let's say somebody is spending, $100 more, they will probably spend $95, $100 again. That's okay. But the problem comes in, now it comes at the expense of something else. You were going to upgrade the PCs in your department. That's not going to happen. You're going to push it out by 6 months. Servers, normal software that you use for day-to-day work. You're going to scale back on some of those elements. Consulting, is off the window at this point. I mean, I'd be very surprised to see consulting. One could expect layoffs coming in the consulting world over the next, few months, because if there is no work, these companies are going to cut out consultants, whether it's McKinsey, BCG, or some of the other services companies. So you have to take money out from one to give it to the other.
But that's what I'm saying. Is there rotation of money or just a non-spend of money altogether? Like, does one section spend more while the other spends less? Or is this a true pullback?
It was a mix of both. I think reallocation is definitely going to go, but I don't expect, if somebody is investing in AI to improve their operations, they're not going to stop that project. But to be very frank, that number as a percentage of total spending is still not that big for a large bank or a retail company. It's really the day-to-day work, and that's where you're going to see. Anticipating more layoffs coming in over the next 1.5 months from some of these vendors.
Oh, man. That is a grim prediction on that point. How fast do you think spending could pick up? Like, what would be a trigger for a reset?
The news like Vietnam, please give me 5 or more of those news releases and all of this turns and everything goes back to normal. Because frankly speaking, we are really on a thin line when it comes to business confidence. And I think really in our view, these things are really, they're playing with fire, because once it takes the spiral downturn, it's very difficult to stop it. So if it stops over the next few weeks, I think we can see a good end to the year. But otherwise, once the layoff starts, then it's a vicious cycle.
So is there any safe names in tech? I mean, is Microsoft the safe name?
That's a very good point, Paul. We have been thinking a lot about it, and discussions we have been having, and with folks like you, we've been saying that companies that are really exposed to the large enterprises, so the Fortune 500 companies or the Fortune 1000 companies, they will be less impacted than the ones that are impacted to the SMB spending. So I'll give you a very good example here is Shopify. Look at how it's completely been, decimated yesterday and today because bulk of their consumer base or the client base is small and medium businesses. Now, somebody like a Microsoft or a Workday that deals primarily with larger companies and larger enterprises, a lot less, disturbance in their revenue flow. They will also get hit. It's not that they're immune, but it'd be a lot less than somebody like a Shopify.
I also have to wonder if does this change the ROI for AI, for example? Like, you got to prove it harder and faster in this kind of environment.
See, one of the things is that's still in the experimentation stage. So let's say if a company, if a bank is spending $100 in technology spending, in total, they're not spending more than $1 or $2 in AI. So it doesn't really, that doesn't move the needles. It's really the bulk of the big hardware purchases, big computer purchases. That's the one that, gets pushed out.
All right, Anurag Rana, thank you so much. We appreciate that. Anurag Rana covers all the technology for Bloomberg Intelligence, joining us from Chicago via Zoom here. Looking at the markets here, bouncing off the bottom here just in the last few minutes. The S&P 500 doing a little bit better, trying to get a little bit of life here. Down about 170 points, so we're down over 200 just a little earlier, maybe a little bit of on that Vietnam news that President Trump just kind of said. I think he said it in passing, and as he's getting off the helicopter down to Miami. He's going down there to his Doral Golf Club because the Live Tour is having their tournament there this week. So he's going to go be a part of that.
I see. He also calls on Fed Chair Jay Powell to cut rates. He says that Powell is always late, but that he should be cutting. And speaking of, at 11:25, Jay Powell will be speaking in prepared remarks in a moderated conversation at the CEBU annual conference in Arlington, Virginia. We will bring that to you in full. We will also preview that with Michael McKee, Bloomberg International economics and policy correspondent, coming up next. Taking a look then at the market, as Paul was just saying, you're seeing the equity market off the lows. You're still seeing buying coming in, though, to the bar market. The 10-year yield is down by about 6 basis points. The 2 is down by about 7. So still a little bit of theme there into safe haven assets. Happy Friday. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is the Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages tumbling, but actually off the worst levels of the session after the Bloomberg headline. According to President Trump, Vietnam wants to cut their tariffs down to zero. That's giving a list of some of the companies that produce their stuff in Vietnam. Nike, after yesterday's plunge, up over 4% right now. After falling over 20% for the peak, the NASDAQ 100 was on course to enter a bear market. And then this headline from the Bloomberg, Klarna pausing its planned IPO after Trump tariffs, according to the Wall Street Journal. This company, Klarna, provides e-commerce payment systems. Waiting for headlines from Fed Chair Powell, set to speak in a few minutes. No pressure here ahead of the remarks. President Trump says, perfect time for him to cut rates. We know the history of presidents intervening in monetary policy. Not a good one. Think Arthur Burns. S&P 500 down 174 points, down 3%. The Dow Jones Industrial Average down 1,046 points. The NASDAQ 100, 586 points lower. That is down over 3%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, John Tucker. Appreciate that. And speaking of, we will have Jay Powell speaking in just a few moments' time, discussing the economy. He'll be speaking with SABU Board President James Nelson, business editor of the Milwaukee Journal-Sentinel, and Heather Long, an economic columnist at the Washington Post.
And just some more news coming out as it relates to the volatility in the marketplace. Klarna and StubHub, they've paused their planned IPOs after the Trump tariffs. That's according to the Wall Street Journal. So another ripple effect there.
I feel like, wasn't Klarna like trying to IPO for like ever,
Yes, yeah.
2 years at this point? I mean, the tape just keeps getting worse and worse here. Okay, so let's get some economic take and so what we make into listening to Jay Powell in just a few moments' time. Stuart Paul is U.S. economist with Bloomberg Economics. What are you going to think? What do we think we're really going to hear from Powell today?
This is what's a little bit difficult is because if you think about the Fed's reaction function and you think about the projections that we now have for inflation and unemployment, there should actually be fewer rate cuts this year than, let's say, even the 75 basis points we were expecting at the time of the last Fed meeting. Markets have moved the exact opposite way, now pricing at about 110 basis points for the year. And I don't think that the Fed is going to completely shrug off market expectations. What's interesting about Powell is that in talking about the 2018 and 2019 tariffs, he was more so focused on demand destruction and the negative growth consequences of those tariffs more so than inflation. So if you're in our seat and you have to think about the Fed's reaction function and build a comprehensive and coherent model of the Fed's reaction function, you'd have fewer cuts, but taking Powell at his word and thinking about what he's said in past remarks, he's probably going to strike a little bit more of a dovish tone, perhaps, than most that are taking a more empirical approach would expect.
Has Bloomberg Economics changed its outlook for a recession?
I don't think we've done it officially. We've always been
thinking
a little bit,
about it?
We've always been a little bit more bearish than most forecasters out there. We've always expected consumer spending to wane a little bit more quickly than it has. The consumer showed quite a bit more resilience than we've been expecting over the last 2 years, frankly. There is still quite a bit of credit capacity to smooth over any sort of lumpiness in the broader economy, but we are sort of at this point where spending should start slowing and growth plans, expansion plans should be put on hold, and we should start seeing that in aggregate numbers.
Pause you there for a sec because we're getting the Powell headlines from his prepared speech. There'll be a moderated part of the panel also. Powell saying the possible tariffs could have persistent inflation impacts and that the Fed is obligated to keep inflation expectations anchored. Also saying the economic impact of tariffs likely larger than expected. They must ensure price hikes don't lead to ongoing inflation, and they're still going to kind of wait and see. That feels, and there's a bunch of other headlines, but that feels a little bit like the inflation scale is outweighing the growth scale a little bit right now.
Yeah, the Fed needs to maintain this sort of emphasis that it is dedicated to maintaining its 2% average inflation target. We saw the same thing actually from the Bank of Canada just last month. They were talking about maintaining inflation expectations, maintaining the 2% target. So it's not a huge shock. What's a little bit weird is that there is some trickery a little bit in the wording here, right? The Fed is well positioned to wait, right? I mean, that's sort of a phrase that means a little bit of nothing, right? So I guess we'll still be waiting to hear exactly what it is that he says as he delivers the remarks, and if we could read a little bit from his body language.
What is at Bloomberg Economics, your view of inflation? Is this a material risk that we could see a material increase?
Yeah, so this is, we certainly know that firms are going to be trying to pass along their higher input prices to consumers. So we do expect to see pretty close to 3% core inflation through this year and well into next year. So again, if the Fed's going to be, if we're thinking about modeling the Fed's behavior, yeah, it's that inflation element that's going to keep the Fed on hold, right? That's our empirical model of the Fed's reaction function, once again, coming through. But if we think about whether firms will be able to pass along their higher input prices to customers, we're actually a bit skeptical.
I wonder how, I'm just taking a look at the markets and how they're going to view this, because, you have to wonder, like, at what point might we see an emergency rate cut? Like, what's the bar for something like that?
The bar is really high for an emergency rate cut, because more than any sort of alleviation of concerns or any sort of signal that the Fed is being reactive to, market concerns or expectations, it does send such a signal of fear to market participants. It could be worse than it actually is helpful.
Stuart, thank you so much for joining us. Stuart Paul, Bloomberg Economics. Right now, let's head down to Northern Virginia. Jerome Powell, the Fed chair, discusses the economy in the era of Donald Trump's sweeping agenda at the Cebu board, with Cebu board president James Nelson, business editor of the Milwaukee Journal, and Heather Long, an economics columnist at the Washington Post. Let's listen in.
After a couple of years of solid growth, many forecasters have anticipated somewhat slower growth this year. The initial reading for first quarter GDP will be released later this month. The limited hard data are consistent, though, with the slower but still solid growth outlook. At the same time, surveys of households and businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, that was Fed prepared remarks, Fed Chairman Jay Powell. And now let's do some Q&A from the Cebu conference. I believe they're in Arlington, Virginia. So we'll wait for the Q&A to begin.
This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Wong with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump earlier this week, when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments, so I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life, and they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. We, of course, we're looking at inflation, which is the change in prices, and we're seeing that has come down quite a bit, and that unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data, and it still shows a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't actually we don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you consider that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. We're driven by, analysis and careful thought and discussion and debate and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. And I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is from the staff has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. You know, we're probably moderately restrictive, let's say. So it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the reserve banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be.
It might be months away.
We'll have to see.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. There was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and then and now we have new administration and changes in policies. And every situation, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, either slow down or speed up the economy over time. And higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation, if we find ourselves in that situation, we look at how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
It's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. It's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities, which each have two variables. And then you say, you look at that and you think, what do we need to do? And typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for tight monetary policy. This could be different, but again, we're not actually facing that today.
I feel like there's another tension inherent in your job, which is that you're looking at the macro economy, at the global economy, really, and the U.S. places in it, but also the data you're looking at is very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us. And trade policy is one of those. There are many, many issues that people love to try to pull us in on, almost every issue, really. And we just need to stick to our knitting, not get pulled into those things. And so trade policy is a classic one. Energy policy is another. Climate change, immigration is not really, although all of those things have economic implications, and it gets argued that way. But if we treated those as our job, the case for our independence would disappear. So I really can't comment on, we hear the same stories like that, but honestly, the policymakers who are charged with that, they're probably hearing the same stories too, and they're reaching a judgment about what's in the best interest of the country in the long run. That's what they are doing, I guess, and that's, so it's not for us to comment on that.
What happens inside the Fed at a moment like right now, when there's so much change and quite a bit of uncertainty, when you're watching things unfold? What does that look like, practically speaking? What are people doing inside the building?
So I'm very proud to work with the people I work with. I can tell you that in times like this, or times like the pandemic, where the global financial markets were shutting down, the global economy was shutting down, people step forward and they say, "We've got this." These are career people who were here for the global financial crisis. They've got 25 years, 35 years of experience with crises, and they step forward and it's just incredible what they can do and how good they are. It's a great honor to work with them. So right now isn't that situation. We have the situation we have. So our trade people and our inflation people and our macroeconomists are all working hard to kind of digest the news of this week and try to filter that into the forecast that they'll make And policymakers are doing very much the same thing, and we're reading everything we can about what's happening and lots of outside analysis too. We don't have an FOMC meeting until May 6 and 7, so that's really a process that lasts several weeks, and we're not quite at that stage yet. But we're kind of thinking ahead to that and working through all of that. I will say though, it feels like we don't need to be in a hurry. It feels like we have time
Really?
to. Yes. It feels like we don't. No, I mean it's like I said. You have inflation's going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be, and we're going to need to wait and see how this plays out before we can start to make those adjustments.
Question from the audience. One of our SEBU members is: are you in contact with other central bankers in other countries at a time like this?
Yes, pretty frequently. Absolutely. I mean, and the same was true during the other crises I've been through. Not only that, though, we do meet very regularly. The IMF World Bank meetings here in Washington twice a year. We go to Basel multiple times a year to meet. That's all central bankers. And there are also G20 meetings, G7 meetings where the central bankers are there. So we're kind of regularly meeting and talking. And when we're not doing that, we're also texting each other.
Is there a group chat?
I'm not at liberty to say. No, there's not.
And have you talked to those central bankers this week?
Recently, yeah, I didn't want to get too specific about this, but yes, I have.
What's their sentiment? Can you characterize that?
I'd rather, again, I don't comment on what my international colleagues say, or it's not appropriate. But we're talking about events. We're talking about the implications for the economy. We're discussing what we're hearing from markets and from business people and for from the elected governments too. It's all the things you would expect us to be talking about on a regular basis. It's one of the best things about this role is that the central banks have a lot. We're all non-political, so we think about things in quite similar ways, and they're real bonds. We're not lobbying each other ever on policy. It's just never. That's just not a thing, because we do our policy here, they do their policy there, but we develop really, really good relationships and bonds with them. And it's one of the real pleasures and benefits being able to talk about this, just not only with the great people at the Fed, but also with the leaders around the world.
I mean, it's interesting because it is a job of enormous responsibility and power, but it's also a job. How would you characterize the job of Fed chair? Like, how is it as a job?
Honestly, that's what it is. I really feel just like another person doing that job.
Really?
Yeah.
You just like...
That's how it is. I'm doing a job. I have a job to do. I actually really like the job. I like it a lot. I enjoy it. It can be stressful at times. Nonetheless, incredibly interesting, great people to work with, really important. What more could you want? But that's what it is. And, I'm blessed by working with great colleagues who are really committed to getting it right. I mean, fully appreciate how important it is that we get it right. And do everything we possibly can to bring the best thinking, the best analysis, and debate things, over and over until we feel like we're in the right place. At the same time, there is no certainty in this. You can be wrong because the economy can zig when you thought it was going to zag.
So your term as Fed chair ends about a year from now. What do you think about your job security?
I fully intend to serve all of my term.
Excellent. I mean, as we're getting close to wrapping up, I did want to ask something a little bit out of the box. I think because you do have a position of such great responsibility, people are very curious about you, and I think people tend to read into everything a Fed chair does, small gestures, word choice. I know it's part of our jobs in this room to pore over every word you choose. I did want to ask about one thing that I've wondered about for years, which is your tie. You always seem to wear a purple tie, and every time I think I've seen you, you've worn a purple tie, and I'm wondering if there's significance to that?
Well, at the beginning, the only significance was that I like purple ties.
Okay.
But I will say, you know, so then the next press conference, I reach for a blue tie or a red tie, and I go, maybe not, you know. And so I wind up wearing purple ties. And then it becomes a thing, and now I definitely wear purple ties all the time.
Okay.
But I felt like, you know, it just felt a little awkward to be wearing one that was identified. We are strictly non-political. I can't stress that enough. We are not, it's not that we're bipartisan. We are non-political. We don't do that. And so purple was a good color for that. That's all. Plus, I like purple ties.
Sorry, I didn't give you a purple guitar pick. I have one other Milwaukee question that I overlooked here, but in Milwaukee and other parts of the country, the housing market is out of whack. In our market alone, in southeastern Wisconsin, there's 5,000, the market's out of whack by like 5,000 houses that need to be on the market for it to have equilibrium. And a report this week said tariffs could tack on some $6,000 to the cost of building a new home. How long are people going to sit on their cheap mortgages from COVID? Thank you very much. And before they move on, before the market frees up.
So you have several things there. The first is we just haven't built enough housing, and we haven't kept up with the demand for housing. So there's an underlying shortage. Before the pandemic, you know, there was a real housing shortage. And by the way, that's happening in many comparable democracies around the world. The second thing is, you know, lock-in, as you say. There were very, very low mortgage rates during COVID, and people are kind of locked in. It would be very expensive to move, and that'll of course wear off over time. You also mentioned, you know, the costs of materials that might be imported, you know, lumber and nails and things like that. And yeah, and also labor, a lot of labor from in the home building business has been traditionally immigrant labor. So yeah, the housing, the sort of new build market, it may face some cost pressures as well. That may very well be the case. That's what we're hearing from home builders, for example, both on the labor side and on the materials side. But even once these short-term things happen, we're still going to have not enough houses, and so it's all, you know, I think for a long time we're still going to see upward pressure on housing prices. You know, maybe until population growth slows or until we catch up.
You mentioned that we're kind of in a period of waiting right now to see how policy ripples out through the economy. How long do you expect that to take? How long do you expect these big policy changes to show up in our day-to-day lives, in prices and supplies and things like that?
I mean, for a while we didn't know what was coming on April 2. Now we know what came on April 2. We don't know. There's a lot more to be said about how all that shakes out. But we've come through that, and I think you now know that the tariffs are larger than people were generally expecting. That much you know now at this point. And you'll know more as you start to see the effects on the economy. So, you know, as the months go by, it's hard to say exactly when you'll know. But, you know, clearly that learning process is ongoing. We're just seeing that these are new policies, not just the tariff policies, but the other ones as well. There'll be, you know, important fiscal legislation coming up fairly soon. And there'll be regulatory changes, significant regulatory changes. You have to really look at all of that to see what the overall effect will be. So I can't give you a date, but all of that is now kind of coming into place at sort of the speed you would expect policy changes to be, and then we'll begin to see the real economic effects as the year goes on. But again, I can't give you a really specific date.
Is the fiscal legislation the tax cuts?
Well, yes. I mean, I know they're contemplating, and you know, we don't comment on fiscal policy, but what I read is that they're contemplating, you know, making the Tax Cuts and Jobs Act cuts permanent, and also perhaps some other things as well. We wouldn't be. We have sort of a placeholder for that too, but that's really not ours to comment on. But that's what I was talking about. Yes.
So I have a question from a friend in Milwaukee who said she has clients that have deals ready to go, businesses that are ready to launch from their garage to a private equity deal, and they're just stuck in their garage right now. How long do you think, what do you think the impact of the uncertainty these days will have on the private equity deals?
So again, we're hearing a lot of that. People are they're just kind of waiting for clarity. So And I can't tell you when that will pass, but ultimately it will pass. We know that at a certain point we'll know enough to know what the uncertainty will decline, and we'll be able to see with real clarity what the policies are and what their effects are. So, you're right. We hear the same thing from businesses and from people that they're kind of waiting and seeing. There's a lot of waiting and seeing going on, including by us. And that just seems like the right thing to do at a time of elevated uncertainty.
What economic indicators are you watching right now? I mean, very famously, you look at the CPE and obviously the CPI and things like that. But are there any economic indicators in this moment, in these circumstances, that you are watching, focused on,
Sure.
interested in?
So the basic two big data pools are the data around prices and around employment. And we get in the employment area, we get just really that's an area where we actually get pretty good data. Although the survey response rates have been lower, nonetheless, we get a lot of different data. And it's not just unemployment, it's participation, it's by age group and things like that. It's wages, it's many, many different things. It's jobs, it's quits, all the job creation, quits, openings, all those things. So that's one thing. On inflation, we target PCE, personal consumption expenditure inflation, not CPI, and the two are broadly they move they move together. But 25 years ago, the Fed switched to PCE. The public looks at CPI. It's kind of a little bit of a thing, but because we think it's really just a better way to capture the inflation, the cost pressures that households and businesses feel. We think it's a better measure, and that's what we look at. But they're not that different. I mean, they look at different measures. Ultimately, they're pretty close together. Those things. On growth, you look at what's happening with consumer spending. The economy is overwhelmingly driven by consumer spending. So you look at how are consumer surveys, how are they feeling, how are they spending? Sometimes the surveys are very negative, but they keep spending. That's been happening really for a while. People spent right through the pandemic, and they spent right through this time of higher inflation. They kept spending, and forecasters kept thinking, like us, kept thinking that consumption would slow down. But that's a really critical thing. After that, business investment is a big chunk, and you look at that, and that is also susceptible to sentiment. Businesses, if they don't know what to do, they're not going to do an acquisition, or they're going to hold off on building a factory or a plant or hiring people and things like that. So we look at, I could go on for a long time. We look at a lot of data, and we try to make sense. We also talk to people who are in the real economy. I grew my career was mostly in the private sector, talking to people who ran businesses. And for me, the story doesn't come together until I actually hear from people who are in the economy doing things and what they're feeling and seeing, and then it sort of fits together better.
Is this like via the Beige Book, or just
Beige Book? Thank you for mentioning the Beige Book, and I hope you read it.
I love the Beige Book.
See, that's great. Everyone should read the Beige Book. The Beige Book comes out sort of mid-FOMC cycle, and it's all the 12 reserve banks and all of their incredible context, what they're saying about what's going on in the economy. So if you want to know, you can look at the national data, but if you want to know what's going on in regions and at different industries, you look at the Beige Book. So it's really a critical thing. And actually, the reserve bank system that we have is an enormous strength of the Federal Reserve System. We have these 12 reserve banks with their own, economics departments and own participants on the FOMC. So that's a great thing to look at.
I'd like to ask you about another body of work that many of us know that you're familiar with, and that's the Grateful Dead. So, question for you, sir. American Beauty or Terrapin Station?
American Beauty.
Well, it's not even a pause. That was so fast.
That's my era.
Working Man's Dead?
Yes.
Or Europe 72?
Oh, both. Yeah,
Well,
that's my era. We're in the same era here. So that's, for me, it's late 60s to mid 70s. So you're
Touch of Grey, what do you think?
It was their only hit, but it's a good song. Okay. Yeah.
Finally,
we're going to do this?
I feel like you're speaking another language.
There's a well-known Grateful Dead bootlegger who, with I believe the permission of the band, Dick's Picks, who's put out. So, what's your recommendation of those hundreds of?
I don't have any Dick's Picks. Like I said, my real interest was late 60s to mid 70s.
Yeah.
And I saw him a bunch of times, and I know every note on every song from that era. But since then, I've been busy, actually.
Well, we thank you for taking time out of your schedule to join us here, and we appreciate your work.
Thank you very much. Thanks, everybody.
There you have it. The Fed chair on quite a day here to be taking live questions and answers as we brought to you live here from Northern Virginia. He was speaking just outside of Washington, D.C., live and unfiltered here on Bloomberg Radio. I'm Joe Matthew in Washington. Thank you for being with us. You made it to Friday, and it doesn't feel too good as we watch the markets tumble as investors listen to Jay Powell there. Some really interesting news there concerning as well the risks, he says, of higher unemployment and higher inflation have elevated. In light of the tariffs, he spoke directly to President Trump's tariff regime that has sent the markets on a spiral this week. The tariffs are likely to cause higher inflation and slower growth, he said, likely to raise inflation in the coming quarters, going on to say that the possible tariffs could have a persistent inflation impact. That is what has spooked the markets here as we listen to Jay Powell speaking live. Quote, this is the quote, while tariffs are highly likely to generate at least a temporary rise in inflation, it is also possible the effects could be more persistent. And this comes off a Truth Social post from Donald Trump, who in fact called on Jay Powell to cut interest rates just moments before he took the stage today, writing on Truth this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He's always late, Donald Trump wrote, but he could now change his image and quickly. Now, this has been a very difficult day on the markets. It was before the Fed chair started speaking, and we just reached to new lows while he was talking. And that's why we want to bring in, before we do anything else, Charlie Pellet with his view on Wall Street from World Headquarters in New York. Charlie, how's it look?
And right now we are just about lows of the day with the Dow, the S&P, NASDAQ very much in the red, Joe Matthew. Right to the numbers here with the S&P down another 4% today. The S&P 500 index now tumbling by 217 points at 51.79. We've got the Dow down 3.4%, 1397 lower, right now at 39,153 on the Dow. NASDAQ is down 668 points, another 668 down 4%. The Russell 2000 index of small cap shares slumping now by 4.6%, with a 10-year that's currently yielding 3.93%, with the 2-year at 3.61%. Spot gold right now down 3%, $3,021 the ounce. West Texas Intermediate crude lower by 7.6%. WTI right now 61.85 a barrel. The trade fight weighing hard on shares of industrials and materials companies, including tool companies Stanley, Black & Decker, machinery builder Caterpillar is lower as well. Right now, we have got shares of Caterpillar down by 4.9%. Stanley, Black & Decker down 4.3%. Among other manufacturers, Harley-Davidson down 4.3%, and Whirlpool right now down by 2.8%. So the sell-off driven by worries about President Trump's tariffs, pushing the economy into recession. Again, the S&P keeping it all in context right now, down by 4.1%. Back we go to Washington. We got more on the economy, more on the Fed, more on the sell-off coming up right here on Balance of Power. And once again, your host, here he is, Joe Matthew.
Thankful to have Charlie Pellet with us on this Friday edition of Balance of Power. We'll get back to Charlie a little more than 10 minutes away as we keep a close eye on the markets today, even as we cover politics here from Washington. The fact of the matter is you cannot separate the two right now. Wall Street has been keying off of Washington for weeks, and it just got worse with Jay Powell speaking a short time ago, reminding this is jobs day. That would actually be our probably lead story in any other world, with growth topping all forecasts in March. Non-farm payrolls, 228,000. But clearly, this data is rear view mirror, because we've got a whole new world that we're dealing with now. And we're going to be updating the push and pull here with the tariffs. We do have a couple of updates for you here, based largely on Truth Social. We're really just hearing about this from the president, knowing that China said it would retaliate here, hitting all U.S. imports with a new 34% tariff. President Trump writing on Truth Social, China played it wrong. They panicked. The one thing they cannot afford to do. That was followed up a short time later with a truth about Vietnam. Just had very productive call with To Lam, General Secretary of the Communist Party of Vietnam, Donald Trump writes, who told me Vietnam wants to cut their tariffs to zero if they are able to make an agreement with the U.S. I thanked him on behalf of our country. Are we about to get 10 more of these? Would that change the vibe on Wall Street? That's kind of the big question right now as investors head for the exits. And a lot of people are very worried about staying long into this weekend because of what might be waiting for them when the bell rings on Monday morning. Let's start with the economic side here. And our friend Stuart Paul, the U.S. economist at Bloomberg Economics, is with us live from New York on a jobs day. Stuart, do we pay any attention to this report, or is it already old?
It's already very old. Life comes at you fast. It comes at you even faster when Trump has his cell phone and is all over Truth Social. So the March jobs data are a bit stale. I think that if we're going to take anything from the March jobs data, it should be this: robust payroll growth plus relatively rapid wage growth and no material change in the length of the work week. That spells about 0.5% personal income growth for the month. We're not going to get that data for another 2.5 weeks, a little bit longer. And so if we're thinking about whether consumers can continue spending through the month of March, through the month of April, they probably can. Now, if I'm Chairman Powell and I'm worried about folks spending and bidding up the price of goods to try to get ahead of tariffs, to get ahead of the price hikes that they're anticipating, they're going to be applying upward pressure on prices. I think that that's the most material takeaway we can get today from the jobs report.
Interesting. Still too early to see the impact of the Doge cut, Stuart?
It is too early. Federal government hiring was pretty slow. Still seeing a lot of local and state government hiring. We're not seeing a major shift in terms of jobless claims in the weekly jobless claims reports. We are seeing from Challenger, another Challenger survey reports on annual growth in layoffs. We are seeing a lot of planned layoffs, of course, but that doesn't give us much data, true data, beyond just what we're seeing in the headlines.
You consider the dual mandate here, the headline on the terminal, Jay Powell, tariffs likely to raise inflation, risks of higher unemployment and higher inflation elevated. What could we be looking at, I should say, when it comes to jobs reports 6 months from now?
We think that the unemployment rate is going to be heading higher, ending the year a bit over 4.75%, closing in on 5% to end the year. And I think that a big part of that is because the Fed is so committed to the other leg of its dual mandate, the price stability element of its dual mandate, by trying to convince folks that they are committed to a 2% average inflation target, and by trying to keep inflation expectations reasonably anchored at low single digits at least. The Fed is essentially emphasizing that they're not rushing to cut rates anytime soon, and that's what's going to untether the unemployment rate, we think. So we think that, yes, today we just saw a very minor uptick in the unemployment rate, but we think that we could get a more substantial and a swifter rise in the second half of this year, in part because the Fed is moving a bit slowly. Now, that's not to endorse what you mentioned President Trump said on Truth Social. He said that the Fed typically moves a little bit slowly. The Fed has to, at this point, be reactive. It has to be reactive to the printed data, and the printed data is going to move even more slowly than sentiment, which is moving based on what we're getting out of Washington. So there's this long chain of action that has to take place before we actually get interest rate cuts. Those rate cuts are probably going to only come late this year, and in the meantime, the unemployment rate is going to continue rising into year end, we think.
Yeah, late is different than slowly. In no hurry is the headline. Feels like we don't need to be in a hurry. We have time. That was a red headline on the terminal. Jay Powell speaking earlier. Stuart Paul, thank you so much on a jobs day from Bloomberg Economics in New York. We want to add the voice of Ed Harrison, whose headline caught our attention this morning. Bloomberg senior editor, author of the Everything Risk newsletter, where the headline says it all. The jobs report is actually bad news for stocks and bonds, too. Edward, it's great to have you back here on the program. I appreciate this. Now, of course, you add everything that happened after you published this column at 9:14 a.m., and you wonder where Jay Powell's head is. The fact of the matter is this came in hot And it just adds to the confusion that we're dealing with here. When people are calling for rate cuts, doesn't look like that's happening anytime soon.
Yeah, it seems he confirmed what I was saying in the post, Joe, and that is that they're going to take a wait and see approach. They're going to continue to hold, and if the inflation numbers are too high, there's nothing they can really do about it unless the labor market really falls out of bed. And so that's not good for the bond market, which has been rallying on the concept that they're going to get these rate cuts. But the fact of the matter is that Jay Powell wants to keep inflation expectations anchored, and he's afraid that they could become unanchored, and therefore he's not going to cut rates.
Let's hear from Jay Powell right now. Sam, if you could do that for us in New York. We just heard about a half an hour of commentary, prepared remarks, and Q&A. This is the line that matters to the market. This is why we saw conditions deteriorate. The Fed chairman here from earlier.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Investors doing it for him here. The bond market's doing it for him, Edward. 10 years back below 4%. And how? We're at 3.93% right now. What does that tell you?
It tells you that the bond market, it's almost thinking a recession is a fait accompli. I think that really what we're seeing now is just a flight to quality. Some of the levels that we're seeing in terms of the rate cuts, in terms of the actual yield, they aren't necessarily indicative of what we're going to see in a week from now or 2 weeks from now. This is just the knee jerk. Once we have time to process what the Fed has said and how things progress, I think that some of that flight to quality will be backed out. And we'll see that the bond yields will reverse to a certain degree. Hopefully not entirely, but there is the possibility that, yes, this post-Liberation Day rally is entirely erased because the Fed is unable to cut because of the inflation.
Wow. Well, this is getting to be something, Edward, and we've got a couple of IPOs canceled now, StubHub as well as Klarna pausing their plans to go public because of everything that's happening. Some of the analyst notes this morning are deeply concerning. And unless Donald Trump does something this weekend, maybe it's exacting concessions, maybe it's backing off implementation of some of the reciprocals. On the 9th, we get the baseline that takes effect tomorrow. I mean, what are we going to look like on Monday morning if Donald Trump is sitting in the Oval Office with his arms crossed, not changing his tune on this?
You know, I think it was interesting that you talked about Vietnam and China, the juxtaposition there, and the fact that Harley-Davidson, I think actually Jay Powell was asked about Harley-Davidson moving production from China to Vietnam and then getting whacked anyway. It's an indication that there is room for negotiation in these tariffs, that really, this is just the baseline. Potentially, you could see the numbers come down significantly if the individual countries are willing to play ball, as the post from Truth Social seems to say. We saw that with Mexico. We may see that with Vietnam. So potentially, we're going to see something of that nature. But, the market is very much shocked at how high these tariffs are and the inflationary implications of that.
JP Morgan hiking recession odds today to 60%, up from 40 before the announcement of tariffs on Wednesday afternoon. Edward, is that an outlier? What are the markets saying about the R word?
Well, yeah, I think that is not an outlier. That is what the market is effectively saying. If you look at Fed fund futures, you look at swap rates, which show you what the market's predicting in terms of interest rate cuts. They're predicting 4 interest rate cuts, potentially a 5th, all within the space of this year alone. And given the fact that we all know that inflation is going to be 3.5%, who knows, as high as 4% at points in this year, that's only possible in the case of a recession. So very much so that is potentially the base case that's now being priced in to the bond market.
Perfect time to speak with the author of the Everything Risk newsletter, Edward Harrison. We missed you, Edward. Thank you for coming back. Bloomberg senior editor with us today on this Friday edition of Balance of Power. We've got our eyes, of course, on the Friday trade. That's what this is all about. We want to bring Charlie Pellet back into the conversation from World Headquarters in New York with his eyes on stocks and bonds today. Charlie, take it away.
All right. Thank you very much, Joe Matthew. Lower across the board on this Friday, on track for yet another losing week for the U.S. equity market, but you want to know what's going on right now. The Dow, the S&P, NASDAQ deeply in the red. We have got the sell-off intensifying, bonds paring gains, oil trading at a 4-year low. Fed Chair Jay Powell, you heard him on Bloomberg, reiterating the central bank's wait-and-see approach despite signaling the economic damage of a trade war that will be bigger than anticipated. Another 4.5% drop right now for the S&P 500 index, down 244 points to 5151. The Dow is down 1,591 points for the Dow, a decline of 3.9%, while NASDAQ is lower by 775 points, down another 4.7%. The 10-year at 3.92%, with a 2-year currently yielding 3.60%. Gold is down $91 the ounce to $3,024, a drop there of 2.9%. Crude oil slumping 7.7% at $61.77 a barrel, and Bitcoin higher by 0.7%, 82,888 on a Bitcoin. Stellantis, the parent of Jeep, Chrysler, and Fiat, offering employee discount pricing across its brands as the maker of Jeep and Ram vehicles seeks to lure buyers into its showrooms after President Trump's tariffs sparked fears of rising car prices. Stellantis down 5.4%. Ford, meanwhile, down by 0.1%. So again, stocks lower across the board here. S&P down now by 252 points, a drop now of 4.7%. Balance of Power continues right now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, we're just letting the headlines wash over us here along with the numbers that Charlie is bringing from New York. This is pretty scary stuff. And I'll tell you what, if Ryan Reynolds can't keep his cool, I don't know what I can say about the rest of us. Yeah, Ryan Reynolds. This company that he's involved in, actually he's the Chief Creative Officer, MNTN, a connected TV advertising platform set to go public, just put off the IPO. Was planned for next week. Ryan Reynolds, MNTN, said to delay the IPO amid the market rout that follows Klarna now and StubHub saying, guess what, guys? No thanks. We'll come back on another day. And who could blame them, not wanting to wade into the waters that Charlie Pellet there is just describing? So maybe it's a weekend for a little aviation gin, everybody, although now that I say it, don't we have to go out and stock up on our favorite imported wines this weekend? Baseline takes effect tomorrow, right? Reciprocals next week. Time to load up on the Brunello de Montalcino. Tariffs were front of mind when we spoke with the governor of New York yesterday. This is a big deal in New York, and of course they're sharing a border with Canada, so this has been a big deal for longer than just Wednesday. Kathy Hochul, the Democrat, speaking to the impact that these tariffs would have on New York. Let's listen.
The impact on New York, let me explain. This is the 10th largest economy in the world. We have Wall Street, we have farms, we have a border 450 miles with Canada. So we have a trade relationship with Canada over $50 billion. So already, here's what we're seeing. Droppings in bookings from Canadians coming to New York State, a huge source of tourism all the way to New York City, but certainly my hometown of Buffalo, where Canadians come over all the time and they go to our sporting events, they shop in our stores. So here's number one, sales tax revenues are dropping already. Now, speaking to a farmer in a very Republican part of our state, I'd call it Stefanik country in the North Country, he told me that as a dairy farmer, he gets his shavings, he gets his fertilizer, he gets all these products from Canada, and his costs are going up $10,000 a month, a dairy farmer. Not the total cost, but an increase of $10,000 a month. So there's such anxiety now Not to mention the Walmart mom who goes to Walmart like I did when my kids were little, that giant grocery cart with the oversized diapers and lots of baby food and paper towels. That's going to have an impact on people shopping at Walmart who come out of the trailer park like the one my parents grew up in. So I have to say, it goes all the way from Wall Street to the farmers, to the small towns, Main Street to Wall Street. There is a cataclysmic effect on this, and New Yorkers are reeling right now.
I hear where you're coming from here, Governor. I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we already have advanced manufacturing coming to New York. I literally got off the phone with someone who's in a pharmaceutical business looking all over the world, and he's very likely, with the deal I'm making, to come to New York. So we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area. So we're already reimagining our economy based on manufacturing, so that's important to me. I come from Buffalo. I mean, my dad worked at the steel plant. I know how hard it is when businesses leave, but we are backfilling in with businesses that we think will have a long-term future, and they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And, you know, I just don't know. All I know is that people were promised lower prices on Inauguration Day, and guess what? They're going up.
Well, is there anything you can do about that, Governor, regardless of what policy is set by the federal executive? You as a state executive, are there levers you can pull to help offset any economic pain that results from these tariff policies?
Well, I've had to have this conversation. I'm assembling some of the smartest economists in the country to help give us advice on this. This is an unforced error. This did not have to be this way. And yes, you can use tariffs as a tool to negotiate or, you know, have something in moderation, but this is so extreme and so immediate that I need to figure out with some real experts on what this is going to do. But I'll tell you what's going to happen. Wall Street goes down. Next January, when I'm looking at my revenues that are coming in from Wall Street bonuses, where I fund a lot of the generous programs we have in our state, that's going to be lower. I'm going to have to look at where we're going to have to cut there. I have to look at the whole picture now in the context of the budget I'm negotiating, the revenues I count on, the revenues I'm going to lose, but also the impact on our businesses who may not be expanding now. So I have to find ways we can use state resources to say, we'll help calm it down. What I can do for a farmer in upstate New York, that's a good question. I don't want them to suffer. 32,000 farms in our state. People think of New York as just Manhattan. I know they do. But it's so much more than that. An important part of our economy is our agricultural sector. So all of our sectors are going to be hurt. So I have to look at our budget, what we can do to help, other incentives for economic development. And as I'm doing, I'm trying to put money back in people's pockets. I mean, the average New Yorker will have $6,000 less in their pockets because of these tariffs, and that's an opinion by a number of economists. I have a budget I'm negotiating right now that puts $5,000 back in people's pockets. Child tax credits, a middle-class tax cut, the largest in 70 years, the largest tax rate decrease in 70 years, an inflation rebate for people who paid so much more in sales tax. So I have a path to put all this money back in their pockets. You know what's really sad? That's going to be sucked right out with the $6,000 they're going to lose because of tariffs. So I'll keep fighting. I'll keep doing what I can do, but this is a real hit on New Yorkers.
So it sounds like the potential for state tax cuts in the year ahead depend on tax receipts from Wall Street, Governor. Is that right?
Oh, it always does. I mean, I've not had an increase in our income tax because I want to make sure high net worth people know we appreciate them, and I don't want to drive them out of our state. So that's my view. But
does it increase the urgency behind extending the Trump tax cuts and eliminating the SALT cap? Because a lot of Republican members of Congress in your state are working to do that now.
Well, they better be successful. We want to make sure that the SALT deduction, state local tax deduction, is brought back 100%. Absolutely. And I have 7 Republican members of Congress. You better win on this one because you promised your voters you would.
That's the governor of New York, Kathy Hochul, speaking with us late yesterday, the late edition of Balance of Power, with her eyes on tariffs. This is, of course, before we walked into the news today. Before we heard from Jay Powell with another leg lower here on Wall Street, the S&P 500 now on pace for its worst two-day rout since the COVID lockdowns of March 2020. That's where we are here in our time machine, as we also watch the price of oil fall precipitously over the past several sessions here. Crude oil futures, West Texas Intermediate, now below $62 a barrel. WTI down 8%. And when we see a drop like that, we tend to reach out to Mr. McGlone, who joins us right now from Miami, covering commodities for us at Bloomberg Intelligence. Mike McGlone. And I know if I'm talking to you, Mike, twice in 24 hours, something is not going well here. We had the OPEC story, but it looks like the tariffs are really driving the price here, no?
Yes, well, at least it's going the right way for consumers. And the commodity traders don't really like when prices drop, but this is great for consumers. And it's an indicative of what's happening in this country. We have a massive glut, an excessive glut of crude oil and liquid fuels, and the market's going that way. So the average cost of production to produce crude oil in this country, according to Bloomberg New Energy Finance, is around $50 a barrel. We're going to that level. It's just a question of time. And now we have a decent catalyst to get there. The stock market going down was just one of those things that helped push it lower. It's the key thing, as I have to say, Joe, is those who have listened to me before, I've been saying this for 2 years, and I think it's eventually not going to bottom until it gets to below 40 or around 40, which is what it's done for the last 20 years. Yeah.
What does that mean for gas prices this summer?
Exactly. So this summer, no, gas prices are up a little bit now because it's a seasonal thing. But by the time we get to midterms next year, I think gas prices are more likely to be around $2 a gallon versus closer to $3.25 right now. That's just a normal cycle. So the last 20 years, gas has always bottomed around 4 or lower after it goes above, bottom around 2 or lower after it goes above 4. And same thing in crude oil. Every time it gets above 100, it usually bottoms around 40. The thing that's changed from the past is most of the time in the past, U.S. was a net importer. Now we're a pretty significant, massive net exporter, and our new government is just going to increase and continue to do that. So we have a glut. We have to export it. And that's the same thing in some of the grains. That's why those prices are lower. We have to export. If there's a trade war on it, pressures those commodity prices. So it's very good for deflationary forces.
Can you drill, baby, drill, and even increase production when you've got $50 a barrel?
Well, that's the key thing. We're not there yet, but what we've been seeing for years now in the futures curve, it's called normal backwardization. In the futures curve, you can see prices are lower in the future. They used to say that's bullish, but now what I think it's showing is those producers are selling forward and hedging a bit of their production. And right now, it's still a good sign. But the key thing is for the last 10, 20 years or so, to really shut off that trajectory of U.S. production increasing versus consumption, is that prices have to go down. And it's the force of price. And for now, the prices are still sufficient for us to produce more than we consume and for prices to continue to get to that level. That's what I call it. In the grain, people call it the low price cure. We're heading towards that low price cure, and it's just a matter of time I think we get there.
Normal backwardization. I feel like you're describing the way my brain works or something there, Mike. I like that. Did you come up with that?
No, I think Maynard Keynes wrote about that about 100 years ago. But it's a concept that in futures that switched back and forth.
Yeah. I always love talking to you, Mike. I appreciate it. What a week for crude. We didn't even get to gold, which is also lower today as this global sell-off continues in the wake of the tariff announcements. Mike McGlone, Bloomberg Intelligence. Look for him on the terminal and online for the smartest analysis in the energy space. We'll assemble our panel next. We've got a lot to talk about right here on Balance of Power, only on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Just getting word of another delayed IPO. This, according to the Wall Street Journal. Chime is delaying its IPO. Also, Circle Financial and Hinge said to be watching the market before their IPOs, again, according to the Wall Street Journal. But that headline right now on the Bloomberg Professional Service, Chime delaying its IPO. Stocks lower across the board for a second day. We are on track for a 6th week of losses in the last 7. The Dow, the S&P, NASDAQ, all very much in the red. Right to the numbers with the S&P down 4.5% now, down another 241 points at 51.54. We've got the Dow holding just above 39,000, 39,010. It is down 3.8% in today's trading. The NASDAQ Composite Index right now down 4.6%, lower by 764 points. The 10-year currently yielding 3.93% with the 2-year 3.60%. Spot gold today trading lower by $81 the ounce. That's a drop of 2.6%. Spot gold now at $3,033. West Texas Intermediate, just talking about that with our Mike McGlone. We've got West Texas Intermediate down another 7.6%, 61.84 barrel on WTI. Bitcoin higher right now by 1.1%, 83,257. A lot of moving parts to today's trading, including a jobs report. Job growth topped Wall Street forecasts in March, though the trade war cast a shadow on the solid labor market data. And with that story, here's Bloomberg's Vinny Del Giudice.
Last month's payroll gain, a solid 228,000, is the most since December. But that's before this week's tariffs. Many on Wall Street now see a recession sooner rather than later. Bond traders aren't looking back and boosted bets on Federal Reserve rate cutting to fend off an economic slump. So much for what would normally be good news. Wall Street seems to be acknowledging it's tough to stop a war once it starts. Finito El Giudice, Bloomberg Radio.
A week from today, we'll be hearing from J.P. Morgan Chase as banks start reporting earnings. J.P. Morgan Chase shares down now by 6.5%. Morgan Stanley down 6.6%. We've got Goldman down 7%. And among some of the regional names, First Horizon down 7.5%. And shares of Western Alliance Bancorp down by 7.7%. They're based in Phoenix. Recapping stocks lower, S&P 500 index down now by 4.4%. Balance of power continues. Keep it locked into Bloomberg for the latest. Once again, your host, Joe Matthew.
All right, Charlie. That's quite an update. Let that wash over you. This is pretty bad. It's hard to find a silver lining anywhere here as the IPOs just keep dropping. You heard Charlie? It's got another one now. Chime. You ever heard of this company? Chime Financial delaying the IPO. After we heard from several others, including StubHub, right? We got that one, Klarna. Even Ryan Reynolds decided to pack it up. MNTN. We got another one, James? Look at this. 8 Gritty Specialty Holdings said to delay IPO plans. Ensure, I guess I'm saying it right. 8 Gritty said to join other companies delaying IPOs. Remember Animal Spirits, everybody? We were coming in off the top rope on Inauguration Day. Charlie put his finger on another one, Goldman Sachs. Stock topped out on the 18th of February, $672. Animal Spirits. It is now selling for $474. The IPOs are dropping. The stocks, of course, are dropping. Bonds are holding up right now, as we discussed with Edward a little while ago, but it's anyone's guess how long that will last. After Jay Powell told us they're in no hurry to cut rates. That's when things really turn south here. We brought you live commentary from the chairman of the Federal Reserve codifying the idea of tariffs leading to inflation, and it is changing the outlook at the Fed. In his prepared remarks before they even got to questions, Jay Powell talking about risks of higher unemployment, higher inflation, now elevated, tariffs likely to raise inflation in the coming quarters, tariffs likely, the economic impact of tariffs likely larger than expected. And then the cherry on top, feels like we don't have to be in a hurry. We've got time. So if you're betting on rate cuts, that may not be working out too well either. And that's where we start our conversation with our signature panel. Rick Davis is here, partner Stone Court Capital, Republican strategist, and Jeannie Shanzano, senior democracy fellow with the Center for the Study of the Presidency and Congress, Bloomberg Politics contributors. Rick, I remember a period of time that, of course, helped to inform your view on things here when you were helping to run the McCain campaign for president in 2007, and it was your decision to bring the campaign to a halt because of what was happening in the economy. This was the beginning of the Great Recession, and we thought we were on the precipice of something much worse, and I think you could probably argue that we were. You went to the White House, where President George W. Bush was still in office, and you put together a meeting to help prevent the end of the economic world order as we knew it. Are we at another point in time like that today?
You know, I think you alluded to it. I don't think it's as extreme as that. You know, these were global structures. Banks were failing. The stock market went down substantially more than it has already gone down since the trade regimes went into effect over the last, a couple months. But it was more functional, right? It reached into every aspect of the financial network that existed in the world. And so, yeah, it was bad, and it had horrific political ramifications for the party in power, Republicans. And I know there are a lot of comparisons being made now. We have yet to see the bottom. We now know where the great financial crisis ended and how we recovered from that. I'm not exactly sure we know where the end is as these countries like China retaliate with their own, trade barriers, and other countries likely will follow. So I think we're just at the very beginning of a global trade war that, as of today, wouldn't be as bad as the great financial crisis, but as it continues, has maybe the potential to become as bad as that.
Jeannie, I'm sure you're looking at what Donald Trump is writing on Truth Social today. There have been a lot of posts, but the one that stands out to me in this conversation, he writes to the many investors coming into the United States and investing massive amounts of money. This is all caps lock. My policies will never change. I think he was trying to say that as a good thing, saying, hey, if you come here, you can rest assured that we're not going to turn on you. But saying at this moment, when the market is in free fall, my policies will never change, tells you what?
Well, he followed that up a few hours later with a similarly bombastic notion that he would be willing to negotiate, whether it pertains to Cambodia. And then yesterday he mentioned, hey, maybe we can negotiate with China as it pertains to TikTok. And I think that is part of the problem here. Unlike the example you were talking to Rick about in 2008, this is a self-inflicted wound. The president told us he was going to do this, and he did it. And the question now is why? And the administration cannot answer the why question. At times it's about negotiation. We're going to negotiate. Okay, many people are willing to accept that. At times it's because we want to even the playing field. That's not going to happen with companies, or rather countries like Bangladesh. We're never going to even that playing field. Other times it's to bring us back to the beautiful days of manufacturing in the U.S., reshoring here. All of those are fantastical ideas. They may be understandable. We'd all like more manufacturing here, but they're not going to happen in the short term. And so until the administration and the president can say why he's done this and inflicted this chaos around the world, that this is going to remain a problem. And that basic question, why, Mr. President, why are you doing this? He has been unable to give us an answer.
The IPOs are dropping like flies, Rick. Integrity, I think I butchered that before. Chime Financial, MNTN, StubHub. What was the other one we had? Klarna. How many of these do we need before Donald Trump looks at this a little bit differently? Or am I just asking the wrong question here? He's not looking at this at all.
Well, he's got to be looking at it. And I know that a number of his advisors are trying to think through ways to try and mitigate the economic impact dislocation here in the United States. But as Jeannie said, it's really a function of their own doing. There weren't any advisors I know who thought this wouldn't happen, right? In other words, everybody expected markets to react negatively to this kind of approach. And the fact that it wasn't sort of walked out early and tested and people could get used to it and run models against it before it was actually implemented, I think is really the biggest issue. By just surprising people on the eve of implementation, there were so many ramifications to consumers and to financial organizations and to corporations that use trade as a mechanism. Nobody could be ready for it. And even though he'd warned us that this was going to happen, I think it's still very much a shock, and still people are reeling with the idea of how long is this going to take to normalize, if it ever does, and what cost is it going to be to them? Can they survive it in the process?
Well, of course, Donald Trump would say, hold on, Jeannie. You're looking at the wrong post on Truth Social. This is, I think, what the White House would call progress. This would be qualified as my plan is working. Just had a very productive call. By the way, none of these in caps. Just had a very productive call with To Lam, General Secretary of the Communist Party of Vietnam, who told me Vietnam wants to cut their tariffs down to zero if they are able to make an agreement with the U.S. I thanked him on behalf of our country. What happens, Jeannie, if we get a dozen more of these over the weekend? And the S&P 500's up 5% on Monday. Is that also possible?
It certainly is possible. I mean, none of us can read the future, and that gets back to what I was saying. If he's using this as a negotiating tool, many members of Congress, particularly on the Republican side, they are open to that. And they're saying exactly with this conversation with the leaders, whether of Vietnam, Cambodia, that absolutely makes sense. But the reality is there are many countries on this list we are never going to have, we will always run a trade deficit, because in return for that, we have gotten cheaper and better goods from them. That's the way this has worked. But yes, if it's a negotiating tool, that's fine. Why a few hours ago, though, did he say he will never change his policy? And this gets me back to the goal. When we do something in public policy and it impacts so many people's lives, tell us why you're doing it and what the timeline is roughly and what the end game is. And we haven't gotten any of that clarity from the president. We know he's committed to this. We don't know how, we don't know why, and we don't know what the end run is here. And in the meantime, the pain is very real. And we have a right as Americans to say, is this pain worth the end goal? It's hard to answer that if you don't know what the end goal is.
Rick, J.P. Morgan analysts are hiking their forecast for a recession to 60%, up from 40% after the announcement this week at the White House. Is there an equation or a model that you can use as a political practitioner to see what that means for Donald Trump? If we go into a recession this year, what does that mean for midterms? What does that mean for favorability, ratings, right track, wrong track, et cetera?
Yeah, well, I mean, I experienced a similar situation, and as you remarked, the 2008 presidential campaign, voters took it out on a party. They didn't take it out on an individual. The Bush administration was ultimately responsible, and yet it reflected on our campaign and John McCain's winnability. We went from being 5 points up to 5 points down in 1 week following the 2016 or 2008 crisis. And yet Republicans lost even substantially more. Think about it. We had historic losses in the House and the Senate. And I think the way to look at it is right off of what we experienced this week. We saw that House races in Florida that Donald Trump won by 30% still stayed Republican, but they stayed Republican by half that amount. If you look at every Republican in the country who won in a Trump district where Trump won by 12 points or less, you're talking about 40 members of Congress who could be at risk today for re-election. I mean, that is a significant rewrite of midterm strategy versus, Republicans in a +3 district might be vulnerable. So as you see the public sentiment turn against the Republican Party for what they would perceive as fiscal mismanagement, you have to start moving that window out of the number of members that might be at risk.
Rick Davis and Jeannie Shanzano, quite a conversation on the Friday edition of Balance of Power. Thank you both. This is Bloomberg.